Ladies and gentlemen, my name is Khyati Kawa, and it is my absolute pleasure to welcome you all to this remarkable NaBFID Infrastructure Conclave 2024. We are thrilled to have you here with us. Bank for Financing Infrastructure and Development for Establishment of National Bank for Financing Infrastructure and Development, better known as NaBFID, as an infrastructure-focused development financial institution. The NaBFID has come into force effective April 19, 2021. The Reserve Bank of India accorded it making NaBFID the fifth AIFI after NABARD, SIDBI, NHB, and Exim Bank. Well, the objective of the conclave today is to facilitate knowledge sharing, collaboration, and strategic partnerships among stakeholders, address challenges, and catalyze sustainable development initiatives within the industry. The conclave will also provide all of us with insights into the infrastructure industry. It will also provide all of us with insights into key areas such as emerging technologies, sustainability practices, project financing and investment, urbanization and infrastructure planning, amongst others. We all will receive updates on the latest regulatory and policy developments, and we will also actively engage with a diverse group of peers, rating agencies, executives from banking and infrastructure sector, and industry experts. As we are about to commence our event by lighting the lamp of knowledge and wisdom, I request our dignitaries to please join us on the dais. Ladies and gentlemen, please join me in welcoming our RBI Deputy Governor, Mr. Rajeshwar Rao. Also like to invite NaBFID Chairman, Mr. K.V. Kamath. Join us in welcoming DFS Joint Secretary, Mr. Manoj Muttathil Ayappan. Please join us in welcoming the Executive Director of SEBI, Mr. Pramod Rao. And we'd also like our NaBFID Managing Director, Mr. Raj Kiran Rai ji, to please join us on stage to do the honors for lighting the lamp. Thank you so much to all our dignitaries. Request you to please take a seat on the dais. And ladies and gentlemen, as we've started this morning on this very auspicious note, I'd now request our NaBFID Managing Director, Mr. Raj Kiran Rai ji, to please welcome our RBI Deputy Governor, Mr. Rajeshwar Rao, with a bouquet of flowers. request Mr. B.S. Venkatesha, NaBFID DMD, to please join us on stage and welcome. Yes, please join us in welcoming our DFS Joint Secretary. Ladies and gentlemen, give a warm welcome. Mr. Manoj Muttathil Ayappan. Thank you very much for joining us, sir. I'd also like to request Mr. Samuel Joseph Jibaraju, NaBFID DMD, to please welcome our chairman, Mr. K.V. Kamath, with a bouquet of flowers, please. I'd now like to request Ms. Monica Kalia, NaBFID DMD, to please join us on stage and welcome Mr. Pramod Rao, Executive Director, SEBI, who's joined us today. Ladies and gentlemen, a big warm welcome to them. Thank you, ladies. Once again, we'd like to thank our dignitaries on the dais for taking out the time and being present here today and gracing this occasion. Ladies and gentlemen, I would now like to request our Managing Director, Mr. Raj Kiran Rai ji, to please join us and set the context for the day. A very warm welcome, sir.
A very good morning. On behalf of NaBFID, I welcome you all for the first Infra Conclave of NaBFID. First of all, I welcome Secretary who will be connecting from Delhi because of his pressing engagements. He could not be personally here, but we welcome him, and also welcome Joint Secretary Mr. Manoj Ayappan, who is representing him today. We also welcome the Deputy Governor, Mr. Rajeshwar Rao, who is here despite his busy schedule. He has come here to spend some time with us and give us guidance. So welcome, sir. We also welcome Mr. Pramod Rao, representing SEBI here, actually because Madam was supposed to be here, but then due to again some pressing engagements, she couldn't come. He is representing, so welcome, sir. And I also welcome all the directors on NaBFID board who are here, the senior leadership from the BFSI sector, delegates from the government, ministries, the regulators, the multilateral development banks, and academia. And also welcome to our knowledge partners for the conclave, namely the BCG, the Bloomberg, CRISIL, and the World Bank. Again, welcome you all for this inaugural conclave on infrastructure sector organized by National Bank for Financing Infrastructure and Development. It's an honor to have you all join us this morning. So we are grateful to all the dignitaries on the dais, actually particularly Mr. Rajeshwar Rao sir, because we were a very, very new organization, and operationalizing NaBFID was very difficult. Actually, whenever I approached him, they were very positive to NaBFID, and all the decisions required from the regulator came very, very quickly. So special thanks to you, sir, playing such an important role in setting up of this NaBFID. Similarly, I acknowledge the DFS, represented by Mr. Manoj here. Actually, because this is a very different kind of organization where there is no template, and acknowledge that the secretary and all the executives at DFS really held our hand together so that we could ramp up quickly, operationalize NaBFID very quickly. And also special thanks to our chairman and directors on the board. And it is their vision and dedication to shape NaBFID, deliver on its mandate. This conclave is a key initiative towards fulfillment of our developmental mandate. Our aim is to bring all stakeholders together at one platform to discuss, debate the issues and on infrastructure development in India, and how best we can enable financing for infrastructure. The knowledge partners helped us bring rigor and depth to our analysis of key issues. It is widely accepted to be a key enabler to economic growth and development. It helps unlock productivity and improve policy push to build infrastructure in the country, leading the way. To set the context for today's conclave, I would like to visit some of those areas of infra. There is a lot of negative perception because of our past experiences around this segment. Even today, even though things have changed, but then a lot of perception issues around this sector is still there. Some practical insights with some study from NaBFID and during the last 10 years, whether it has really yielded results, whether it has impacted this sector. So this study done internally by NaBFID is something which I will present. First, let us visit the enablers which happened in the last 1 decade. Yes, we entered 2014-15 era with a lot of issues around infra, and we also had a good analysis and understanding that why these problems came up in the first place. The first thing was, most of this problem was sitting in the financial capitalization problem, what we call the three banks were encouraged through AQR and other measures from the regulator to identify the problem, recognize the problem, and then also make appropriate provisions. And that's what happened during this period, which is actually the area where like almost most of the issues got solved. And we actually maybe had it persisted, maybe would have entered COVID era with the problem and that would have complicated the issue. But it is in good time that these problems were addressed by both the regulator and the government, and we entered by 2019-20 with a very, very clean slate. And then other initiatives was the IBC, is a game changer, the insolvency and bankruptcy regime, because that put the fear in the mind that how much impact it had on actually doing business, and also resulted in much quicker recoveries. Even though there are issues around IBC saying that it is still delayed beyond what is anticipated initially when the act was enacted, but it is still much better than the earlier recovery processes. Issues, environmental clearances issues, and many other issues, and even the legal issues. So, but then today, no project gets appointed date without environmental clearance. Those issues which plagued this sector earlier. One of the major reasons, particularly around the power sector, but the coal mining and other areas, telecom, all these issues happened because some of those policies were questioned and the courts intervened, that saying that these are not that, are actually were tested, and now the resource allocation is happening in the last few years without any issue. There are no legal challenges. That's why infra around this space is also taking off very well. We are not seeing those issues which were around that time. Then changing promoter profile. Actually, I have some slides to substantiate this later. But then if you see, most of these players who are in the infra today, who execute these projects, their profile has changed substantially. So, like PE funds are coming in, sovereign funds are coming in, a lot of pension funds are coming in, even the domestic, actually, companies which are around this, many of them are listed. We can see the quality of these promoters, the kind of capital which has come in, which is very issues was the payment, actually, like, you know, the government also took steps to develop, like NHA as a very strong counterparty. The whole of road sector, particularly in the last few years because of the HAM model or the annuities and all that, where the construction risk was still with the banks and the builder, but the revenue risk was totally taken away. Hopefully now actually this has kick-started that sector, and now gradually the toll roads are again coming in, and hopefully maybe the system is ready to even look at them now. Similarly, on the energy side, actually the state discoms, actually the kind of initiatives taken in the last few years has actually reduced the receivable levels at every level, and most of the players in this sector also are doing very well, and this is attracting a lot of investment also into the country by way of InvITs and other structures also. So these InvITs and REITs have also played big role actually particularly in the operational assets area, because this is very important, because these are all very long-term assets. Like one particular set of lenders take care of the construction risk and the initial risk, which is slightly higher. Once the project becomes operational, because the revenue risk is not much today, that it moves into restricted group structures, the InvITs, REITs, and the other financial institutions, maybe probably the pension funds and insurance companies come in, and that is where the bond market development also is very much required. And hopefully these initiatives which have happened over a period of last 10 years in this particular, will show exactly how it has resulted in some, better governance structures and how the numbers have improved. And my request here to the friends from the media and other friends, not to draw conclusion. Tomorrow, please don't print. These numbers are limited to rated companies, particularly on the infra sector, just to draw some conclusions. This has a limited purpose for this conclave to put some number, resulted in some good things. That because this data, what we have is tomorrow headline should not speak that NaBFID challenges regulator. No, because many times when we speak, because this is just to try to bring another perspective. So, but this is authentic data. You can rely on this data because this is coming from about 2,500. Look at the profile of the companies. We took a sample of about 2,500 companies in 6 infra subsectors. This is solar, about 913 companies. The power, others, basically thermal and other areas. And then the highways, that's the road sector. Then the wind. Then the marine ports and services and airport, the numbers are slightly smaller here, but they're very big investments. So this is the profile of the companies which we looked into. And then we looked at the default rates. Actually, this is very revealing. It is not that it is something new. We have this data around this. Now, if you look at, we studied almost 2010 to 24, actually. Analyze, I think, statistics, 50-year problems started coming in. So, 2000 by one-day default. That's why I'm saying that it is not perfectly matching. But then the trend is very clearly visible. So, 2012, it moved up, 13, 14, 2015, for various reasons, it came down slightly. But then again, the AQR came in. Then it went to 8.5. That was the peak, actually. Then came down and again went to 8.1. And then it started coming down. Now, this is where I come in the last phase, if you see, particularly 2019, 20, where most of the recognition happened, the recapitalization happened, then the IBC came in, a lot of resolutions happened, and then you see the numbers coming down. Now, the default rate is practically around 1% in the last 2-3 years. During that period, has definitely resulted of the pricing we did. Actually, because when we saw this data, so whether it is reflecting the pricing, because across the industry, infra funding is happening. So we saw very surprising to us, average lending rate for the infra companies is around 8.75. Okay, actually, see, that way we need to respect the increasing of the risk is also happening, actually, according to, which is actually evident in the last 3-4 years. So in the system, to further investors in the rates, because this is another interesting area. Triple B and above is what companies which are investment grade, where generally the lending hovered around, below 1 for the last infra companies of all the next one. These are companies which are in this space. Today's date, 91% are investment grade and above. Are investment grade and above. There is enough space to lend. And actually, it is a very, very revealing thing. Rating has moved. Come 2005, the core real infra is around A-. Highways, roads are still A-. Solar is A+. The median rating around solar is A+. Similarly, wind is around substantially improved. And this is an internal study based on the domestic rating available, study of about 2,500 companies. And our team has gone in. So the calibrate what further, and it's the time that we take it to the, look at the future and how the things are shaping up. Similarly, actually, this is the time we need to look at. Actually, we are talking of 6%, whether even 8% is enough to reach the goal in 2047. This is again a matter of debate. And infra is one space with a very high multiplier effect, which will play a big role in playing that, important role of Viksit Bharat. Now, if you look at this today happens from the government and all the background I have spoken about, I think maybe the time has come to rope in other investors. Maybe this conclave will pave the way for everyone to look at by crowding. Basically, first of all, I have to do this job of asset, and this is where they're trying to create a data report rather than actual data. And there is not much data available around this infra space. And actually, I was very happy to see in RBI, one project finance guideline, actually they are already speaking about data and in touch with various government departments to, tomorrow if you have to really develop all PD data, LGD data, everything, we are trying to do that maybe in 1 year time. When as we do the next conclaves, we will be able to come with more data on this. And now the next half year, we will be looking at financial institutions for financing this. And it is very important to take out operational assets out of the bank books so that, they can take 20, 30-year bonds. And this is one space, 20, 30-year bonds. And this is one space which can supply that investment avenue for those people. And maybe it is the time to rope them in. And also tapping the global savings as a pool for lowering cost of capital, because this is very important. Internationally, these funds are available, particularly when we are looking at the climate and related financing. The global funds have to be tapped, and we all have to work together to bring the cost down for most of these climate-related financing. So, a lot has happened, and I'm very sure, actually, this conclave will lead the way to bring all these stakeholders together, all the academia together, all the media together, regulators and the government departments, and pave the way for the way forward, and let infra attract all the investment needed. It's very important goal to be achieved to really achieve Viksit Bharat. Thank you, and thank you for your patience.
Thank you. Thank you so much, Mr. Rajkiran Raiji, for setting the stage and providing us with valuable insights into the vision and mission of NaBFID. We greatly appreciate you setting up the perfect context for what promises to be a transformative day ahead. Ladies and gentlemen, to give you a glimpse of what's in store today, we have an exciting lineup of insightful presentations and dynamic panel discussions featuring our esteemed speakers who are industry leaders and experts in infrastructure and finance. It is my absolute honor to introduce our first keynote speaker for the day, Mr. Rajeshwar Rao. Shri M. Rajeshwar Rao took over as the Deputy Governor of Reserve Bank of India on October 9, 2020. He was the Executive Director of the Reserve Bank prior to the elevation to the post of Deputy Governor. As Deputy Governor, Shri Rao looks after the Department of Regulation, Department of Communication, Enforcement Department, Legal Department, and Risk Monitoring Department. He also represents RBI in various international organizations such as Financial Stability Board and Network for Greening the Financial System. Shri Rao, a career central banker, joined the bank in 1984 and has worked in various positions in Reserve Bank of India. Ladies and gentlemen, please join me in welcoming Mr. Rajeshwar Rao to share his invaluable insights and expertise. Let's give him a bigger round of applause, ladies and gentlemen. Very warm welcome, sir.
Thank you for the introduction. Good morning, everybody. The distinguished members in the panel at the dais, Mr. Kamath, Mr. Ayyappan, Mr. Pramod Rao, Mr. Rajkiran Rai, and maybe virtually Mr. Nagaraju, Secretary DFS. A very good morning once again to all of you. It's a pleasure to be here today at the NaBFID's Infrastructure Conclave, which provides an excellent opportunity to interact with the participants who play a critical role in India's infrastructural journey. Infrastructure can be thought of as a framework of facilities and systems that enables an economy to function efficiently that can then make possible optimal outcomes for the society at large. It is therefore a critical catalyst in fueling a country's economic expansion and holistic development. It lays the foundation for a prosperous and equitable society by enhancing productivity, attracting investments, expanding markets, and improving quality of life. India is the fastest growing major economy in the world, and as it embarks on an ambitious journey towards emerging as a global economic powerhouse, the role of solid and reliable infrastructure is becoming paramount. Recognizing this, India has made and committed substantial infrastructure investments during the recent years through various policy measures such as the National Infrastructure Pipeline, the PM Gati Shakti National Master Plan, Bharatmala Pariyojana, Sagarmala Pariyojana, etc. An allocation of rupees 11.11 lakh crores for capital expenditure in the union budget this year, amounting to 3.4% of the GDP, seeks to reinforce this commitment. Historically, public expenditure has been the cornerstone of infrastructure development in India. However, considering the limits up to which we can depend on public infrastructure and public expenditure, the involvement of private sector becomes crucial in funding the expansion of infrastructure, fostering industrial competitiveness, broadening the access to the talent base, and optimizing the use of resources. It is in this context that a specialized institution like the National Bank for Financing Infrastructure and Development, better known today as NaBFID, has been set up with a specific mandate to support long-term infrastructure financing in India. It is envisaged that this can play a transformative role in bridging the funding gap to catalyze the participation of the private sector. Against this backdrop, let me briefly reflect on the challenges in infrastructure financing in general and the critical role that can be played by NaBFID in overcoming these challenges. I would also like to flag a few emerging issues that the NaBFID should navigate to effectively deliver on its mandate. Just to set the context, let me begin by sharing a brief perspective on the concept of developmental financial institutions. In the immediate aftermath of the World War II, when the war-ravaged nations and the newly independent countries embarking on the path of rapid industrial development, the nations quickly realized that financial systems of the era were not equipped with the necessary skills in pricing and managing risks associated with financing projects with long gestation periods. To address these shortcomings, the developmental financial institutions were set up across the globe by governments to cater to the requirements of financial resources for the developmental effort. These institutions enjoyed government support for underwriting their losses and had access to cheap funds from multilateral and bilateral agencies duly guaranteed by the governments. However, as the governments eventually found it difficult to support them due to budgetary constraints and for considerations of favor of market efficiency, many of these DFIs were repurposed. The Indian DFIs too traversed a similar path as their global counterparts. It started with the establishment of IFCI in 1948, along with an ecosystem of state financial corporations. It was followed by the establishment of other term lending institutions like the ICICI and IDBI to support development in various sectors of the economy. By providing long-term industrial finance, these organizations played an instrumental role in stimulating capital formation and in supporting investment activities within the country over the 4 decades. However, elevated NPAs coupled with increased competition from commercial banks forced the DFIs to realign their strategies. As they found their business model to be unviable, some of them converted into commercial banks. Financing infrastructure presents a unique set of challenges requiring specialized expertise. To begin with, there is a need to have a consensus on the definition of infrastructure itself. The Rangarajan Commission in 2001 identified 6 characteristics of infrastructure sector: natural monopoly, high sunk costs, non-tradability of output, non-rivalness in consumption up to congestion limits, and the possibility of price exclusion and bestowing externalities on society. Some of these characteristics stem from the inherent challenge of financing the infrastructure sector rather than the nature of infrastructure itself. High sunk costs, coupled with long gestation periods, further complicate the financing of infrastructure projects and lead to asset liability mismatches. Delays in approvals, clearances, land acquisition challenges, and breaches of agreement also add to the risk of project financing and cause further issues like cost overruns. The interdependence of infrastructure projects further complicates financing, as unlocking the true potential of an infrastructure project is often contingent upon availability of complementary infrastructure. The interconnectedness can convolute the financing process, as impediments or delays in one project can trigger a cascade of causal effects impacting all other interconnected projects. Consequently, the successful fruition of an infrastructure project often hinges on the availability of synergistic infrastructure, comprehensive planning, meticulous synchronization, and proficient execution. This underscores the necessity for having an integrated approach to infrastructure development, where the projects are not perceived in isolation, but as components of a complex interconnected matrix. The long life cycle of infrastructure projects necessitates the involvement of different financial entities, specializing in various phases of projects, aiding the process by refinancing, transferring, and taking over of projects between these entities. The comparatively underdeveloped financial system and a market for raising debt for the infrastructure has made the sector reliant upon banks and NBFCs for its financing needs. However, the spike in non-performing assets in the banks in the last decade and the debt default by a systemically important NBFC engaged in infrastructure financing. The recent downward trajectory of non-performing assets, coupled with the enhanced resilience of the non-banking financial companies, signifies a positive shift for the sector. Recognizing the importance of infrastructure financing for economic development, the Reserve Bank of India has implemented several significant measures within the framework of prudential measures. The NBFCs are permitted to exceed the specified credit exposure limits to a single borrower by an additional 5% if the extra exposure is allocated for infrastructure. The banks that are currently asked to ensure that the promoter's contribution towards equity capital should come from their own resources, or they should not be provided advances for purchase of other companies, but there is an exception made for financing the acquisition of the promoter's share in the infrastructure projects. Banks are also allowed to issue long-term infrastructure bonds to raise market funds. These funds are exempt from priority sector lending requirements and are not subject to CRR SLR requirements. The bank's lending to infrastructure investment trusts was permitted in 2019. And with a view to enabling long-term providers of funds to invest in bonds issued by funding projects by corporates or SPVs, banks are allowed to offer partial credit enhancements. Banks, AFIs, and select NBFCs can also act as market makers in credit derivatives as a part of RBI's effort to put in place a market-enabling regulatory framework for the corporate bond market. Notwithstanding the efforts taken by the government and the regulatory framework enabled by the Reserve Bank, it is evident that more needs to be done to meet the country's infrastructure needs over the next few decades as we move on the path of aspiring to be a developed economy by 2047. Here, an institution like NaBFID can undoubtedly play a pivotal role. The National Bank for Financing Infrastructure and Development, or NaBFID, was established to support the long-term non-recourse infrastructure financing in India, including the development of bonds and derivative markets necessary for infrastructure financing. I would like to highlight some areas where we believe the NaBFID should focus given its mandate. The NaBFID has taken promising strides by sanctioning more than rupees 1 lakh crore by the last financial year, along with substantial increase in the actual disbursals. The initial capital of rupees 20,000 crores supplemented with the additional grant of rupees 5,000 crores should support the loan book growth in the near term. Further, the growth in scale of large institutional investors, such as the life insurance companies and the pension funds, presents an opportunity for NaBFID to secure reliable long-term funding for their financing needs, offering a natural fit. Consequently, it should also strive for a strong credit rating which will help it to tap both global and domestic sources of funding in future. It is also necessary that over the medium term, plans for self-sustainable operations under a business model that is not reliant on continuous government support or regulatory dispensations need to be put in place. The dynamic nature of our times necessitates agile strategies for institutions with focus on sectors prioritized by the government, thereby complementing the overall government efforts, while retaining the required flexibility to pivot its strategies as per the changing needs of the economy. In this context, the role of governance is crucial. RBI has increasingly underscored the significance of governance and assurance functions within financial institutions for long-term sustainability and growth. The role of the board is critical in guiding the future path of the institution and in attracting long-term potential institutional investors. An independent, skilled and professional management is an important enabler in this process. As NaBFID is still in its formative phase, the focus must be on equipping itself with the necessary resources, skills and knowledge through concerted efforts on human capital development, on institutional strengthening, and in adoption of best practices. As with any other entity in the financial service sector, NaBFID must particularly look to strengthen its risk management and establish robust assurance systems from the outset to foster a sound risk culture going forward. While NaBFID Act provides various enabling features to attract the best talent and get the best expertise, NaBFID would need to quickly develop project appraisal expertise and establish itself as a leader setting benchmarks in the market for its project selection, appraisal and monitoring to give comfort to lenders and stakeholders. We also need to learn from the past mistakes. The absence of post-dispersal monitoring of credit utilization was a key design failure in the erstwhile DFIs, which resulted in suboptimal outcomes. There is a need to learn from the past episodes and set up dedicated units tasked with ongoing monitoring and evaluation of funded projects through comprehensive and frequent surveys and assessments, which will not only enable dynamic appraisals for subsequent disbursements, but also ensure that finance and tangible progress in the projects are in sync with each other. Furthermore, necessary mechanisms must be put in place for dealing with liquidation and resolution of bad assets, and sufficient expertise must be built internally towards this end. There cannot be a more pertinent time than this to stress the importance of climate risks and the required mitigation. We are witness to the risks that are manifesting and affecting various facets of the economy. The biggest challenge faced by the emerging markets, and more so India, is the availability of adequate financing for development of technologies and requisite infrastructure to cater to the issue of climate change and build a sustainable economic system. Technology and infrastructure will be the fulcrum for driving the crusade against climate change and fostering sustainable growth in the future. Low-carbon, climate-resilient infrastructure is the way ahead, and the world is looking forward to it in terms of dealing with climate-related risks. Specialized financial institutions like NaBFID can contribute significantly to climate finance and the LCCR infrastructure development in the economy by facilitating investments of public and private funds towards these projects. Specifically, these institutions can provide access to capital through concessional and non-concessional lending, through equity investments, attracting climate-specific funds, encouraging public-private partnerships, risk-sharing instruments, specific grants and assistance, as well as technical assistance. Given the need for supporting technology-enabled ecosystem across the life cycle of infrastructure projects, there is also a requirement to develop specific expertise and focus on an ecosystem of sustainable finance in the country. It can specifically work towards mainstreaming the LCCR development and enable the country to meet its emission targets. It can also aid in developing any symbiotic infrastructure development that has beneficial after effects on mitigating climate change. Let me also reflect a bit on the developmental role for the NaBFID as a new age DFI. In addition to its financial objectives, NaBFID can play an important role in several crucial development objectives. Bond market development and provision of technical assistance and consultancy services for infra projects is one. It can strive to become a market maker and provide adequate liquidity to the investors. Further, to ensure that the custodians of the long-term funds, that is the pension and insurance funds, derive comfort in lending to the infrastructure sector to match their long-dated liabilities, it can think of offering innovative solutions like providing partial credit enhancements through rating upgrades or providing first loss default guarantees. It could play a critical role in facilitating loan syndication for large ticket loans and a lead role in supporting the Secondary Loan Market Association in development of credit markets as well. As NaBFID develops its internal rating models for credit appraisal, it may also be able to offer products such as credit default swaps, which would go a long way in ushering confidence in the bond market space. As the Indian economy continues to grow, it is imperative that the infrastructure is seen as a factor of production like labor and capital to attract necessary focus, considering its multiplier effects in capacity building, in the development outcomes, and in societal well-being. While the historical challenges and lessons are instructive, NaBFID has a unique opportunity at this point to play a transformative role in shaping India's infrastructural landscape. The journey ahead necessitates a delicate balance between financial prudence, developmental impact, and having a long-term vision on this issue. As a new generation DFI, NaBFID must strive to remain at the forefront of the task of driving innovation and ensuring infrastructure development is inclusive and sustainable. I'm sure during today's conclave, the delegates will have fruitful discussions on some of these issues. I extend my best wishes for the success of this conclave. Thank you. Namaskar.
Thank you so much, Mr. Rajeshwar Rao, for that enlightening and thought-provoking keynote address. With that, I would request all our dignitaries on the dais to take a seat in the front row just opposite the stage, as we will now set the stage for our next keynote address. And I'm pleased to announce that our next keynote speaker has joined us online, and he'll be visible on the screen, which is why after this perfect picture of all our dignitaries on stage, we'd request them to please take a seat in the audience. Thank you so much, sirs. Thank you, team. Ladies and gentlemen, I'm pleased to welcome Shri M. Nagaraju, Secretary, Department of Financial Services, Ministry of Finance, who is an IAS officer of 1993 batch. Over the course of the service, he served at state, national, and international area in the areas of public order, revenue and development administration, tribal development, finance, international economic relations, industries and commerce, healthcare, and state finances. He joined as Joint Secretary, Ministry of Coal in January 2020 and got promoted as Additional Secretary, Ministry of Coal by November 2020 and continued in the same ministry. Shri Nagaraju got promoted as Secretary to Government of India and was immediately appointed as Secretary, Department of Financial Services with effect August 2024. We are pleased to be joined by Mr. M. Nagaraju, Secretary DFS, as he takes the stage online to share his insights with us today. Ladies and gentlemen, can we give him a big round of applause? A very warm welcome, sir.
Thank you. Thank you very much. Good morning and namaskar, respected Chairman NaBFID, Mr. K.V. Kamath, respected Deputy Governor RBI, Mr. Rajeshwar Rao, and other distinguished panelists on the dais, and ladies and gentlemen. At the outset, let me express my regrets physically not able to be present along with all of you to speak and also to learn from all of you. This is my loss because of the other pressing engagements today here. I could not be physically present. In fact, it's my pleasure to address this distinguished gathering of key stakeholders from the BSFI, infrastructure sector, academia, and the government bodies to collaborate and share insights on shaping the future trajectory of India's infrastructure landscape. The Infrastructure Conclave 2024 is a first of its kind initiative taken by the NaBFID, and it marks a new milestone in India's infrastructure space. In fact, I congratulate the MD NaBFID, Mr. Rajkiran Rai, and his team for this initiative. In my remarks today, I briefly touch upon India's improving fundamentals, especially aspects to put India's sustained growth performance. I will also share my expectations from the NaBFID and financing committee in general. Now, we all know India is ready for a long haul outperformance. India's journey to its first $1 trillion in GDP took 58 years. The second trillion took 12 years, and the third was achieved in just 5 years. The economies of scale and the productivity gains are clearly visible. In the economy, India has been fastest growing large economy in the world with a robust macro stability post-COVID. It is reflective of investment-driven approach taken by the government, partnering the private sector. We aspire to becoming a $30 trillion economy by 2047, the overarching goal of Viksit Bharat 2047, and developed country with high standards of living for every Indian. Demography is on our side. India's working age population will continue to increase through 2036. About 735 million people, or about 60% of India's population, is in the working age group of 15 to 59 in 2011, and this is expected to increase to almost 1 billion by 2036. A rapid pace of urbanization is underway, giving a lot of opportunity for investment and development. By 2036, approximately 40% of the total population of India will reside in towns and cities, contributing nearly 70% of India's GDP. We are home to largest entrepreneurial ecosystem, around with millions of micro, small, and medium enterprises who are aspiring to grow bigger and better. Most importantly, we are building infrastructure at an unprecedented pace. Our investment rate has risen of late with enhanced budgetary focus on increasing the capital expenditure. Infrastructure assumes paramount significance in policy paradigm given high multiplier impact. To sustain a high single-digit growth rate over the next couple of decades, India needs to spend 8 to 10% of GDP on infrastructure. Achieving this will require more than just budgetary outlays. So far, 3/4 of the infrastructure spending is borne by the government. This must change. There should be greater participation by the private sector. For that, whatever is required to enable the private sector to invest, the government is ready to build that ecosystem. The government has made significant efforts to make infrastructure emerge a safer asset class, including changes in concession agreements, the creation of stronger counterparties, and setting up institutional arrangements like insolvency and bankruptcy code. National Asset Reconstruction Company Limited and Specialized Development Finance Institution like NaBFID. These efforts are supported by other initiatives like National Master Plan, aimed at providing multi-modal connectivity for movement of goods and people, the National Monetization Plan, which seeks to unlock the value of older assets for new asset creation, and the scheme for special assistance to states, providing long-term duration interest-free loans for durable asset creation. The banking sector is in the best shape today to support India's growth aspirations. Our banks are well capitalized, noting robust credit growth and less stress in terms of asset quality. Likewise, Other participants of financial ecosystem, such as insurance and pension funds, have greater flow of financial savings available today. We need a holistic approach to solve financing constraints for infrastructure sector. As per CRISIL report, infrastructure investment will nearly double by 2030 to almost 142 lakhs. As the government works on fiscal prudent path, the dependency on household surplus will come down, creating a robust pool of funds available to support the financing requirements of the corporate sector. By appropriately channelizing savings into investments, the cost of capital can be brought down, paving the way for a dynamic cycle of investment-driven growth. In this regard, NaBFID can actually play a catalyst role in infrastructure development. In our journey to becoming Viksit Bharat by 2047, the youngest development institution, financial institution, NaBFID, has an ever greater role to play in the Indian economy. Apart from its financial objectives centered around lending towards infrastructure, its developmental objective in the form of creation of an ecosystem to foster deepening of bond markets holds key value in properly channelizing capital towards productive uses. There is a need to have a long-term plan in place, especially for core infrastructure such as highways, ports, railways, airports, and social sectors like health, education, and sanitation. Developing a project pipeline in collaboration with both the government and private sector is the key. NaBFID can play a role here through transaction advisory services. It should also build specialization on key infrastructure sectors that other stakeholders can leverage. By assuming project execution risks early on, NaBFID can create a pool of assets available for financing by commercial banks and other long-term institutional investors. Additionally, through innovative financial instruments, commercial banks can manage their portfolios, say every 3 to 5 years, with an NaBFID facilitating the involvement of other institutional players. Likewise, raising low-cost long-term resources is crucial for making infrastructure projects viable. NaBFID has taken a promising step with the issuance of a 20-year bond. I've been informed that there is a tremendous response to the bond across investor spectrum is quite heartening, which is a testament to the maturity of our market. NaBFID can collaborate with the MDBs, particularly those focused on green funds, to provide blended financing structures in the country. Additionally, exploring pooled structures for municipal finance could aid in raising resources for urban infrastructure. Technological initiatives Technological initiatives to leverage various data points and information may also be developed in coordination with other stakeholders to attract private capital on a sustainable basis. The solution to India's infrastructure needs presents a promising opportunity for a collaborative effort, bringing together all stakeholders. A nimble-footed and agile approach aimed at inclusivity, innovation, and creative disruptions of technology would be appropriate to the cause of Viksit Bharat 2047. By dedicating ourselves to building capacities and driving innovation today, we can create a powerful momentum that will sustain our economic growth and lead us to a self-sustaining path of development. It is crucial that we remain committed to this goal. This infrastructure conclave is an exciting opportunity to gain new insights into challenges and explore innovative solutions. I wish the conclave and NaBFID all the success. Thank you so much for giving me a patient hearing. Thank you.
Thank you, ladies and gentlemen. We are now honored to have with us Mr. Pramod Rao, Executive Director at Securities and Exchange Board of India, handling Department of Debt and Hybrid Securities, Department of Economic and Policy Analysis, Inquiries and Education Department, COSI Judicial Cell, and acting as a COSI Judicial Authority. He will be sharing with us insights from his experience. Their expertise and perspectives are sure to add significant depth to our understanding. Here, ladies and gentlemen, please join me in welcoming Mr. Pramod Rao, Executive Director, SEBI, as he takes on stage to deliver his keynote address. Can we have a big round of applause, please?
Good morning to all of you. I'm delighted to be here at what I just learned during Mr. Rajkiran Rai's address, that this is the inaugural conclave. So indeed, delighted to be here. Shri Rajeshwar Rao, Mr. Kamath, Mr. Rajkiran Rai, dignitaries of the dais, in the audience, media. I wanted to take the opportunity of building on what you've heard probably, from the inaugural address right through, the DFS secretary as well. And that's also because I want to talk about NaBFID's role in corporate bond development and so on. So I want to, keep emphasizing that our market is actually developed. We keep talking about developing the bond market. So I just want to sort of begin by saying that when the market issuances have crossed $100 billion in corporate bonds just in the last financial year, and it represents almost equal to about 60% plus of the corporate loan book of banks, I think, to say that it is still requiring development may be an understatement. So I wanted to begin with that one data point. But indeed, it is supported by a host of infrastructure built in the last few years that I'll touch upon. There is the electronic book building platform. It supports the private issuances of debt. Everything above 50 crores by a listed issuer enters this platform and is used by QIBs and other investors to participate. There is the request for quote platform, which again is operated by the market infrastructure, the exchanges, and that facilitates secondary market trading. The two additions made in the last 1 year have really been, one, the LPCC, or the Limited Purpose Clearing Corporation. This operates the corporate bond repo platform. Over the last 1 year in its operation, it's already crossed 1.4 lakh crores in transaction value. And to me, it's just the start because this is just the inaugural year of their operation as well. There is equally the establishment of the backstop facility by the government, which takes the form of Corporate Bond Development Market Fund, and that is supporting all of the debt mutual fund schemes. In short, there are several of these infrastructure initiatives around the corporate bond market where we've made remarkable strides. Yes, we will continue to require working on it. I think the Deputy Governor mentioned how NaBFID could play a market-making role. To me, that market-making can address the somewhat liquidity constraints that we see in the corporate bond market. But again, as a counterpoint, I will say that a large set of investors end up being hold-to-maturity investors. To expect that, there will be a liquidity just as much as equity, may be expecting too much unless we bring in new swaths of investors. And really, a lot of our efforts are going to be around that at SEBI. For instance, we issued a consultation paper last month, which is talking about introduction of liquidity window, which issuers can offer to retail investors. And to my mind, it can again facilitate where retail investors can come in with some level of confidence that when they desire that liquidity, the issuer indeed makes it available. Market making can be an excellent complement to such a liquidity window facility. There was also, the entire theme of green, which I think the Deputy Governor touched upon and which I also want to build on, which is really around that not only do we need infrastructure development in the country, I think what we need is green infrastructure development. Clearly, climate change is here to stay, and climate change risks are only going to exacerbate as we go along. To me, we introduced again a consultation paper last month, which is on expanding the sources of sustainable finance framework through the Indian securities market. It builds on 2 or 3 components, which is namely whether we can facilitate issuance of social bonds, sustainability linked bonds, linked to the international frameworks that already exist, may be duly adapted for Indian markets. So there are the ICMA green bond principles, social bond principles, and so on. And we'd like to be able to refer to those as we develop what we call the ESG debt securities. And to my mind, that can again complement what we have as green bonds, where just to sort of share, it also has blue bonds, yellow bonds, and transition bonds already. So we'd like to be able to complete the entire suite of products that corporate India can look at in the sustainable finance framework. This is accompanied by a proposal, if I can, to create what I would label as green securitization. Again, our consultation paper talks about creation of an instrument called Sustainable SDI, or Sustainable Securitized Debt Instrument. And the intention is to help the lending community, namely banks and NBFCs, which have actually assisted in green projects, that they could actually issue instruments which investors can then participate in and create a virtuous cycle of capital being available again for fresh green projects. This is again something which we hope will help create a green loan portfolio which the capital markets can then support. There is also a proposal in our consultation around independent external review, which I will come back to in a minute. I want to say that all of our sustainable finance framework builds on three components which we've already made operational from last year, namely the BRSR core, which builds on BRSR requirements itself of disclosure by corporates. This BRSR core is really about assurance being provided on certain disclosures made by corporates, which then feed into what ESG rating providers are required to look at, and similarly ESG debt schemes of mutual funds. This triple play of what we have done around BRSR core, to my mind, can again help refine what we think can assist corporate India in its transition. To me, I wanted to talk about a few things which are futuristic, but where indeed I think I've heard the previous speakers talk about. One is the investment institutions, such as insurers, pension funds, provident funds, including NPS or EPFO, probably need to have a green investment mandate as much as they have a mandate towards investing in corporate bonds. Maybe those mandates or requirements can be similar to the ESG debt schemes that SEBI has, so we don't have different formats of requirements which may confuse the issuers or the investors. To me, that itself will galvanize quite a lot of issuances as well as participation. We also need what I call green market infrastructure institutions. We look at market infrastructure institutions such as exchanges, depositories, and clearing corporations. But I think we need to now move to looking at what is it that is required to support the green ecosystem. And indeed, to my mind, NaBFID can play a catalyst role in those. So just by way of illustration, there are as many as 8 or 10 different reporting systems on green or sustainability reporting internationally. In India, as I said, we have the BRSR and BRSR core, but each of these reporting systems has some different nuance. What we need so that the issuers and investors and also the SME sector can sort of have one portal or one place where they can feed in all of this, and it generates reports in whichever reporting system that is required. It is not just about capital market reporting, if I can put it that way. For instance, Europe has this requirement that whatever are exported into Europe has to fulfill certain sustainability requirements which they mandate. For exporters, therefore, that kind of reporting system may be an additional cost if we don't actually create a single portal. To me, whether it's called a ESG data exchange or whether it's just a ESG data portal, but something like this is necessary for this country to invest in and create. We also require climate and transition fund assessment on an ongoing basis. I think we oftentimes fail to both understand how much is it that we need, both our old economy industries, but also what it requires to move both in energy and other terms, and what that funding gap is. I think, again, with the infrastructure database that NaBFID is developing, perhaps this assessment of the climate and funding gap for transition may be something else to be considered by NaBFID as well. I had said I will move to independent external reviewers. So each time that we have green bond issuances and so on, the investors look to some assurance providers which are today, as on date, outside the regulatory perimeter. Yet the role that they play is highly critical because what they assess is the use of proceeds. They look at what the KPIs which the issuers have committed to and so on. So again, one of the things which we are cognizant of is just as the auditing and the accounting function sort of gives assurance to investors, perhaps it's the right time to consider whether these external reviewers providing whether second-party opinion, whether providing third-party review, need to also come within the regulatory perimeter. Being at NaBFID organized event and having its senior leadership present, just as Secretary DFS and the Deputy Governor spoke, I will also add to certain things which I think NaBFID can consider and take forward. So one, and these are a couple of items which I will touch upon where we've already been in dialogue with NaBFID, but I thought it will be useful to recap some of it. Just as we have seen the growth of REITs and InvITs in the country, and just to put, again, numbers on the table, I think the assets under management exceed now 6.5 lakh crores between REITs and InvITs. And I keep comparing them to AIF world, which has maybe 1,200 entities, which has a total investment of 4 lakh crores. So in a very rapid, short period of time, REITs and InvITs with just 30 entities have really overtaken our entire alternative investment fund ecosystem. And this is just the start, because to my mind, we've barely scratched the surface. We've rarely done outreach programs like what a mutual fund industry does through its association, AMFI. But I digress. The way I look at it is a NaBFID with a catalyst role can probably go into sectors and to state entities or state governments where probably we have not yet seen even the first step towards harnessing InvITs. And indeed, to my mind, NaBFID by both creating an InvIT, aggregating assets which probably can assist the state government in recycling will be a really dramatic thing to do. The second, and which I think I heard the Deputy Governor touch upon as well, has been NaBFID has been a big advocate of introducing partial credit enhancement or partial guarantees. And to my mind, both for showcasing the potential investment opportunities, but also crowding in investors, this is a critical instrument. We look at it actually as a mechanism that can be used for municipal corporations and municipal debt security issuances. The structural features of municipal bonds which SEBI requires really has escrow of all of their cash flows, cash flow trapping mechanism, a debt service reserve account, and so on, and a merchant banker due diligence which makes sure that the latest financials are available of the municipality which is seeking to tap the markets. Yet many of them sort of get rated, maybe investment grade, but certainly not AA and above, where the investment institutions want to sort of come in at. And I think by NaBFID, providing credit enhancement to such municipalities will be able to ensure that we have far more investor interest which comes in. And as the investors become comfortable, this need not be perpetuated, it can actually start to fall away. Again, we have a long tail of municipalities. We have close to about 5,000 municipalities and urban local bodies. While 50 or 100 of them can probably stand on their own feet and make issuances, the long tail will probably require pooled finance structures, blended finance, and some of it we've been in conversation with multilateral banks as well. But to me, NaBFID again can provide a lot of support on that. The third item which I would urge NaBFID to consider is really to spur securitization of infrastructure lending book. This can again serve to release fresh capital to the lenders and create, which can then go on to create other infrastructure loan assets. Just as NHB with RBI is sort of creating a RMBS development company, to my mind, NaBFID can think of creating an infrastructure mortgage-backed securities development company. And we'd certainly be very happy at SEBI to support such securitization mechanism. We need to recognize that our country is indeed on the move, and dreams and aspirations will need green fuel, green infrastructure, as I talked about, and all of it really, both at the outcome of this conclave and what NaBFID does, should be to support Atmanirbhar Bharat, Viksit Bharat. Thank you again.
Thank you. Thank you so much, Mr. Pramod Rao, for that compelling and insightful keynote address. I'm sure, as he mentioned, a lot of us have to come together to really build and strengthen Viksit Bharat, and how NaBFID can be a support to all of us. Thank you so much, sir. Ladies and gentlemen, with that, I would like to thank each of our keynote speakers and special guests. Ladies and gentlemen, give a big round of applause to Mr. Rajeshwar Rao for his invaluable insights into the role of finance and infrastructure development. Thank you so much, sir. Also, Mr. Pramod Rao, one more time, a big round of applause to him for sharing his expert perspective on financial markets. And of course, we had Mr. M. Nagaraju online with us for shedding light on the crucial role of financial services in shaping our infrastructure framework. So thank you once again to our inaugural speakers. Thank you very much. As you see, the stage is being set for our next session, which is a fireside chat. We are thrilled to transition into an engaging fireside chat that promises to be both insightful and stimulating. Give us a moment to just set the stage up for this fireside chat. Thank you, team. Joining us for this conversation are two renowned figures whose experience and wisdom have profoundly impacted us. We are honored to welcome Mr. Tamal Bandyopadhyay, consulting editor at Business Standard. Widely known for his weekly column Bankers Trust, Tamal Bandyopadhyay is an award-winning author and journalist. Currently, he's a consulting editor of Business Standard and senior advisor at Jana Small Finance Bank. Starting his career as a trainee journalist with the Times of India, Tamal has worked with the Economic Times, the Financial Express, and Mint besides Business Standard. A very warm welcome. With him, we also have with us Mr. K.V. Kamath, Chairman NaBFID. Shri K.V. Kamath, Chairman of National Bank for Financing, Infrastructure and Development, is an Indian banker having started his career in 1971 at ICICI. In 1988, he moved to the Asian Development Bank and spent several years in the Southeast Asia before returning to the ICICI as its Managing Director and CEO in 1996. Under his leadership, the ICICI transformed itself into a diverse, technology-driven financial services group across banking, insurance, and asset management in India, and also created a global presence. He retired as Managing Director and CEO in 2009 and continued as the Chairman of ICICI Bank till 2015. And in 2015, he was appointed as the first president of the new development bank set up by the BRICS countries, from where he retired in 2020. He is currently also the chairman of Geo Financial Services Limited. Shri K.V. Kamath was also awarded Padma Bhushan, one of India's highest civilian honors in 2008. Ladies and gentlemen, let's give a huge round of applause to both the gentlemen on stage, and a very warm welcome, Mr. Bandyopadhyay and Mr. Kamath.
Thank you. Yeah. We are running late, but should we stick to the time, half an hour? Is that okay, or? Yeah? So, very good morning, and Mr. Kamath, welcome. I mean, you wear so many hats. At some point, we used to call you the retail guru of Indian banking. And now we are talking about infrastructure sector. Raj Kiran Saab I think he has gone to see off RBI Deputy Governor. People call him Raj Kapoor of the industry now, because in the way he sold the NaBFID story and India story, I mean, if the elections were around, you would have thought that there is somebody talking and a political person. So anyway, get back to that. He has set the context and he has said that we should discuss and debate. So Mr. Kamath, the next half an hour we'll just discuss and debate. And I'll pick up some of the stuff what Rajkiran Sahab had said. Now, first is what I found from his, and he was again and again mentioning that he's not challenging Reserve Bank of India. His research is something anecdotal, etc., etc. But the point he was making is this infrastructure is now far more safer assets for the lenders, which was not the case 10 years back in mid-2000, in the mid-last century. Bankers were staying away for any infrastructure project like plague. We will not burn our fingers kind of thing. Many things have happened. Insolvency Act has happened. Environmental clearance, land acquisition, all those roadblocks now. Actually, even before the project takes off, all these things happen now. So the ground has changed. And then investor REIT, SEBI executive director is talking about, they created a lot of hygiene factors. And NaBFID study said that from 8.5% in FY16, it has come down to 1.1% average NPA and all. So tell me, sir, is this like everything is hunky-dory? This is the best time for infrastructure sector? Last year you spoke about Indian banking system is now in a kind of pink of health, which is never seen in the past 50 years. Now, is this something true about infrastructure sector also? Or if not, what needs to be done?
Thank you, Tamal. I'll upfront say it is true, but then put it into context. See, the challenges of 2016 or leading to 2016 were observed in a phrase which everybody talked about in 2014, the stranded projects. You remember that phrase, projects which we did not see next, I would say, dawn as it were. And these were primarily infrastructure projects. So when you look at that mass of stranded projects, and they then having to work out, that time you could see the NPA ratio or the projects in trouble, that number was very high. And indeed, those projects have been resolved. And those projects have been resolved. And the steps that you just now mentioned, which Rajkiran put up on the screen, have been taken. So consequent to that, you had clean balance sheets, both at the corporate end and at the borrower end. The borrower end, I'll make only one point. 2020, when COVID hit, the Reserve Bank constituted the expert committee, of which I was a member. Mr. Manoharan was a member. And we estimated that about 8 lakh to 8.5 lakh crores of assets will need to be restructured. That was our job. That was a committee to look at restructuring needs.
You are not a member, you are chairing this.
Okay,
right?
I was a member. I was a chair with my colleagues.
Yeah?
Yeah, the point is that 8.5 lakh crores, which of course majority of those assets would have been infrastructure in our mind. What do you think we ended up, our mandate for 1 year, end of 1 year, the actual number done was about 40,000 or 45,000 crores. Less than 10%, just about 5% or so was what was done. So clearly things had changed at a much faster pace than we had reckoned. And despite COVID, with an enabling environment that was provided by the Reserve Bank and the government, the companies had come out of trouble. So that endures. Nothing has happened after 2020, which has changed that equation. That is why this is what you're seeing is real.
So good run will continue. Good run will continue. You don't see any challenges.
At this point, unless there is rash behavior again, it won't happen. And rash behavior again is a function of whether banks are able to control that behavior or not. Now banks are able to control that behavior. If you look at credit appraisal standards now, and look at it 20 years back, I don't want to look at it 10, 15 years back, but 20, 25 years back, it's a completely different set of, the way we look at project appraisal today.
Mr. Kamath, that's one side of the story. The asset side, you are saying that it's far better. But on the other side, this how to support those assets. I mean, where would the money come from? Again, I'll pick up from what Rajkiran's presentation was there, that between insurance and pension segment, we
I think
75 plus 40, 115 trillion. but they're not that excited. You know, in like, for instance, insurance need to invest 15% of their total AUM in infrastructure and housing, but they've done 9.5%.
It'll happen as we go along, and I'll explain why. I think Mr. Rao quoted some numbers which are very important. These are numbers which are built up. For example, the INVIT number that was indicated. The bond issuance is now
6.5 trillion.
And the bond issuance is now, the size of the bond issuance is now. These are all, I would say, a reflection of a market which is evolving very fast. So those, the funding is available. The people who are putting up that money are comfortable with the asset that they are acquiring. And the companies that we are ultimately borrowing through a bond route or through the INVIT structure are much stronger than what they were 5 years back. So this is a confidence building situation. We are up that confidence building cycle. Started slowly, but we are getting up pace. And I think that will work to the good. So another point, Kamal, which we need to factor in, and has not been, has not still come out very clearly, and that is important support that the government gives through the budget, 11 lakh crores, because that becomes the momentum provider. Now, imagine the situation at today with, say, NHAI being able to create INVITs. NHAI really does not need to go to the government now for support. They will just say another piece of a road project or several road projects which are mature and in a profit stage, transfer to the INVIT. They get their funding, and that provides them the next investment path for the next project. So they can, in a way, get off budgetary support. I see over the next 5 years several industries which the government has supported in the past being able to get off budgetary support, and which will mean that the overall pie will increase tremendously. The government can then support what really needs support, and where, say, for example, railways, I would think putting into an INVIT structure is probably not feasible and probably not wise. It's probably best through the government support. So there will be projects which will be, which will have to go through the government support, and as we grow and become a larger size, that size of investment will increase, and those who can stand on their own feet will find their own path through the market process. And that path, again, people are comfortable, the insurance companies, the pension companies, whoever is putting money there is comfortable, the borrower understands that process, and there's a regulator which is laid down the playing conditions very clearly, and is continuing to engage with all parties to understand what is it that could be done to improve the playing conditions.
Mr. Kamath, talking about the government support, again I'm picking up from Raj Kiran's study and whatever is put about that. So infra spends about 5% of GDP roughly, and 80% of that comes from the government at this point of time and all. Now, if we are looking for, I don't want to repeat the same thing, India becoming the third largest economy, fourth largest economy, and this is the size of the economy, and we need 8% growth, etc., etc. I mean, we need to spend more on infrastructure. Now, just I want to understand, at this point of time, as I said, that yes, INBITs and REITs, etc. happening, corporate bond market is happening, but still is not sufficient. Our own insurance guys are not that, excited about it, and we have to depend on Canadian pension funds for the money, etc. Banks are still they run the risk of asset liability mismatches if they take the plunge, and the new RBI, Mr. Rao has gone, but the LCR norms are coming up, etc. So in all this kind of scenario, what is is it a process, or you have some suggestions on that money flow side? What else need to be done?
I'll explain why the mindset. You described a mindset, people are not keen. See, from a situation where there were challenges, people are just about 6-7 years away. And during that intermediate, we have gone through a COVID cycle where 3-4 years nothing happened. So people have to get their comfort levels up. That's not just the insurance companies, and the regulators have to get comfortable. And I would think that the share, I think the number that you quoted is going to be used up very quickly at the pace that Pramod indicated. The market is today absorbing instruments, and the issuers are coming forward. And I still want, you still have one question which needs answering. You raised a question which needs answering. That is, much more needs to be done as we grow. I put it as a virtuous cycle. We cannot look at it as an economy of $4 trillion. I look at it as an economy of $8 trillion on a path to that economy. And on that path to that economy, surpluses are getting thrown up. And those are going to get invested. And again, government stake in investment will continue, but it will go for only those areas where there is a need for government money. The rest of it will go through the InvIT market. They'll stand on their own feet. So this will also be a virtuous cycle.
Okay, sir, from the macro issues, let's get into NaBFID, which is, as I said, till some time back, you used to wear the hat of the retail king. Now you are the infrastructure financing king. You are the chairman of NaBFID and all. I was going through the numbers. It's raised about 28,427 crore, 10 to 20-year maturity money and all. So do you see that NaBFID is actually on the liability side, meaning creating the real market, which will be helpful, or whatever you call it, the panacea for Indian infrastructure finance? Between him and this gentleman, as I said, who people call Raj Kapoor of financial sector, is it?
Again, I go back to what Mr. Rao mentioned. There is already, I would think, a cycle that has started with the people directly accessing the market. I think NaBFID becomes a facilitator in this, and that starts the process of a new window to people who want to borrow. And again, our appetite is going to be significantly more. I would like Raj Kiran to speak about it. I'm sure we'll speak about it.
Yes, spoken enough, sir. There's so much of oratory he did.
We have, the book, the approval book is now what, 1.5 lakh crores. And he has very ambitious numbers for the, at least that number is what he wants to emulate in the immediate future. And our capital is 25,000 crores, and we have raised 28,000 crores. So you can imagine how much appetite we have to come to the capital market. So NaBFID has enormous appetite to come to the capital market, and that itself will spur activity in the market. That will raise confidence in the market. And the regulators will see it in the right perspective. And again, that gets the cycle kicking.
Coming back to NaBFID again, and the background is this, before NaBFID, most of the experiment by the government for infrastructure financing have failed. I don't want to name, but nothing happened. Either one entity just had to be converted into bank because it got messed up, the entire thing. Another entity, it's not growing anywhere and all. Now NaBFID, in a very quick time, it's now the loan book is 1.2 trillion. Correct me if I'm wrong, Rajkin sir. And its liabilities are on the longer side. It can afford long 10-year loan because its liabilities are on longer and all. It can afford to have, say, interest rate reset between 3 and 5 years, not this thing. Even it can happen a fixed rate loan. Sure. It can afford to give and all. So do you think that NaBFID actually will be meaning between you and this gentleman sitting there, you will create history? I mean, the way China thing happened in the infrastructure thing, in the 5 years down the line, we'll see that there's a new India on the infrastructure says, thanks to NaBFID. I mean, not only on its own, but through all these things, it can support others as well.
Let me put it in context. China is a good case study. So we should understand what went right and what...
Because China had been your model all along. As a banker, you always spoke about China.
What went right and what went wrong. I think we should pick what went right and look at it. So but that's not really the focus. I think there's enough to do in India on our own. And you have mentioned, in this, the pace we want to grow as a nation, everybody has a role to play. The commercial banks have a role to play, so we shouldn't forget that as a major driver. And they are mobilizing huge amounts of money, and they will deploy this money as you go along. What I see in the corporate side is the banking sector is also going through, this is my view, there are eminent bankers here, has to go through a metamorphosis. The metamorphosis is that you go circa 2000, basically commercial banks were lending working capital. Before that, the project finance came from the 3 development banks, which today don't exist as development banks anymore. So then it evolved into, slowly, project finance also was being done by commercial banks. Then came retail. And now you have a situation where a large part of the customer base of a corporate, of a bank, corporates, are self-sufficient. They are throwing up enough cash to finance themselves. And they have understood to use leverage very effectively, not 3:1, 4:1 as we dealt with 20, 25 years ago. Today they are dealing with the leverage, which is probably the top 500 companies hardly have any borrowings. The others have reasonable amounts of borrowings. So the market characteristics for bank money is also changing. So mid-caps, agriculture, retail, this is now coming on. And then as you go along, some of these will. So they will have an appetite to fund infrastructure. But they would need to very carefully look at what maturity are we looking at. Because average profile of a bank loan, if you look at the entire corpus, is about a year, a little over a year. Can you really look at giving 8-year money or 10-year money using 1-year money? You're carrying a risk which no banker would honestly want to take. But within that, shorter tenor, there is certainly a scope. So NaBFID will have to play along with the commercial banks. It has to be a holistic approach to provide funding, where each one provides the maturity range that you are comfortable with. So if that is so, then NaBFID has to be at the long end. And NaBFID has to be at the long end. And when the customer says, I want fixed rate, NaBFID can borrow fixed rate in the market and lend the customer fixed rate. Because at the other end, there is a provider who wants also long-term fixed sort of flow, who could be a pension fund, an insurance company, and so on. So we are talking of harmony, and in a holistic manner, this provides to progress.
But in private, if you ask any banker, they would love to have only retail, retail, retail. You see the structural shift in Bank of India chairman is sitting here, so is it, they would love to just only go for retail, even 100%.
Indeed,
No?
indeed, but
Huh?
every product has its own risk connotations. So we'll need to understand that risk as you go along.
Okay, sir, flashback to 2015 May. You were the first chairman of New Development Bank for the BRICS countries, and that is also primarily for infrastructure and sustainable development. And to a large extent, NaBFID also the same thing, infrastructure and sustainable development. I'm not getting to the multicolor bonds and all. So, but from your experience, and 5 years you were there, between May 2015 and May 2020, you set up this bank, right, for the BRICS countries, for infrastructure financing and sustainable development. So what are the few key messages that you want to give NaBFID executives as well as entire crowd from the infrastructure sector? How do we proceed?
Yeah, I think when we looked at our 5 countries, because that's where the focus was, there clearly is a need for infrastructure. In all the 5 countries, even in those countries where we think infrastructure is fully there, there is need for infrastructure. That was one. And B, the lesson is infrastructure is best done with the longer tenor and longer funded fixed rate funding. That's the structure that you can have blends of other things, but primarily long dated and longer. See, the most important lesson that we got is that we were 5 countries which one had an A- rating, and all other, India had an investment grade rating, triple B minus. The other 3 were sub-investment rating. But when we came together, and after a year, we could demonstrate our balance sheet, capital had come in, all the policies were put in place, governance, risk management, everything was in place. We got a AA plus rating, which meant that our borrowing cost was only 10 basis points, maybe 15 basis points costlier than World Bank, which by running a very lean people structure and a very high technology structure, you could easily overcome that and you are competitive. So sum and substance is that we, countries of the South, can stand on our own feet if we come through collectively and present a workable case to the market. And we can fund ourselves. We don't need to rely 100% on the Western world to fund ourselves. So that, to me, was my biggest learning from having set up BRICS.
Thank you, Mr. Kamath. So from macro to micro NaBFID and the learnings from setting up the BRICS Bank. I have just 2 more things, and I wish the regulators were here, both both Reserve Bank of India and SEBI. It's about them, how do you, because I'm encouraged to ask you because for everybody, Mr. Kamath is one, typically what happened for this kind of, even for panel discussion, everybody who's look for, or most of them look for some question paper leaking, what are the talking points and all. But Mr. Kamath is just nothing he wants to, even here I came and he said, sir, anything you want to, anything, he said, no, nothing, just whatever you want you can ask. So on that basis, I am taking the liberty of asking you two questions. One is this, the claim by SEBI that, why are you saying that bond market, corporate bond market is developing? We have developed. So is this the right statement?
No, I think he put that in perspective. The feeling
don't be diplomatic now. I mean,
no, I'm honest. The number that he indicated is signs of maturity in the market.
Okay.
See, it is a combination of 2-3 things. You got the regulator. You got the people who are actually wanting to put money or not wanting to put money into a bond. That is subscribed to that bond. And there's the issuer of bonds. So there are 3 parties here, and the exchange then comes in and facilitates that process. So there is a learning curve for each party to understand the other. And of course, there's several regulators, not only SEBI, there's an insurance regulator and pensions regulator. So it was a case of everybody coming up the learning curve, and I think I myself was surprised at the size of the market that he indicated.
Correct.
With that size of the market, yes, we are going up the learning curve fast. Does that mean there is nothing to be done? I think Mr. Rao himself articulated what more needs to be done, and market participants could do it. Whether it is securitization, whether it is trading, and so on and so forth. Though he caveated it by saying probably most people will want to hold the asset long term. But it's going to be a very interesting marketplace. For example, government bonds are traded, but there is an active market, there are various maturities. That's what will happen in this marketplace also. There will be very long end, there will be shorter ends, and at an appropriate end of the market, trading will happen.
Okay, I wish Deputy Governor Mr. Rao were here. I just want to ask you, which is the created in the quite a, I would say, storm in the space of infrastructure financing. That May Reserve Bank of India draft guidelines, released in May, on the project loan financing. You say that quite a few interesting things are there. A lot of things for better risk management, credit appraisal, so on and so forth. But one thing which has been in the eye of the storm, and RBI has not come back on this, is that the provision requirement is gone up 12 times from projects in the making, from 0.4% to 5% during the construction period. Now, once the operational phase starts, it comes down to 5% to 2.5%, and then of course when the cash flow starts per projects, it's become 1%. But this key thing is from 12 times from 0.4% to 5% during the construction phase. Okay, now just quickly, and it of course is laid down the roadmap, laid down meaning it's again still in the draft stage, not yet the thing. 5% in phases, 2% by March 2025, 3.5% by March 2026, and 5% by March 2027. Now, the various kind of analysis, etc. happened. I think NaBFID itself has done some analysis, but roughly it will raise the cost of financing between 0.5 and 0.7%, little less the thing. Now, this project finance, it's a big blow to project financing. That's the market perceives. Bankers in private say RBI should go back to the drawing board and calculate and do something about it. RBI is keeping quiet. Probably the work is on and will come back. So given a choice, sir, what would you, suppose you are not a chairman, but a member of a committee looking into this, because you refuse to be, call yourself a chairman. So there's a committee created and you are a member. What would be your impact?
I think we will need to understand what are the amber flags that Reserve Bank is seeing. I think what they're saying is this is a growing economy. And with a history just a few years back of credit losses running to numbers which are very uncomfortable. So you build up a cushion as you go along. And I think what I'm sure industry will engage is how do you build that cushion? There are very many ways of doing it. Basically they're saying is you keep aside certain things. So how do we keep aside is something that I think industry will engage with as we go along. And I just want to, in a regulatory context, in a provisioning context, this is just the start of things. We will have to be prepared for what the West is now doing. It's basically expected credit losses. That will cause, this is nothing compared to what that will cause. So I think they are basically telling you, go to the gym, work out a little bit, get stronger, because looking at the global context, we will have to move towards that direction. So basically they're toning us up. So we'll have to look at it as a toning exercise.
So you don't see it very high?
No, I think they will calibrate it as we go along.
And
there are ways in which they could look at it also.
Okay. So sir, I think we got the message. So Mr. Kamath does not think that is very high. That's the way we should approach infrastructure financing. So it's a wonderful thing, sir. Even if you give me permission to ask anything, I'll not ask about plan of Geo, because that's not in the infrastructure space. Okay, I would have loved to, but that's not for some other time.
I always say that Tamal is a very naughty interviewer. I'll tell you a story. He did when I just came back, and he said brunch with or lunch with Tamal. So I had the lunch with him. So I thought I did well, and then next day or day after, when I read the thing, it is only about my munching on chilies, and he has counted how many chilies I have had, and he says it's 10 chilies that I went through during lunch. So of course my stomach is now all gone, so it can't stand even half a chili now.
So, but you have given enough spice, enough masala, but to cut a long story short, I will not take time. So what Mr. Kamath says is this: things are pretty good, things are happening, things are in the making. It's not that we have reached there, but it's a long way to go, but everything, the brick by brick, it's being built. And as far as the RBI norm is concerned, unlike many others who were sitting here, unlike many other lenders, Mr. Kamath does not find RBI is too harsh or too strict. I mean, we need to go for better risk management, better credit underwriting. As he said that to you, all the financial sector guys who are into project financing, let them go to gym and build their muscle and come back. This is a good time for that. With that note, sir, and more green chilies to your panel.
Thank you, Ramal.
Thank you, sir.
Thank you so much, Mr. K.V. Kamath and Mr. Tamal Bandyopadhyay, for that insightful and engaging fireside chat. Your candid conversation and expertise have given us a lot to think about and added tremendous value to today's discussions. Thank you so much. Ladies and gentlemen, with that, before we dive into our next sessions, we are taking a short tea break. We invite you all to enjoy a refreshing tea and network with your peers, with fellow attendees. We'll reconvene in 15 minutes for our panel discussions, requesting all of you to please join us back in 15 minutes. Thank you so much. Thank you. Check, test, mic testing. A very good morning, ladies and gentlemen, and welcome back after the break. Requesting everyone to kindly take a seat. All those who are still in the pre-function area, request you to please join us in the hall and take a seat as we are ready to reconvene the conclave. We have a very interesting panel discussion coming up. Requesting each of you to please join us in the hall and take a seat. Thank you. I request Mr. Tamal Bandyopadhyay to please join us on stage. We'd like to thank Mr. Tamal Bandyopadhyay for moderating the Fireside chat. Thank you so much, sir. Delighted by your presence and your contribution to the conclave. Thank you so much. Once again, requesting all our guests to please join us in the hall. Everyone in the pre-function area, requested to please join us in the hall and take a seat as we are ready to reconvene the conclave, requesting your presence. Check, test, test. Welcome back, everyone. May I request everyone in the room to please take a seat. As we are excited to dive back into our program with a series of stimulating panel discussions, our experts are ready to share their insights and engage in dynamic conversations, for which I request everybody to please settle down, take a seat. Sirs, ma'am, may I request you to please take a seat? All right, ladies and gentlemen, now it's time for our first panel discussion of the day, and we have an exciting topic ahead: infrastructure as a growth enabler, Viksit Bharat 2047. To moderate this engaging discussion, we have with us Mr. Ashish Garg, who is the leader of People and Organization Practice in Asia Pacific and a core member of the Financial Institutions and Public Sector Practices. Ladies and gentlemen, can we welcome Mr. Ashish Garg on stage? A very warm welcome to you. On his request, I have cut short his bio, but his luminous career everyone is aware of. Very warm welcome, sir. And now I'm delighted to welcome our esteemed panelists who will share their expertise and insights into this very important subject. Please join me in welcoming Mr. Ashwini Kumar Tiwari, who is a career banker, started his career in SBI in the year 1991 as a probationary officer and has spent more than 3 decades with the bank in India and abroad in various assignments. Presently, since November 2023, is the Managing Director, Corporate and Banking Subsidiaries of State Bank of India and a whole-time director handling the portfolio of large corporate and commercial credit business of the bank along with associates and subsidiaries of the bank. Ladies and gentlemen, Mr. Ashwini Kumar Tiwari, let's give him a warm welcome. On the panel, we are also joined by Mr. Manoj Muttathil Ayappan, who holds a master's degree in business administration, has done BSc from Mahatma Gandhi University, Kottayam, Kerala. Presently, he is posted as Joint Secretary in the Department of Financial Services, Ministry of Finance, Government of India, New Delhi. Ladies and gentlemen, a big round of applause. A very warm welcome to you, sir. On the panel, we are also joined by Mr. Rajendra Kumar, who is the Member Finance of National Highways Authorities of India. He joined NHAI board in January 2022 and handles financial planning, budgeting, market borrowings, accounting, audit and compliance, financial management and control, NHAI International Investment Promotional Cell and asset monetization as well. A very warm welcome to you, sir. Ladies and gentlemen, for Mr. Rajendra Kumar, let's give him a warm welcome. We're also joined by Mr. Rajiv Gupta, who founded Arpwood Financial Group in 2012, comprising an MA&N investment bank, Arpwood Capital Limited, a mid-market PE buyouts firm. Ladies and gentlemen, please join me and welcome Mr. Rajiv Gupta. A very warm welcome to you, sir. And last but not the least, on the panel, we are joined by Mr. Samuel J. Jebaraju, who's joined the board of National Bank for Financing Infrastructure and Development as Deputy Managing Director, Lending and Project Finance in April 2023. He has over 31 years of experience. Ladies and gentlemen, for Mr. Samuel Jebaraju, a very warm welcome. And of course, I leave the stage over to you, sir.
Thank you, Ms. Welcome to this session. This is indeed a privilege to moderate a panel with such distinguished guests and who bring such different capabilities important for infrastructure development, especially when we think in the context of Viksit Bharat 2047. We have heard actually a lot of interesting pointers from distinguished guests since morning, and actually I'm going to just present some of them probably a bit visually, probably with some more factoids to anchor the presentation, but we'll go along and start to drill on some of the themes that came up. The nature of the panel is such that we will keep it very interactive, so don't be surprised if actually I ask a question to you rather than the panel here. Let's get going. I'll present a few pointers and we get started immediately from that point onwards. Can we have the presentation, please? Lovely. So look, we have heard these numbers, but I think it is just useful to set them in context. We are talking of a $30 trillion economy. We heard Secretary DFS speak about how fast the trillions are coming by. So if we were to think about from 3.5 or 4 trillion all the way to 30 trillion in the next 23, 24 years, we are looking at adding $1 trillion a year. And actually, that's not true representative because this number will keep exponentially going up. So that's the kind of pace we are looking at. The GDP, of course, looks very impressive. From about $2,500 per capita, we are going to go to $18,000. And if you de-average that between urban and rural, in urban India, we are looking at $40,000 per capita, which starts to then put us in league of European countries of today. And you can't see at the bottom, but if you were to translate that into what it means for infrastructure, we are looking at least 3 cities which will have a GDP of over $1 trillion. Again, a number was spoken about, I think, by Secretary saying 70% of India's GDP will come from the urban centers. Mumbai's GDP today is 250 billion, roughly. Take 10 billion here and there. So we are looking at 3 cities which will be more than 4 the size of Mumbai in the next 20 years. That's the kind of excitement we have ahead of us. Can somebody help me, please? This doesn't work. Okay, it's changing now. But you know, it's not just at the national level which is of such interest. At the end of the day, even Honorable PM says, ultimately the states have to develop. In fact, now we are speaking about developing every city, developing every village. So Viksit Bharat, Viksit Gaon, Viksit Bharat, Viksit State, so on and so forth. And if you look at it, that's where really the action is in the states. And it's just not one state, but state after state, there is a very rich list of infrastructure development that states are speaking about. This, for example, is from the Vibrant Gujarat Summit of this year, where they speak about Viksit Gujarat 2047. And just look at the kind of things they are speaking about. They are speaking about 3 new cities being built, greenfield cities being built. There is a growth hub that is being spoken about in Surat. We are speaking about of course we know it. Hopefully we will have the terminal station very soon here, which is the high-speed rail connection. But we are speaking about 11 greenfield airports. We are speaking of 1 megaport. So the amount and the conversations that are happening around infrastructure development in every state is actually a bit tingling. It's a bit heady for us. And it is just not big states and the states which are known like Gujarat, but if somebody can help me move a slide forward, but even states like Chhattisgarh, can somebody help? Even states like Chhattisgarh which are starting to speak about a lot of development. So this is, for example, the conversation around industrial corridors. Now, even a state like Chhattisgarh, which is probably, you know, when you think about Gujarat, one would think about a lot of development. Chhattisgarh probably coming up the curve. We are speaking about 15 industrial plug-and-play industrial parks in Chhattisgarh itself. The number itself is not interesting, but I think what is interesting is on the left-hand side. These are going to be integrated developments. So it's just not about creating a land parcel and developing connectivity. We need to have everything in there to really make this infrastructure pay. And the approximate cost, at least that we have picked up, seems to be in the range of about 2,500 crore rupees per industrial park. So wherever you touch in India today, whatever part of India you touch today, there is development, there is industrial development, there is infrastructure development, and therefore I think opportunities for all of us. Okay, so why are we here? Well, we are here because while many things are going very well, but I think we still need to do many things. So there is no doubt in the last few years, things have really, really progressed well, and I need not repeat the points which have been spoken about, whether you look at the capex in the budget, whether you look at how the increase in the national highway development is happening, is just tremendous. But if you step back, there are 2 questions that come to our mind. One is all of this requires massive investment in the next few years itself. Some of the estimates suggest $1.5 trillion of investment requirement. Where is this money? 2, as this infrastructure comes up, and I live in Gurgaon, and some of you who may be following the news, the moment some rainfall happens in Gurgaon, is our quality of infrastructure really up to the mark? Today, even if you look at the road development, which is probably one of the best ones in India, the mean score of road development in India is just about 58 versus the score of 107 for US. If you just look at the quality of the roads is again, and I'm just picking up roads, but that's true for everything, whether you take ports, you take whatever, right? There is a huge room for improvement. So one question I would like to debate on this panel is, where will this money come from? And how do we make our assets future-proof? While I think the traditional infrastructure sectors especially in terms of transport, logistics, power. I think they still have a lot of understanding. They get financing. Things are really progressing well. But if you look at India, the new India from 2047 perspective, there is so much to be done on infrastructure. You think about industry and energy, industrial corridors, SEZs, multimodal logistic parks, renewable energy, pipelines. You look at the whole digital piece, the amount of data centers that India is putting up is massive, and they will require green energy. A lot of them will require green energy. You look at social infrastructure, the cities being built, the metros being built, the commercial real estate, tourism being spoken about. There is every sector, every piece requires attention and effort. Which then leads me to the second set of questions, that while we have, again, we are starting to cater to some of them. About 1,000 megawatts of data center has been set up. Another 1,000 megawatts is in the pipeline. We have a very, very ambitious goal of 600 gigawatts of renewable energy. We are speaking of some 50,000 crore rupees from 35 multimodal logistic parks. Do we really have the capabilities, and more importantly, capacities, to deliver this? Today, if you look at all our grade 1 developers, players, their order books are all choked up. In fact, they're refusing to take orders just because they can't deliver anymore. So we cannot wait for something to finish to start with something new. One question we will explore in our panel is which sectors really need the most support, which sectors we find most exciting, and are we doing enough as a nation to build capabilities and capacities? I think we have spoken a lot about the banks, so I'm going to skip that one. And I think a final point that I'm going to explore is a little bit on, I think again, everyone spoke about it. I think Gati Shakti has been just fundamentally a game changer, bringing 16 ministries together. 200 GIS layers are kind of available for both ongoing and upcoming projects. But still, with all the data available, we still have challenges on risk assessment and risk management. We still find a lot of issues in the data available, in our ability to really use the new technology for infrastructure financing. So we'll again explore how do we think about using technology. We are speaking about Gen AI these days. We are speaking about data availability so easily, drone policies in place. How do we really think about using technology and data to empower our industry? With that, we'll get into our panel, and we have 4 questions or 4 big themes that we are going to speak about: pace, quality, and longevity of infrastructure, emerging infrastructure segments for New India, adequacy and innovative funding, and then building capacities and capabilities. But before I go to my esteemed panel, I want to go to the audience. Can I have a raise of hand? And if you can pick one, what is your most important pick of these 4? Pace, quality, and longevity. Raise of hands. Okay, I would say about 10% of the hands went up. Emerging infrastructure space. Okay, not many, maybe 5%. Adequacy and innovative financing. Okay, that's like 60-70%. So Mr. Tiwari, be ready. And then building capacity and capabilities, including data and technology. So that's another 20%. Maybe the first 2 are also important, but probably the audience was just getting warmed up to what is coming up. So all 4 are important, but we got a clear hint that adequacy and innovative financing becomes important. So with that, let me ask you, Mr. Ayappan, JS, DFS, the money requirement is huge, and the challenge continues to remain on patient financing. NaBFID itself is a result of that policy thinking, And we have heard some great inputs in the last 2-3 years itself how NaBFID has moved forward. Do you think we have enough instrumentalities right now to fund India's infrastructure?
Yeah, thank you, Ashish, and good afternoon to everyone. So basically, I mean, the tone of the question, the session has been said. What is the most important thing? The audience feels that it is financing. So yes, the infrastructure is very, very important because of its multiplier effect. We have understood in the initial discussion. Now, from a government perspective, the spending has been huge in the last 3-4 years, especially. 3.4% of GDP, 11 lakh crore in the current budget, yes. But again, if we look at it going forward, as we discussed in the inaugural session, the capital which is waiting to come in actually should start flowing. That's one of the important things which we see, because government funding, government will continue, but as the pie keeps on increasing, the private capital which is to come to the infrastructure funding should start flowing. And I think NaBFID is one of the major steps which has been taken by the government in facilitating that. NaBFID has been given an AFI status, which will help them to raise long-term capital, long-term funds, and fund long-term projects. So the general issue of asset liability mismatch, which the normal commercial banks face to a large extent, can be addressed by NaBFID. A lot of concessions are available for NaBFID. Also, as we say, NaBFID also has this developmental activity. So by developmental activity, they should be able to develop the financing markets. So I think a good start has been made. There are a lot of funds which are waiting to come in. We need to probably improve the ecosystem a bit more and have a good channelizing of those funds, like we discussed about insurance and pension long-term funds. So they should come in. So I think as a facilitator, things are happening. Now it is for the capital to start flowing, and I'm sure with the positive trends in infrastructure sector, in terms of growth and in terms of asset quality, and in terms of longevity, which we are seeing in the new assets which are getting created, I feel that financing is going to be a good space in the near future.
Well, thank you. So, I completely concur. I think NaBFID has been just not only from the overall mandate, but I think the way it has been set up, I think kudos to the government, and I think the way NaBFID has really picked up that baton and actually delivered in some ways a new kind of organization. And we are really looking forward to, the financing growing by leaps and bounds. Let me move to you, Mr. Kumar. I think the velocity of investment has significantly improved, and no better than NHI to kind of really speak a lot about it. I mean, numbers are staggering, 11.1 lakh crores in FY25. My questions are twofold. One is, does India has a capacity to absorb, to create this kind of money flowing in and deliver the infrastructure that the country needs? And two, even when the infrastructure is built, are we really building this infrastructure for a multi-decadal growth? What's your perspective as you look at?
Good morning, Ashish ji. Can we absorb additional capital? Absolutely. See, government is doing the heavy lifting now. Most of the investments into infrastructure are public investments. More than 80%, I can say for roads, more than 80% of our investment is funded by the government. If you see the budgetary allocations to Ministry of Road Transport and Highways and NHI, they have grown by leaps and bounds. And we can see what is happening on ground. There is a significant addition to our infrastructure and the road network. However, as we all know, our aspirations, our requirements, to propel ourselves to what we aspire to be, we require a lot of investment. We have the capability to deliver on the construction, management and maintenance of the infrastructure. But For financing, we have to sacrifice somewhere. When government is coming in and putting money into infrastructure, it is also allocating, there's a limited pool available to the government based on its own fiscal parameters. So definitely there is ample scope for private equity as well as the debt capital to flow into this sector. Obviously, means when we are trying to attract capital, we should have the environment that supports, and we should also build in confidence to whoever, the investors as well as the lenders, that the environment is safe and the risks are manageable. So if you see the road sector, what we have gone through over a period of time in the BOT, and it's in the, from 2008 to 2014, where the road sector itself faced some headwinds. We should also look at how the government has responded. We have gone back to the drawing board. We have created concession structures, the institutional mechanisms to look after all these risks. Government has again, through the HAM contracts, has taken over again heavy lifting, assuring the lenders. So, and from there again, now we go back and we are trying to again revitalize the build, operate, transfer through a new concession agreement, which we have designed with all the stakeholders being part of the consultative process. So definitely there is a scope for absorption of more capital into the infrastructure sector. The second point is that, yes, longevity, yes, we design. Sometimes there's a scope for improvement, as we can see in Gurgaon, obviously. But what are we going to do with it? It's not that we are turning a blind eye towards this. Government is continuously engaged in improving the quality of infrastructure. Gati Shakti is a living example of what we plan to do. I will share something that what we are also trying to do within NHAI. For the past 3-4 years, we have been trying very hard to improve the quality of the DPRs, the detailed project reports, even before start of the project itself. Gati Shakti is playing a major role in improving the quality of the DPRs. We created a dedicated DPR cell so that the DPR quality can be improved. The structures, they play a major role. Their quality is of paramount importance. So bridges, tunnels, and the associated structures. We are also creating dedicated quality assurance cells within NHAI to ensure that the design as well as the construction and management of these structures are also taken care of. We are also now entering into a performance-based maintenance contracts over a longer period of time, so that the management of the roads and the quality of infrastructure is maintained properly. So these are some of the things that we are planning to do. Plus we are also, during the monetization, we are bringing in, after the roads are constructed, for the management and the monetization process, where the private investors are coming in and the best possible expertise in the roads is brought so that the roads are managed properly. So these are some of the things that we are planning to do, and hopefully we will be delivering on this.
Just an observation. Our experience has been that O&M cost per lane kilometer varies widely across various roads. So I think there are some areas of excellence on the O&M side or the maintenance side from which a lot can be learned. And therefore the SLAs, they can be tightened, particularly road roughness, values and all that. The point that was made by him with regard to the quality comparisons. I think if just a comparison between the various operators and the best practices that exist, there's a lot of opportunity to our mind doing something.
Actually, as a supplement, we are also looking at using the artificial intelligence and the drone surveys to actually manage the roads in a much more effective way.
Excellent. So that the data kicks in, and I think, again, we just read the newspaper report about not toll being collected without toll gates. So clearly, I mean, I think, and we all are beneficiary of so many new technology advancements. So hopefully, I think the point, Rajiv, you mentioned about O&M spends in various sectors and making comparisons will be very helpful. Okay, so Mr. Tiwari, I'll come to you. Look, I think the roads is well understood, a lot of innovations. HAM has been absolutely brilliant at some point of time. And you know, to give credit to NHI and the government, I think they have really kind of kept pace with the time. But we're also talking about various new kind of infrastructures coming up. Data centers is fine, but they are being pulled in by large guys. You know, we speak about the big Amazons and the Googles and the entities of the world. What, from a banking perspective, where you are really, there is so much of demand all over the place, your credit to deposit ratios are starting to really come all-time high. What emerging infrastructure excites you? What will become big for you, where you are really zoning in?
Thank you, Ashish. And first of all, my congratulations to NaBFID for organizing this, because this is direly needed. We needed a central place where, as mentioned, data can be centralized so that it becomes a repository for all kinds of information about infrastructure, because all said and done, infrastructure lending, infrastructure information is a little fragmented. And since it is so large, we do need this. Coming to your question, before I get into the new emerging areas, I would like to say that we have success stories in this infra space, sectoral success stories. Road is, of course, one clear example, where you see it on your own that the road infrastructure in India in the last 20 years has really, really improved significantly. And we see it, and it is a result of NHI working with the developers, the lenders, and everybody else to standardize, to keep improving, keep tweaking. So as mentioned, and when there was a challenge with the asset quality of some developers about 2012 to 15, then they came back the HAM model so that the lenders continue to support. Otherwise, it would have been very difficult for people to continue supporting. Similarly, in solar, we talk about government intervention. Solar is, the trigger was SECI's intervention in terms of coming up with the assured offtake through PPAs, etc. And you now see there is very little government there in solar. It's all private sector. The money which is now coming in is all foreign money, lot of it. So these are the success stories, and we need to build on these for the financing models we want to go. So emerging infrastructure, I think you mentioned data center, but you said Google and others, they have been setting up, but we see a lot of potential there. I mean, so many proposals, we've already done a few, and there's such a large pipeline. So this is clearly a very, very strong area of interest for us and an emerging piece. And the requirement is humongous, like you mentioned. So whether it's Navi Mumbai, or whether it is areas of Hyderabad, or whether it's Noida, we see a lot of data centers coming up. And increasingly, these are also green data centers requiring that green power. And also some of them are now trending towards the GPU-based, which is the artificial general intelligence, that kind of capability. These are all being done, interestingly, by developers who used to be regular constructors of residential real estate or commercial real estate, and now they have ventured into this. Every large developer has a data center arm, so as to say. This is one. Second is, which we are saying, again, emerging, you mentioned, so smart meters. So many entities who have got into this area, because the overall ambition of the government to actually launch it across states is a huge one as part of the policy. And therefore, that's another space where we see a lot of action happening. In terms of newer technologies or newer areas, another area which we see coming up and which we are looking at very closely is this entire thing about renewable power, but beyond solar. So this is round-the-clock power, including solar, wind, hydro, small hydro that is, and backed by either a battery power or a combination of all this. So this is the latest thing. We also see some emerging opportunities in pumped storage hydro, which is again a very, very new field. Old technology, but risky, takes a long time, and therefore fully satisfies those risks around infra. But again, this is something we are already seeing, and a lot of potential again here. In terms of mobility, again, electric mobility is a key area of emerging, which is there largely around the e-buses, but it's also developing in other areas. Electronics is another area which initially it was led by PLI, the entire chip space, design, the manufacturing, but it's across, and we are seeing a lot of interest there. Of course, it is led by some very large players, but whenever a large player comes in, there are a host of mid-sized players who support that large player. So again, we see a lot of opportunities here. In terms of areas like railways, again, interesting, while the railways, I think it was said earlier that this is a space where government needs to largely fund. True, because a lot of areas in railways needs to be aligned to what private sector wants, but parts of that railway thing is being done by private sector, whether it's the manufacturing of tracks or the manufacturing of axles or various other areas related to railways, and we see a lot of action there. So again, this is not very glamorous, not very well known, but we see a lot of action there. So I think these are some of the areas, some old infra, as you call it, some new infra, but infra is something which is such an important piece for our nation's development, and we will continue to see action here.
That's very, very encouraging to hear. I mean, you mentioned so many areas, and I think that's just wonderful. Tell me, today if you hear, because we are in Viksit, in the context of Viksit Bharat, you hear a lot of cluster-based development being spoken about, whether it's a marine cluster or an industrial park. The idea is bring everything together. Is there an approach at SBI now to think about, okay, let's adopt these clusters or park and make sure everything happens here so that the outcome of that investment is actually realized? Is there a thinking that you go beyond the project?
So cluster-based financing approach has been, is not a new thing. It has been going on for a long time. So we have had clusters like garments cluster, then we have the Coimbatore industrial cluster, we have had Firozabad clusters, and in fact, during the 90s, we used to have a project called Project Uptech, which used to actually provide technical consultancy to clusters, the units in the clusters, and then the technology used to be financed by the bank. And these were largely MSMEs. So far the cluster approach has been mostly MSMEs, not really the very large players or the very large entities. And I think there is a lot of merit in this approach. I think if we marry this to maybe a repurposed or a refurbished version of the SEZs, they cannot only be a real estate play. We will have a very good model in terms of infra, supporting a large number of units where power, the water supply, the marketing side, all of that is in one place. We do need a very large number of such clusters. So we are already there. We have been supporting this, and it's an old thing for us.
Excellent. So there is the finance and the policy kind of coming together, and I think that really is an answer. Rajiv, we spoke about the investments in new emerging areas, and I think Mr. Tiwari laid out a whole set of ideas. From your vantage, both investments and consulting advisory, you want to highlight which areas are getting funding, which are not?
I think just two, as Ashwinji rightly said, that the whole storage technology for BESS, basically, for solar, is going to be big business. And there was a recent IEA report which said that the prices paid by industrial companies for coal, and generally they tend to be far away from the, the mine pit heads. That price of coal converted into energy, electrical energy, the price of that energy and the price of solar power on a RTC basis is coming close to each other. It's not quite there, it's coming close. So imagine 4 or 5 years later, the price of round-the-clock solar power can be very competitive. And if that happens, then obviously a lot of investment will go into the storage. The second area where we are seeing significant activity takes place is broadband networks. The reason is that from the look of things, through the air, which is fixed wireless access, what's called air fiber and all that, has some serious issues with the latest technology, because it doesn't seem to penetrate the walls. So therefore, if the broadband is to be consumed, it has to be a wired network through the fiber, and you can see significant investment take place here. And it may not always be owned 100% by the telcos. So there will be standalone companies, possibly private, possibly with some
minority investors, but you can expect a lot of dollars to flow into those things.
Thank you. After this question, I'm going to open it to audience. So if you have some 2 or 3 questions, please get ready. We will have 2 rounds of audience questions. I obviously will not be able to ask everything that you have in mind, but we will try to give it a shot. Samuel, while the audience thinks of their hard questions for the panel, we heard, from the regulators themselves about, let's say, muni bonds. There was a suggestion of how can we think about the long tail, how can we think about pooled financing. A bunch of ideas came up. Actually, urban and social infrastructure financing continues to remain very challenging. I mean, of the 5,000 municipalities, urban bodies, Mumbai is the only one which is net revenue positive. Everyone else has to depend on some kind of grants. How will this infra get funding? Is NaBFID thinking on some of these areas where you will step into territories where nobody else has actually stepped foot in?
Yeah, thank you, Ashish. I think this is one of the missing pieces in our infra growth today. While as a country we have been very successful in building, let's say, national highways, ports, airports, at the urban infra level, I think there is a large gap which we are yet to address. Now, my parents stay in a district headquarters. It's also a smart city. But even basic things like whether water will come all 365 days at a particular time. Sometimes they get at 3 o'clock in the morning, 5 o'clock in the morning, the schedule is announced at the last minute. Now, these sort of gaps are not getting addressed. And we cannot delay too much also. Here, in fact, urbanization is a route which all developed countries have gone through and India will also go through. As per the last census, 2011 data, 31% of the population lives in urban centers. This will go up to 40%, what the Secretary DF has also said, by 2036. And this 40% population will contribute 70% of GDP, so all the economic activity is going to be concentrated in this. Even as we speak, there are 65 cities with 1 million plus population. Most of our cities today are unable to dispose of their waste. We are sitting next to mountains of waste. Many of us living in cities live in gated communities, so our societies to a large extent take care of all this, so we are not exposed. We really don't know what is the challenges in this, but I think this is the biggest missing piece in the infra story, and unless we tackle this, we will not get anywhere. Now, waste disposal itself, if you look at just one aspect of urban infra, incidentally, in NaBFID we have touched upon this subject of urban infra. Pimpri-Chinchwad Municipal Corporation came up with a bond issue. Government has a scheme. As we speak, there is an Amrut scheme, Atal Municipal Rejuvenation Scheme, where in order to nudge these corporations get into the municipal bond, there is a 13% subsidy available upfront. So if 100 crore bond issuance is done, 13 crore is given as subsidy, limited to 200 crore. So some of these corporations like Ahmedabad has done, Baroda has done, Surat has done, Vizag, Hyderabad, Bhopal, Indore, a handful of corporations have already issued municipal bonds. But maybe in the inaugural session, I think somebody mentioned 50 odd municipalities, corporations may be ready. What about the others? There have been some models. I think Tamil Nadu did a pooled municipal bond structure. They created 13 urban local bodies came together and issued a 15-year bond. It was not just a 5-year or 7-year bond, 15-year. So it was quite well structured. Karnataka has sort of replicated that, but why can't we replicate this across the country? So if it is becoming very expensive, transaction costs are expensive for each municipal corporation to tap the bond market, compliant costs are quite high. Once you get a listed bond, then reporting to SEBI, exchanges, all that compliance costs are also high. Can we look at a pooled bond structure? There is scope for doing this, and as NaBFID, we are already in touch. We have been talking to the Ministry of Mohua, Housing and Urban Affairs. We met the Secretary also recently. So this is going to be a long drawn process, because we all know decision making at the urban local bodies is, but if we get buy-in from the state governments and from the MOHUA ministry, I think it is not very difficult to do. It will take, this will work mostly through a demonstration effect. We take 50 municipal corporations first to the market, and this will automatically bring governance issues. Today there is some perception that these municipal corporations, urban local bodies or state governments are weak financially. Of course they are weak, but even within whatever pools of resources they have, the municipal bond market in the developed world is much larger. But they have a higher devolution of power and resources at the urban local body level. We are not even asking to change that basic structure under which we are working. Even today, each of these corporations have access to a pool of property tax, and there is a devolution of the taxes from the central state governments which go to the urban local bodies. Can we channel it in a better way? Can we bring some discipline? I think more than the resources, it is the governance issue at the urban local body which will nudge. And through a demonstration effect, I think we can solve this problem going forward.
It's very heartening to know that somebody is starting to put pen to paper on some of these issues, and my best wishes to NaBFID. Just before you put your mic on, if you said about demonstration effect a couple of times, if you have to pick 3 states in India which can demonstrate this, which will be your 3 picks?
I already talked about the pooled bond structure. On the waste disposal, again, what I talked, there are models which have already come up, which have not been replicated. Gujarat has done this.
Okay.
Jamnagar, Surat, Rajkot, Baroda have already done. At the state level, they have a PPP concession standardized for the entire state, how waste to energy, and most of the private sector is not participating because they don't want the trouble of collecting waste. So in that model, interestingly, collection is with the municipal corporation, only processing. Land allocation, lease rental, everything has been decided at the state level. So each municipal corporation need not reinvent the wheel. So there are models available, we have to replicate it.
Maybe one of the things NaBFID should do is actually put together the best practices in India on its website. Maybe there is enough interest. Let's see if there are some interesting questions from the audience. Yes, sir.
My name is Chandrakant Salunke. I'm a president of SME Chamber of India and also founder of SME Industrial Parks of India. I'm very happy that you are talking about industrial park when you remarks. Most of the companies, top corporates have denotified their economic zones which they allotted them earlier. And now the 100 industrial parks are announced by the government. I would like to know from the DFS and NHI, particularly for what is their plan, or NaBFID can create a model or a report to present both the department to credit flow towards the the industrial parks developers and particularly SME sector. Because we are looking for more, so that SBI and other institutions will take forward.
Thank you. So let me rephrase the question. I think the question is building on what Mr. Tiwari said. Cluster financing is not a new concept. We again are speaking about it. Is there something that you would like to suggest on how we are trying to energize this, what can be done to really make it a success?
Yeah, thank you. From a MSME perspective, I mean, slightly away from the core infrastructure. So cluster development, as Mr. Tiwari said, it has been there always. And from a financing perspective, if we look at it, there has been a lot of developments which the government is doing. And also, if you look at the current budget, MSMEs have been given a lot of thrust, which is one of the thrust areas in the current budget. The themes run through the budget, actually. So there has been some forward-looking movement in terms of enabling SIDBI, which is again a DFI to finance these kind of projects. There is developmental fund, PSL shortfalls from the banks, which is getting channelized for development urban infrastructure. So I think the first steps we have taken, and probably we will require for a coordinated effort in terms of how to make sure that all these pieces come together, and the infrastructure development focused on a cluster and towards developmental of MSMEs can take place.
So what didn't work in the past was people notify doesn't mean it's not a good idea. I think there is a lot of thrust now. Let's see if there's any other question in the audience. Sir.
I'm indeed excited about the urban development, and as a veteran banker, we all started in 2007 when the Jawaharlal Nehru National Urban Mission was introduced. And since then, I heard only about Surat. I mean, how is it that the 100 smart cities, at least the municipal corporation in those cities should come at par with Surat? I mean, I would really appreciate if that focus, which started in 2007 on the urban mission, if it is really continued and pushed by the government, I think the 100 top municipal corporations can make all the difference. That's my opinion.
No, that's a good point, sir. So I think we can again, NaBFID can really pick this up to say best practices from various places can be replicated. Do I see any other hand?
Indoor can be replicated.
Indoor can be replicated, sir, for sure. In fact, some of these places, I believe you have almost a command center where what is really happening in various parts of the cities is monitored through a web of cameras. Okay, last question, and then we move back to our panel. Yes, ma'am.
I think we do have very good examples of, very strong municipal authorities, but maybe that capacity building is lacking.
Okay.
Somebody mentioned we are living next to piles of garbage, but the capacity of identifying a new piece of land, the capacity of dealing with NIMBY issues, maybe that is something that requires a more coordinated.
Excellent. So we'll come to that question anyway as a part of our panel. Let's get back to our panel again. Mr. Kumar, I want to come to you. I think InvITs was mentioned as one of the most interesting innovation that happened in the market. In fact, the number suggested 30 InvITs REITs have crossed 6.5 lakh crores. So again, some of them starting from NHI, and that seems to have a very strong demand in the market. Tell us about your experience. Is anything new coming up on innovative instruments? What else you would like to see?
I think if we can see what is the most important innovation that we have for the past decade in infra, I think the lead has been taken in establishment of the InvIT by the government itself. Means it's such a visionary thing that you have a pooled investment vehicle supported by government. We put in assets, good quality assets, pre-examined and pre-vetted by the government itself, and then run a professional management and place it before the financial investors so that the financial savings will come into the infrastructure in a very structured manner. There has been a lot of support from the regulators. The InvIT is regulated by SEBI in a very professional manner. And our experience has been, we have gone through 3 rounds of monetization through the InvIT vehicle. And our experience has been that the market has taken this very positively. Having said that, we feel that we are not utilizing this vehicle to its potential. See, we have high quality investors. We started off with 27 investors. Now we have around 200 investors in this vehicle in the trust. It is run by a very professional management team. My colleagues are here, Mr. Suresh Goyal, the CEO, and Mr. Matthew, the CFO. They have been running this in the most professional manner. They have been approaching the investors. The Canadian pension funds have been anchoring the investment into this. However, it is a little bit disappointing that the benefits of this vehicle is we are not able to offer to our own pensioners, where the entire world sees the advantages of investment into this vehicle. We are not able to actually leverage on our own investors. So this is something maybe we should go back to the drawing board. We request the regulators to have a look at it, see the governance. Means it's not only yes, obviously when we are dealing with finance, we have to be doubly sure, and the regulator's perspective is on financial stability. But seeing the instrument, seeing the kind of assets that we are putting in, ultimately it is, and seeing the coverage, means see, the point is that, is the lender protected? Is the concession agreement robust enough to take care of the stakeholders' interests, both from the lender side and the investor side? So maybe we should go back to the drawing board, maybe we should request the regulators to have a relook at this thing so that at least some exposure should be given, both on the provident fund side and as well as the pension side. People are investing, it's not that as if they are not investing, but the sectoral limits themselves are kicking in to not to have the full advantage, obviously with the risk limits being adhered to, that take advantage of this product.
It's good that you got a praise from this dais, Mr. Goel, Mr. Matthew, this is fantastic. Actually, I have the next question to three of you, Mr. Tiwari, Mr. Samuel, and Mr. Gupta. You recently raised a 20-year paper which was subscribed, I think, 10 times, and you hardly had to pay any premium. SBI keeps raising infra bonds all the time with actually hardly any premium. You probably have a book of 55, 60,000 crore rupees on infra bonds itself. So it seems like there is no real lack of there's no real lack of demand in the market. There is enough demand for high quality, long-term paper that is out there. It's just that it needs to be structured and being presented in an appropriate manner. How do you see this? I mean, we keep speaking about ways of money, but maybe the money is here, we just have not taken it the right way. I just want to hear three of you speak about your experiences and what you see in terms of demand of this paper, what can be done, even in terms of innovative products out there. Let's start with you.
Yeah, well, we did issue a 20-year bond just last month, and we got 7.36. We were very happy with the response, 10 times over subscription. But this paper is very rare. Not many people are issuing 20-year bonds. I think before we did, in the entire country, I don't think other than Mr. Rajendra Kumar, anybody has issued 20-year. I think they have issued 30 years also. But there has been no other paper except government bonds in this 20-year space at all. We wanted to do it because our assets are also long-term, and we also wanted to set the yield curve for our paper, which we have done. We will continue to raise long-term. Now, coming to the demand side, supply has been very limited, as I said, for various reasons, but I think going forward, NaBFID will be a frequent issuer in this space. The demand side, some of these numbers came up in the previous presentation also. The insurance PF gratuity funds are sitting at 115 trillion rupees today, which is more than half the all bank deposits put together. Bank deposits are at about 220 trillion rupees. The growth of the assets under management with the insurance is twice the growth of the bank deposits. And going forward, the issuances by the government is going to go down because of fiscal discipline and foreign funds coming into the GSEC market, so on and so forth. So where is the supply to meet this demand? In fact, Mr. Rajendra Kumar just now mentioned, foreign pension funds are able to take advantage of our infra assets, but our own pension funds are still not convinced. Maybe there is a reason. Safety is paramount. These are not like mutual fund asset managers, fund managers where 0.5% alpha will enthuse them. Here, safety is paramount. All our pension monies are also lying there. We should be careful. But this is where I think what we are talking of for quite some time now, partial credit enhancement. Can we make these infra bonds by the developers, not by the institutions? Institutions, anybody will lap up today. By the developers, make them a AA+ and take them to the insurance segment and increase the supply there. Today, though IRDA has permitted them to invest 15% of their total assets with these bonds, they are still in single digits, maybe 9, 9.5. So can we increase the supply through partial credit enhancement? I think NaBFID will play an active role in increasing the supply of these bonds.
Thank you. Rajiv?
See, first of all, in our experience, and I think Ashwini-ji will agree, in most of the infrastructure areas, there's an implied inflation pass-through. So really fixed rate borrowing is not that critical. There are exceptions like, say, I'll give you one example, cable. Now because this cable networks get offered to people from the very rich to the,
significantly below lower middle class. Therefore, when you offer the same product to such a wide variety of income categories, your ability to pass on price increase is very, very limited. So there is a problem of inflation pass-through. Otherwise, inflation pass-through is implied in the infrastructure assets. So it's not that we are constrained by the ability of fixed rate money, Samuel, in our ability to finance infrastructure. So this is point number one. So the second point is with regard to what sort of money is available. Talking about not the bond side first, but really the equity side, which is what you're talking about, the InvITs and all that. Fact of the matter is, every infra asset is highly levered, and rightly so, because the risk is, the demand is certain and the risk is that much lower. So these very levered assets, the Canadians are prepared to buy at, if Government of India is borrowing at 6.4, 6.5, at about 4.5% equity risk premium, they are prepared to buy the paper. So highly levered 6 and 4.5% equity risk premium, I think to match that kind of return is going to be easy for many other people. So they are going to dominate the sector. And frankly, from their point of view, 8% is enough in Canadian dollar terms for them to meet their mismatch back in their country, the pension mismatch. So I think it's going to be hard to beat these guys. And the beneficiary of that cheap money is anyway you and all of us. So it's okay.
On one fact, yes, obviously on the leverage front we need to look. But if you see at least we can talk with regard to the government's InvIT. So we keep the leverage low, and it's a AAA rated. And as you correctly pointed out, there is an explicit inflation pass-through in the revenues with regard to toll. It's a formula. So somewhere, I think all of us have to look into the fact that the inflation-linked assets have not really taken off. Both the investors, both the pension funds as well as provident funds should have lapped up the inflation-linked assets. Neither the inflation-linked government bond nor these kind of assets are not getting that kind of investment flows.
Clearly see a lot of scope for us to move forward. Maybe I'll end with the last question to you, Mr. Ayyappan. We spoke about PM Gati Shakti, how it has been a game changer. Somebody in the audience spoke about capabilities. So from your perspective, how data, technology, capacities, capabilities need to come together to really give this push?
Yeah, I think that's a very, very crucial area. A lot of steps, again, if you see the NIP, NMP, the PMG, Project Monitoring Group, PM Gati Shakti, a lot of initiatives has been taken. But again, if you look at whether this is aggregated the entire data, whether this is aggregated or captured the entire potential of the technology which can be leveraged, I think we still have a lot to do. Data and use of data in risk management also. I mean, apart from the aggregation of financial data, that I think has a long way to go, because I think NaBFID can look into that as a big, big way. Today, when we talk about data, a lot of data we have is the static data. The flow data is still disaggregated at multiple places, so probably budget has a flow data, but I think the balance sheet still, it's very difficult to aggregate together and find an infrastructure flow data. I mean, what financing is going on. So NaBFID probably has some developmental role from their development part of the role. And also technology in risk management. I mean, I may sound cliched, but the best automobile is with the best brakes. So in risk management, from the past history, what we have learned, and if we can use technology in project monitoring and have real-time monitoring mechanism of project progress. So that's also a big way technology can be leveraged.
We'll end the panel with one rapid-fire question to all of you. You can only answer in one word or one phrase. So we spoke about infrastructure as growth enabler for Viksit Bharat. What excites you most about this?
It's such a multiplier effect. You said one word, so I'll keep it at that.
I think the impact it will have on the social infrastructure. I think that's a great
quality of life.
Decentralized development.
I'll give a slightly longer answer. Infra financing today, it's at a Goldilocks moment, as good as it can be. But history has the habit of repeating itself. We need to be careful.
You need to be careful with that. Thank you very much. It was wonderful hosting you on this panel.
A big thank you to our distinguished panelists for their insightful and thought-provoking discussion on infrastructure as a growth enabler, Viksit Bharat 2047. Before, gentlemen, you leave the stage, I'd request Mr. Samuel B. Jibaraju to present our illustrious panelist and moderator a small token of our appreciation. Gentlemen, please stay with us a moment longer. And if you've taken some key takeaways from this discussion, then do give a big round of applause to our panelist and moderator. Really a wonderful discussion, energized us to think about how are we going to move towards making India the developed country by 2047. Thank you so much. Thank you so much. Of course, while finance was the overpowering theme of this discussion, I'm sure as citizens we also want to see quality and longevity of our infrastructure as well, isn't it? Ladies and gentlemen, as we move towards our next panel discussion, I'm sure all of us would love to hear about how we can unlock corporate bond markets. So as we continue our engaging discussions, it's time to introduce our second panel discussion of the day, focusing on the crucial topic of unlocking corporate bond markets. Now, I would like to welcome on stage Ms. Fatima Ali Akbar to be our presenter from Bloomberg for sharing the presentation and also setting up the context for the session. May I request Ms. Fatima Ali Akbar to please join me. A very warm welcome to you.
Good afternoon to one and everyone present here. It's an honor to, talk about a very important topic, which is unlocking the corporate bond market. In the morning keynote address, Mr. Rao from SEBI raised a very important point, which got all of us thinking, whether are we still developing the corporate bond market or are we already developed? Now that raised a very interesting question on what's our definition of a developed corporate bond market. And today in this discussion that we are going to do with our esteemed panelists, we might come out with thinking that what are the parameters that define the development of the corporate bond market. And before we reach to our panelists, I would want to give you an overview of certain perspectives that we should have in mind when we are looking at the development of the corporate bond market. If I may ask the team to just load the presentation quickly as well. So before we unlock the corporate bond market, let us first understand what's the current status of the corporate bond market and whether are we still developing or are we developed in terms of the corporate bond market. We'll also look at what are the drivers which can then lead to the path in which we want to take the corporate bond market in India. Whereas also when we are looking at diversification of investors, how foreign investors can also play a role in this. And finally, whatever will be the way forward is what our panel will be letting us know. Next slide. So currently to begin with, okay, are we a developed corporate bond market or a developing corporate bond market? I don't know the answer because it depends on how you define it. But just to give some perspective, currently when we look at the global corporate bond market alone, we are among the top 15 markets in terms of size. Now, of course, when we look at US and China as a market, the quantum is pretty huge as compared to all the other countries. But imagine out of the 198 countries in the world, we are still in the top 15. That may be a parameter at looking at how big the corporate bond market in India is. As well as if you look at the right graph, if we talk about India itself and we look at the fixed income universe in India, as has been discussed throughout the morning case, that government has been the main driver for infrastructure and capex investments. Private investments are yet to pick up. The same thing is reflected there as well. Government securities, state papers are the ones which cover the maximum portion of the market. However, 15% of the market is still the corporate bond market, which includes your NBFCs and your financing companies as well. So that's something to put in perspective when we are looking at the development of the corporate bond market as well. Next slide, please. Now here one very interesting piece as well is on how the structure of the market is. The left graph easily explains that over time, as we are growing, we are a 3.5 trillion economy. We plan to be a 30 trillion economy by 2047. This number will keep on increasing. We will be a growing market. But the right chart is something which gives a very interesting perspective. That 10 years back when we looked at the market was smaller, but however, the unlisted space was much smaller than the listed space. Now in the last couple of years, or the last 5 years if I look at it, the private placement of these corporate bonds has been much higher than the listed space. Now why is there this shift? Whether is it good for us, it is bad for us, maybe we'll listen it from our panel. Somebody had told me a very interesting thing about private markets. So this covers the private placement of bonds, but of course we know that the private credit market has also been growing at the same pace as you can see here. Now it's a very interesting thing about the private markets wherein everybody wants to know what's happening in the private market, but who all are the people involved never want to share what's being done there. So whenever we are talking about creating a repository, that's where this disconnect happens. We'll hear it from our panelists today that how that is something which is being able to be bridged up. Maybe there is a mandate needed, and let's see how that goes forward. Next slide, please. Also, one very interesting share is that when we are looking at the corporate bond market, one is the size of the market. Second is our GDP itself, like we are the fastest growing economy across the globe. Our proportion of the market over our GDP numbers is a very important parameter that we should be looking at as well. And if you look at the right-hand graph, I have just taken certain Asian economies, okay? I have not even taken those developed economies. Among those Asian economies, India still is at the middle wherein a percentage of the GDP growth and our corporate bond market, the ratio might not be very promising. Maybe that is something when from government capex to private investments is when we move forward, this number might increase, and that is something which is something that to aim for as well. We'll hear about this more in our panel discussion as well. Now also when we are looking at this journey of how our market is moving from developing to the developed market, there have been multiple efforts that have been taken even by the regulators to push this particular market. Of course, I have penned down a couple of them which include across in terms of operational efficiencies in settlements, electronification of the entire process of raising funds, and how all of these can be helpful in developing that particular market. It also mentions of certain parameters which have been allowed regulatorily, but there are still challenges. Like for example, CDS has been launched in multiple variants over the years, but still we don't see the CDS market developed. There are different regulators who look at this particular product very differently. So maybe the Reserve Bank of India has allowed all banks to offer CDS to each and every kind of industry. But if you look at, okay, the insurance regulator just allows buying, not selling. The PF regulator has not yet allowed these products to their players. So when there are these disparities along, the regulators itself as well, whether how will that product flourish. Another thing is when we compare it with the global markets, okay? CDS as a single name CDS, across the globe, nowhere it has been a success. China had tried it 10 years back, even they couldn't do it. Index CDS is something which is the most prevalent even in developed markets. And here we are looking at those single CDS names. Whether is that something, is there a tweak needed there? Is it something that can work in India? Is something that it's worth discussion, and we'll see that. Also, one very important thing which I think so an earlier speaker also mentioned is partial credit enhancement. Now that is something which when there were crises in the corporate bond market, the regulator had come out with this. But how much has this been penetrated and how much more scope it has is something which will be a very interesting thing to see, especially in our market, where the lower rated papers is something which is not being able to access the corporate bond market. Lastly, the FPI investments. Now, when we are talking about the market and the huge requirements that India has, widening the investor base is something which everybody would agree is very important for growing a particular market. Now, whether foreign investments are something that we are looking for, how do we want to grow that further is something, again, a very interesting thing to discuss about. Next slide, please. On this front, also, like, recently everybody has been talking about the credit deposit ratio, which the regulator has also been concerned. In fact, I was looking at a little history. The credit deposit ratio, there have been times in history as well where it has been pretty high. However, during those times, our liquidity was at deficit. But currently, the situation is a little different. So, despite of both the markets increasing, the bank credit growth as well as the corporate bond market, if you look at the ratio of how much is the corporate bond market vis-a-vis the bank credit market, the ratio is still very small. So, whether when this concern of the credit deposit ratio is there on the regulator's mind, can the corporate bond market be a bridge to fill in that particular gap is something, again, we would want to hear from our panelists as well. Next slide, please. Also, when we are talking about, the corporate bond market, the size is increasing. But where is that size increasing? You will find that the majority paper is still a AAA paper. The quantum of bonds that are issued is maximum AAA. As soon as you go, okay, there are some on the AA side as well, but as you start going below the rating yield, the quantum, gets really shrunk. Now, why is that happening? Because is it that they find it easier to access bank credit rather than the corporate bond market or the capital markets? Or is it that the cost of raising through the corporate bond market is difficult? Or is it that they don't have access to it? These are very pertinent questions we can look at on expanding that particular base as well. In that, whether can the partial credit enhancement scheme, will that be a game changer? Because that helps the lower rated papers to, still ask for funding to the capital markets through increasing their rating through the PC pace, where I think so even NaBFID would play a very important role. Next slide, please. Finally, I mean, there are even certain regulatory things which, sometimes add to how a market can develop. So, as we know that currently also in the market, NBFCs and the PSU space are a big chunk of the players who access the corporate bond market. Now, there have been regulatory, concerns on the risk weights that are assigned to these particular, lending that is done to that particular sector. Now, due to which we expect, there is research which mentions that this could also lead that these NBFCs might look at, different sources of funding rather than just relying on bank credit, because that at a point in time, it will definitely get squeezed. Maybe that can help again more on the growth of the corporate bond market as well, is something that could also be, a very important aspect to look when we are looking at long-term financing. Next slide. Another important aspect is when I was talking about the widening the investor base, okay? Now, foreign investors, this year itself, we got added into the global, JP Morgan index. Bloomberg is looking to add India government bonds also in their index. This has got a lot of interest, for foreign investors to look at India. And of course, as of now, with the China Plus strategy, we are anyways a market which cannot be ignored. Even when I travel to all my other offices in Bloomberg as well, every player there has been asking that their buy-sides have been asking about India and how they can take exposure to India and things like that. In that front as well, right now it's the government bond market where these people are looking at. But this will eventually percolate to the credit markets as well. And when we look at that, and if we do a comparison of, across different Asian economies, India does provide very good returns even when we talk about the credit papers. So that could be something that we can look at an investor base which might be willing to, take exposure to this particular market as well. Next slide. Finally, all of these things that I just wanted to give a perspective on how do we look at the corporate bond market, and in the way forward, we'll have our panelist moderated by Nitin Jaiswal to talk about how these parameters can be finally looked at and what more is needed to grow our corporate bond market. Thank you very much.
Thank you so much, Ms. Fatima, for setting the context for the session. Now, guiding this discussion, we have with us our moderator, Mr. Nitin Jaiswal. He is the Asia Pacific Head of Strategic Relations and Initiatives at Bloomberg LP, the world's most trusted source for real-time and historical financial data, news, research, and analytics. Based in Singapore, Mr. Jaiswal works with senior stakeholders from government, regulators, capital markets in identifying and executing joint strategic initiatives to affect positive change by enhancing market transparency, build local communities, and help advance capital market development in Asia. Ladies and gentlemen, please join me in welcoming Mr. Nitin Jaiswal. A very warm welcome to you. And we're thrilled to have an expert panel to dive into this important subject. Please join me in welcoming our first panelist, Mr. Jitendra Shah, a seasoned engineer with 31 plus years of experience. He has led the Tipsons Group to significant growth. His leadership philosophy, emphasizing honesty, transparency, and trust, has fostered a positive work environment and strong employee relationships. A very warm welcome to you, Mr. Shah. Ladies and gentlemen, we can make that applause a little warmer. Thank you. Joining us on the panel, we have with us Ms. Nipa Sheth, who is the founder and director of Trust Group of Companies, a full-service financial services house and a leader in the Indian bond market. Her work contributes an integral part of the fixed income market over 2 decades. She has large exposure with investment of institutional and non-institutional clients, just like large domestic public and private sector banks, large PSUs including Navratans, provident funds, FIIs, endowments and pension funds, large listed and unlisted corporates in India, and high net worth individuals. Under her leadership, Trust Group has won the prestigious IFR Asia's India Bond House for the year 2014 and 2017, amongst several other accolades. Ladies and gentlemen, please join me in welcoming Ms. Nipa Sheth. A very warm welcome to you, ma'am. On the panel, we are joined by Mr. Prathamesh Sahasrabudhe. Prathamesh, who is the Managing Director and heads Capital Markets Business for India and South Asia region in Standard Chartered. He is the Senior DCM Banker coordinating primary markets, foreign currency and local currency bond issuances in the region. Prathamesh joined Standard Chartered in 2007 and has capital market experience of over 18 plus years. A very warm welcome, ladies and gentlemen, for Mr. Prathamesh Sahasrabudhe. On the panel, we are also joined by Mr. Ravindra Gandrakota, Chief Executive Officer, Fixed Income Money Market and Derivatives Association of India. Mr. Ravindranath has joined SBI as a direct officer in 1985 in a career spanning 35 years working with SBI across various geographies in multiple areas of banking covering retail, credit and treasury operations both in India and abroad, retired as the Chief General Manager. Thank you so much, sir. Very warm welcome to you. On the panel, we are also joined by Mr. Anup Bagchi, who is the Managing Director and CEO of ICICI Prudential Life Insurance Company Limited. Prior to this, Mr. Bagchi was on the board of ICICI Bank and has worked across various functions of the bank, across retail, MSME, corporate banking, treasury, in addition to credit policy and data analytics area. Ladies and gentlemen, can you please join me in welcoming him on stage? A very warm welcome, sir. And last but not the least, we have on the panel our very own Ms. Monica Kalia, DMD CFO at NaBFID. She has been the Executive Director of Bank of India earlier, has handled various roles such as overseeing assurance, fund ratios, internal audit, inspection, risk management, cybersecurity, fraud risk management, and many more. Please, ladies and gentlemen, a big round of applause for all our panelists. And I'd leave the stage to you, our moderator. Thank you.
Okay, thank you. Thank you, Fatima, for setting the context. And just before I get into the panel, one observation I wanted to make. Listening to all the conversations from the morning, the presentations, the opportunities, and the work which has been done, I feel this kind of conference need an international platform because global investors need to know the kind of work which is being done here and the opportunities which India is able to offer I hope that we are able to take this conference global. So on that note, congratulations to NaBFID for the successful inaugural forum on infrastructure. So let me get started. So I have 6 very senior stakeholders from the market representing 6 different pillars of the corporate bond market. And I have given them 2 tasks. Okay, one is the short term and one is the long term. So the short-term task is that we have 40 minutes ahead of us. So we just want to make sure that we are able to finish our conversation in that 40 minutes so that we are not holding you back from lunch, the audience. And the second part is also around food. So we want to have some food for thought, for which is the long-term one. The thought came to me while I was sitting there thinking about this, is how about starting something called, ICBS, India Corporate Bond Stack. So what I mean by that is, if you look at what happened with the digital stack, so India solved a very complex problem the world was struggling to solve of digitization of the economy and the financial inclusion by focusing on what they call the India digital stack. Today, it has become a global benchmark, so every other country is looking at that stack to figure out how they solve their own problem. So when you look at the corporate bond market, is no different. If you take out 1 or 2 large markets like US and other one, every other country is trying to figure out how they are going to further develop the corporate bond market. India, I think, has done, the numbers we have seen come a long way in terms of developing the entire bond market, including the corporate bond market. Pramodji has actually set a very interesting context in the morning, whether we are developed or developing. I think that's something we can actually debate. But I think whatever solution, if we are able to come, what I call the India corporate bond stack, could also become as a reference, not only for us to figure out how far we have come in terms of the development, but also becomes a benchmark for the global especially the global South countries to follow. So that will be a broader context of my conversation because we have 40 minutes. So I have kept my points in 2 different questions, and I'm going to start with Monica ma'am from your side. The first one I would like to find out, the debate we got started in the morning, are we developed, are we developing? And it's a very difficult debate to actually, find an answer. But we need to have that, otherwise, every 2 years we'll keep having this discussion, how far we have actually come. So there is no definite answer to say that if we are 8, we are developed, if we are 10, we are not. So, but if we have to look at it, so what are the key building blocks or 1 or 2, milestones you look at, where you say, if we achieve this, then I think we have made a big stride and we are almost there. What will that be?
So thank you for the question. I think very interesting. I was taken aback really in the morning when Mr. Pramod Rao said, we're already there. I think number-wise, maybe we are somewhere in the middle. We saw that what Fatima, displayed. We were somewhere in the middle. But, looking at the fact, if I look from the 3 perspectives, the issuer, the investor, and the, secondary market. So issuer, what kind of issuer is coming to the market? Whether it is, only the AAA which is coming to the market, the tenor, whether it is only 1 to 5 years or maximum 10 years, 90% is in 10 years. So whether we have 15-year, 20-year, which is the need of the investors. From the investor perspective, whether we have a broad spectrum of investors, if I look at insurance and the PA pension sector, if it is like out of, the total investment, 20% in the bond market, out of that 20%, 97% in the, only a AAA segment. Are we really there? Is it investor base bigger? Then looking at the secondary market, what are the, levels of transaction secondary market? I think the data we looked at was, it has reduced by 17% over a period of last 5 years. So what is the development we need to achieve? I mean, along with the numbers, we need to look at the depth of the market also. Most of the investors right now, buy and hold kind of a capacity. Does it need to increase? Because I think that would only be a factor when we can see a more wider base coming into the segment, maybe the retails or the banking sector. I think those are the few questions we need to develop on if we say we are really a developed corporate bond market.
I think it's a very interesting perspective because where NaBFID sit, I think you have three roles. One is the mandate to develop the bond market, then you are an investor and also an issuer. So from that three hats, let's move to insurance side. Anup, you are an investor. Everybody talked about the importance of insurance sector being a key investor in the development of corporate bond market. How do you see which are the missing building blocks which you feel that if we fill that or we achieve that, I think it gives you a comfort factor?
No, thank you. And so from a development of the corporate bond market, I'll break it up into 4 aspects. One is supply. And as Monica ma'am said, what are the kind of suppliers who are coming? And what is the tenor of the supply that they come, which in turn is dependent on their requirement. And so typically you will see that NBFCs and infra players, they have been very, very large suppliers. With HDFC going out, you have the infra players coming in. Now NHA has gone out of the market, but NaBFID has come into the market. Power Grid is there. So there are long-term ALM providers and suppliers of the market. Then you come to the demand of the market, and where insurance companies, pension funds, these are all long-term demand of the market. And the reason is that as the financialization happens of the economy, you'll always require long-term reinvestment risk management. And so you require long-term. So for us, protection, because these are long-term contracts, you require to have zero coupon bond, which will do this to manage the risk of the market. Third, I will say that how do you manage this? There are 3 aspects to this whole game. One is the duration. So that we have to manage from the supply side. Second one, what we have to manage is the credit risk part, which is not sort of managed so well, because as we saw, all data is all AAA and AA and AA plus, and below that there is hardly any supply of that, so we have to detach the credit. And the third is liquidity of the bonds. And I don't think the liquidity on those bonds are also adequately developed. And liquidity need not be only through the secondary market. Liquidity also could be, for example, GSEC. If you see, the largest liquidity is not from the selling and buying of the GSEC market, it's also through a repo market, where the haircuts are so large that it is unviable to do. And if you provide, so there are temporary liquidity requirements of buyers, and they are permanent. If it is permanent, then you can sell it. If it is temporary, one should have a repo kind of a situation. And the fourth one is the operationalizing of this whole thing. So do we have an exchange? Do we have anonymity of trades? And do we have liquidity, both on the repo side as well as on the permanent side, which is on the secondary market and on the issuance side? And I would say that mechanism needs to be developed to detach this. The providers of the liquidity may not be the same as the providers of capital and providers of risk. And hence, partial guarantee is a very, very good idea. For example, during COVID times, I was on the bank side on that part of time. If you see, the emergency line of credit was a very, very brilliant product, because banks had liquidity, but they didn't want to take the credit risk. Government had credit appetite, but they didn't want to provide liquidity like the rest of the world, and which is where India got saved. And so we have to detach the liquidity provider, the credit provider, and the ALM shifters, which is short-term and long-term. And so just like in GSEC, if you have strips, so you can have one bond, which is 30-year, but by using strips, you can then convert it into a short-term and long-term. Short-term get into banking, because their duration requirement is lower and smaller and shorter. And then there are other providers where you can sell long-term strips. And then you have the stripped out 1-0 coupon bond. So you don't have to create a 4-in-1 product for a market. And that's not how markets will get created in the corporate bonds. And we can hear, like you said, about a stack. I think we can indeed create a stack which is unique to India. Because even on the infrastructure side, if you really see, these are all inflation pass-through. If the inflation pass-through, we really have to think that how many of us really require long-term fixed income. And so it is not just creation of fixed income market which is important, it is also how do you swap it into a floating rate market, because there is a floating rate which is different from the fixed rate market. So if you attach a fixed rate and then you do it on a floating rate, then you create a full market. So from an insurance perspective, anyway, we are long-term sort of players. We need to hedge our protection through zero coupon. We need to hedge our non-par guaranteed book by way of FRAs and bond forwards. And of course, we have to also buy, GSEC. And I would say that if you see now, the demand for long-term is coming up higher, and with fiscal deficit really consolidating well, demand will be more, supply will be lesser. So there is a place for long-term papers to come in. But if credit issue is not sorted out, you will suddenly see an inverted yield curve, which is today, where SDLs are trading at a higher yield than AAA corporate. So that we have to correct.
That's a very good insight from the insurance sector. So I'm just kind of compiling some of the ideas which are coming in. So we could actually summarize that. So from insurance, let's move to the banking side, where FIMDA works with all the banks. Largely on the government bond side, we have done a fantastic job to improve the liquidity. And now we are trying to see what we could do on the corporate bond side. Okay? So if we have to take the learnings from the government bond side and the learnings from the bank. So what is the banker's view on the missing links in terms of making sure that we say that the corporate bond market has developed?
Thank you, NaBFID, for having me here, and thanks for the opportunity. Thanks, Nitin, for the open remarks. I would put this discussion into a little perspective, because we all started with a very provocative statement by Mr. Pramod Rao, whether we are developed at the stage or not. Some data points do say that the outstanding credit along with outstanding corporate bonds, when compared at about 47 lakh crores, along with the CP and CD market put together, constitute about 61% of the outstanding bank credit today. So do we take it as a developed number, or do we not take it as a developed number? That's a point to ponder. But more importantly, the question that comes up is, what is the quality of this outstanding? Where is it coming from? Whether it is easily accessible across the curve, whether it is easily accessible across the investor, issuer communities, like my co-panelist mentioned earlier. So whether the market has been able to satisfy the needs of the three ecosystems that are available, issuers, investors, and the other enablers, including the regulators. Regulators have a typical perspective of that. So in this context, we have still a long way to go, and we have very inconsistencies, inbuilt inconsistencies in the current stage that we are, have to be addressed in a very focused way. For example, let's take the issuances in terms of AAA and let's say AA. I'm just talking about broader picture here. So the volume wise, AAA is the largest, and then as in terms of issuers wise, AA is the largest. So, but how are they being able to pick it up by the various segments equally? Like some of the discussions which happened earlier were certain policies are hindering, certain policies of investment policies are hindering, some of the objectives, lack of products are hindering. So there is a clear-cut mandate for all of us together to work on these three ecosystems: issuers and investors and the regulatory enablers, market infrastructure put together. I would rather put it into an acronym which I coined for this panel: EAST. So you need to work on the EAST. First, E represents the ease of access, expanding markets, whatever you may call. So ease of access, that means like entry, exit, liquidity, partial credit enhancement, all the confidence build measures from both the sides, whether investors seek what kind of a confidence, issuers seek what kind of a comfort. These issues are all grouped under the first E of ease of access. And under that, some of these steps which have already been mentioned, like for example, one of the biggest considerations which we struggle is, how do I exit in case of a need? Or how do I have access to my liquidity in case of what I need, either temporary or permanent, whether I will be able to sell or whether I have to borrow. Here, there have been some steps taken as mentioned earlier. The AMC repo, though repo is already been there for quite some time, but corporate bond report did not pick up. FIMDA provided the first platform of FTRAC for reporting providing the trades on repo. But the real enabler has come in the regulator-supported initiative AMC repo, which is a nascent stage right now, but it will provide an answer, because the tri-party repo with a guaranteed settlement would be the answer for providing liquidity. The second aspect is, of course, the market making. So the liquidity I'm touching about. There are several initiatives in discussion with at the regulators level about how to provide market making. And then I think in the morning there was a mention of NaBFID providing that foil as well, if possible. So that is one thing. And the second part is awareness. how do we bring awareness? Awareness in terms of issuers, issuer community easily accepting, coming to the bond market rather than the existing loan market, or the investor community being able to understand the bond nuances and then feel comfortable about the entry, exit, risk management thereof. So this third one is standardization. If you look at the complexity of the instruments, 40,000 ISINs are outstanding right now. And 40,000 outstanding, 37,000 odd. That means around 4,000 issuers. If you put it across, then there will be 8 per issuer on an average, 8 or 9. So how an investor would understand the complexities and then make a issue? Institutional investors fine, but slightly lesser level. So how do you make them? So standardization has been in the works for quite some time, but it still discussions are on. Like now, probably the level of face value has been reduced to 10,000 privately placed and all that. Some initiatives are there, but lot has to be done on the lines of government securities market that we have. Last one, but not least, use of technology. And I think this is one very understated piece in terms of currently what ails in the market is information, you say access, everything can be sorted out by a vibrant presence of technology. I think fintech market has been able to do something on the loan side with the financing banks, etc. But I think the presence in the bond market side is still building up right now. There are some platforms coming up and then some other, but then a huge canvas is available. Probably regulators can adopt a sandbox model and then build in what needed technologies in terms of data, information, analysis, everything in an integrated manner. These are the things I think are very much important for us.
Thank you. Very well actually put with the acronym. Let me move to a perspective from an international investor and international bank, Prathamesh. From your perspective, when you look at the corporate bond market and you compare that with markets in other region as well, and you speak to international investors, so what is that missing? Like, what are the building blocks and how do you see the development of corporate bond?
Thanks, Nitin. First of all, thanks to NaBFID for organizing such a great event and inviting me for this. So Nitin, before I get into the, how investors are looking at it, you have been debating about this, of whether we are develop a corporate market or not. To my mind, it's a journey. It's not a destination, right? Again, I guess all the participants in the market, whether it is regulator, whether it is intermediate like us, borrowers, investors, for all of us, it's an evolving journey. So first, I think we need, as a market participant, we need to accept that, including, like all of us. When I see the size of the market in a context of how international investors look at it, look, international investors have only two access routes to the corporate bond market right now. One, which is obviously the FPI route, which, kudos to the regulators for coming out with the VRR route and enabling that access, very efficient for the international investors. And the very much boom that we have seen in private credit market over the last 2-3 years, thanks to the efforts which SEBI put in, in the earlier part of this particular era. The other route is obviously the ECB route, which is external commercial borrowing. Right now, obviously that route, if you see in the context of the bond market, like last year, given because where the rates were, given where the, the pricing, etc. were, we saw only $5 to $6 billion of issuances out of India. In the context of the developed market, like US itself, annually, very easily touches $1 trillion. Right? Vis-a-vis that, the largest volume coming out of India I have seen in last 15 years is $24 billion back in 2021. That's the highest that I have seen. So if you see, the comparison and the access route that international investors want to access the onshore India credit is they don't have much supply. Now, why we don't have much supply? There could be various reasons, and I'm sure we will get into those debates when the discussion moves forward. But from an international investor's perspective, the easier access that they have, and given that they have only these two routes, one is a FPI route and the other one is a ECB route, it's very important for them and for regulators and for intermediaries to understand how we make them more efficient so that more international capital comes into it. So, one thing we need to acknowledge, Nitin, that, the kind of growth aspirations that we have, it is but imperative that, our access to the capital markets, both onshore and offshore, is a must. right? The Indian banking sector, they have done a tremendous job over the years, giving access to the liquidity to the local corporates. But the numbers that we are talking about, we heard about the infrastructure spend in the previous panel. The numbers are just staggering, and that need is not going to get satisfied only with the domestic banking channel. You need to have the domestic capital market and international capital market to pull that, because I think someone made a very valid point. It's a patient capital. That's what the capital investors bring to the table.
Thank you. So that's a good perspective from the international side. So, more got added to my list of summarization. Now let's move to the domestic investors. Where you talk to both retail and institutional investors. So when you look at the corporate bond market, and you have been looking for quite some time, what do you think are the missing links where you say that, I wish if this get done, I think more or less we are there?
First of all, thank you, NaBFID, for inviting me for such an event. Great pleasure. And thank you so much. I think a lot has been covered in the Bloomberg presentation by Fatima on what has happened over the last 2-3 years in corporate debt market. And at the cost of repetition, I'll just say the central bank IBC piece was, I think, the most important piece for most of the international or domestic investor to come for private credit. The openness to do CDS, ensuring the AMC repo and the strip comes in the place. I think these are the beginning of a very long-term debt market. Today, we are sitting on a space where we have the highest reserves, what we had. We have a relatively steady currency. So you are a huge infrastructure spend. So you are obviously becoming a darling of a lot of investor for people to start observing this market. We've seen SEBI also taken a lot of steps, like to start with DVP. Then we've seen EBP. We've seen RFQ, we've seen ease of doing in public issuances, OBPP recognition. So these, and I think a combined step of AMC repo, though it is in a very stage of preliminary time. I mean, we've seen the daily volumes from 50 crore now probably to 600 to 800 crores daily, will go a long way. So I think a lot of steps have been taken to ensure that the new market which is coming, and even the trustee regulations by SEBI, ensuring the security creation is also very strong, will go a long way in how an investor will look at it. So when Mr. Rao did mention that this is a developed market, I think a lot has happened for a AAA issuer to come to the market and the institutional investor who were already there to look at this market. But the whole idea is that, when you go to the bond market, you want to disintermediate banking participation and get more investors, which could be family office, corporate, pension funds, and others. I think that is where a lot of improvement and a lot of steps could be taken, while we have seen a frontline regulators who have to do a lot of changes. Just go back to the discussion of InvITs today, even in the 4 years, I think we've seen more than 5 lakh crore of InvITs happening. And more than 40% of the investment has happened by the overseas pension funds. Today, our pension size is almost 30 lakh crore, and so are our insurance size. So, we are actually comparable to the international investor, but our participation has not happened because some of the regulations have not changed. So I think the speed of regulations on insurance and pensions is very important. We are also seeing 90% of the issuances by more than AA plus entity. I think if this had to change, because the number of companies which are below AA are probably much, much, much higher. So I think the long-term investor issuance change. Another data is total, individual or total investor in a debt market would be close to not more than 1 lakh crore, more than 1 lakh investor, whereas mutual fund and equity is saying more than 20 crore investors. So it is very important to get that investors in place. And for that, I think we need an infrastructure. One, the liquidity. So AMC repo or any repo platform should allow every kind of investor to have the liquidity. Second, access to information and access to market. Today, bond market, apart from public issue, which is not more than 1-2% of the total market, does not have an ability for investor to reach out to that market. And since market is fragmented to some portion could be direct and some portion could be indirect, I think the quality intermediaries are not yet there who could probably cater to the full scale. So I think you have seen a huge financial inclusion which has happened. penetration of digital participation is there across investor class. And I think a lot has been done by regulator in terms of ensuring the seamless information and standardization has happened. I think steps are absolutely in right direction. I think equity-like settlements will go a long way for a corporate bond market. Thank you.
Thank you for giving that perspective. So you talked about easy access, the digital access to the corporate bond market. I think, Jitendraji, that's what your platform focus on, providing that last mile connectivity through digital for the retail investors. And that's one of the things people are also looking at, how do we actually get them. So what are you seeing that the roadblocks, if we remove, I think you will feel comfortable to what Pramodji said, yes, we are actually a developed corporate bond market.
Thank you, NaBFID, for giving an opportunity. And what Mr. Rao said is very rightly, we are developing or developed. But as Mr. said, that it's a journey. But I would say if I look back 4 years back or 5 years back, yes, we are developing. And a lot of change has happened into the corporate bond market. Earlier, it was been considered that the bond market is only made for a wholesale player. And retail doesn't look at it. Even retail does not have access to it. And there are two reasons. Number one, earlier the price discovery was not there. After the OBPP and couple of platforms has come up, the price discovery has come. Because earlier what has happened, whosoever buys and whatever buys, he has always have a fear, am I buying at right price or not? So that gives him a constraint from coming to the market. Now today is very sure that I am buying at a right price, I had compared with others, I am comparing with what wholesale players are there and compared to that I am pricing. So that is one thing. Second thing, there is no settlement risk. So he or she does not have to depend on whom he is buying or from where he is buying. All settlements are taking place through the exchanges. That also made them very confident that whatever I am doing is very perfect here. So these are two things has come up. Third thing, as Nipa said, is the market has yet to develop. Unlike equity market, people, yes, we have to reach out to the people. We have to make sure that bond sahi hai. And this is one of the product which one should add into their portfolio. See, today equity market is booming. So definitely everybody is jumping on it. But today's young investors and young people are very smart. They also are equally concerned about their side income or consistent income. So whatever they are making money or profit making out of their investment in equity, they would like to put it for the fixed income. And for that matter, they would like to look at the bond market. So once that will be there, the things are coming. As far as roadblock is concerned, yes, we have to be very careful that no island effects or something should happen. So credit enhancement should be there or something should be there. Because in India, we have a mentality, once accident should happen, we all refrain from traveling to that road. So we all have to be very, very careful that such kind of an accident should not happen. And before that, we should have some system which should give early signals. Because as a retail, we always tell that anything and everything you get more than FD has coming with some risk. And the important part of the people or intermediaries to convey that risk to them. So there should not be any accident or there should not be any surprise to them. Because they should understand, yes, anything more than FD I'm getting, there is some little risk. I don't say there is a risk-free. There is risk because you are buying AAA, AA minus, and as we all say, why BBB rating or lower rate rating bonds are not trading? Because of that only fear. If we address that fear, and if we address that fear very well, the people are ready to jump in. Because how a retail, why do you want that I should get more? If he is getting 6% in bank FD and 9% in bond, it's nothing but a 50% increase in their income without doing anything. So they will definitely love to do it so. Only thing as a regulator, as an intermediary, as the other thing, we have to make sure that these things should be addressed. And I'm sure if we address it, India has a huge potential. We have not even done even journey of 10%. See, even outstanding today, I have data that 1 crore people has invested once in a bonds, not their regular investors, but they have invested one. But today, if you say the trading is very less, and if you compare with the mutual fund data or equity data, these numbers can be 10 times, 20 times, and we can easily do it. So even people will definitely think once, before going for a bank FD, they will think what are bonds available. If that stage will come, if that confidence will come, I think India does not have to look back at anything, and the bond market will be fully developed that time. Thank you.
Thank you. So let me kind of summarize the discussion we had. Then we come to the next step as to which are the areas we want to focus on. So when we talk about the the India corporate bond stack, so essentially we are looking at like 3 pillars to it. One is on the supply side, the issuers, and then you have the demand side with the investors. Over there we have like 3 elements over there: institutional, domestic, international investors, and the retail. And the third part, which Anup talked about, is also the product innovation. How do we actually make it compelling for people to look at corporate bonds, which they're not very comfortable to look at that. I think what Pramodji said, if I have to just reflect, the regulators have created a framework to start operating, but what we have discovered is that yes, people are coming, but the diversity is what is required. Because there's a concentration of issuers, concentration of investors, and that's what we need to figure out in the stage 2, how do we actually expand on that? I think we have done quite well in terms of the milestone. The first phase is done. The regulatory framework is created. The top guys who actually have to take the lead has come. Now the second stage needs to actually happen over there. So if we actually pick up, say, 3 key themes, how do we expand the issuers or, improve liquidity or the product innovation? So what I'll do is, ma'am, I'll start with you. If you can pick up any 1 or 2 and take like say 2 minutes, because we have like 8 minutes to complete the whole conversation to keep with above time. So what will that 1 or 2 ideas will be for us to address one of these challenges?
So the ideas, I think we have been talking since morning before we actually entered this panel discussion. So I think we said, 75% of the space is taken over by NBFCs for the bond raising. So why so? Because they are, mostly they get a AAA rating and they are balance sheet funding. So what about those other issuers who have a project funding, who doesn't have a balance sheet kind of a funding? So they do not get a, kind of a AAA kind of a rating. Initially, greenfield, of course, we are seeing the banks are doing it. But after the greenfield has happened, the project has started, the steady revenue streams. Is it the time for it to move to the bond market? Of course, when we look at the stability of the market and, it is very initial phase of that market to start, I think that stability is required. So if those products are moving to the market, this, partial credit enhancement, what we have been talking about since morning, that becomes very, very important. Both from the perspective of the issuer, number one, he gets a chance to get upgraded. From the investor side, I think when we are talking about whether they are looking at a market risk or a credit risk, I think market risk they are not looking at, because most of the investors we have in the market today, they take it to their HTM category. So they are not really worried about the market risk, but the credit risk is something they are really worried about. So that credit risk also, in case an intermediary like NaBFID comes and says, okay, I'm enhancing, I'm taking the first loss guarantee, I think that will boost the confidence of the industry at large. So this is one product which will be very, very powerful for the market to start developing. Second is, we have been talking about information transparency or the trust of the data what is available. Equity market, we have seen, there are hordes of analysts who are coming up with the, kind of reports, whatever we see. So, investor is flooded with the information on that. What about the information on the bond markets? From the infrastructure perspective, we are already talking about creating a data repository. That is again going to be a very, very powerful tool which will talk about the industry, the project, the groups who are coming into, and maybe it may be able to throw up some of the analytics also, which can be picked up by the analyst, and then, the information can go in a very steady manner to the, coupled with the fact that, of course, since we will have our stake in that, lendings, we will definitely be monitoring those projects very, very carefully. And third thing which, comes to my mind is whether the banking sector needs to, get up and look at the corporate bond market in a different manner. So far, they had not been investing in that corporate bonds, looking at their market risk which is coming. Of course, they are very comfortable with the credit risk. They know every project, they know every promoter, so they are very, very comfortable with the credit risk. But market risk was something which was holding them back. So the new regulations of Reserve Bank of India, which is talking about, asset investment classifications in a different manner, which allows them to take it to the HTM category. Coupled with the fact that they're really strained for the low-cost deposits now. They're coming up with the infra bonds in a big manner. Infra bonds is helping them to address their LCR requirements also, which are in the draft stage, given that it will be increasing a lot of, taking a lot of their liquidity. So whether they need to look at it in a different perspective. They are raising bonds, long-term bonds for the infra, fixed rate. Do they need the fixed returns, or they still want to work on their MCLRs, which is getting reset every 6 months, 3 months, 1 year, whatever they are talking about. So I think this will also be a very, very powerful tool to, for this market to develop if these three things start happening.
Thanks a lot for that. Let's move to the insurance side. Which one will you pick up to focus?
No, so if you really look at two largest innovations that has happened in the last 2 decades, one is InvIT REITs and the second is the securitization market. And in both, one thing which is common is that there is pooling of risk. Because unless you are pooling of risk, you will not be able to bring down the capital requirement, you will not be able to do the credit enhancement part. Once you do pooling of risk, that is where the corporate bond market should start to move. Because then on one-to-one basis, you may not be able to pick up the bond, but you can do a derivative of it and you can pick up. The second thing that is important, from an insurance and long-term perspective is that we must recognize that as the economy is getting financialized, you will have liability generators in the market who are distinct from asset generators in the market. When the economy is developing, you have both. So banks today are liability generators. They are also asset generators in the market, and they hold both of them. If you really go overseas and if you see the movement, pension funds, insurance companies, they're all long-term liability generators. They are not asset generators. And regulators, because of financial stability, they will not allow them to play the asset side and the credit risk side. Then you have other players who will be asset generators in the market, predominantly asset generators in the market, and they will generate assets, they understand the credit risk, they will cut the credit risk, keep it to themselves, and they will securitize the asset part and take it out of the balance sheet and then recycle the asset part. If you see in the US also, the whole thing about Fannie Mae and Freddie Mae was essentially that banks would originate assets and they will take it, and thus reserve money also gets created and deposits also get created. In the next 10 years, the same thing we are going to see in India. This whole thing about deposit and this pressure of this is essentially, the tension is around this. This is really the LOC of liability generator and asset generator, and that is the game that one should play. Then if you look at the other long-term issues, the reason is that none of the long-term infrastructure standalone asset will ever get AAA. They cannot get AAA because of the long-term nature. And so if they are getting A+, naturally, as ma'am said, the supply of that, the demand for that will be, so there will be a latent supply of that, but it will never be an explicit supply because the demand will never come for that. And that is where the pooling will be an important thing, and partial credit enhancement will be different. So again, I'm just coming back to that the credit, the risk part, the credit risk part has to be tackled independent of the liquidity and duration. Okay, liability generators will bring different kinds of liability profiles. They require different kinds of assets, which you can create through either strips, because all of us have to do cash flow hedging. We don't have to do duration hedging, because we are not trading. So in the cash flow hedging, you require more and more zero coupon bonds of different kinds, and not duration, because convexity then hits us. And thus, these kind of products, I'm sure, will come up, and the faster we recognize that liability generator and asset generators will be two different kind of institutions which will develop, and there will be NaBFID kind of people who will essentially orchestrate this game. I think that's where I see next 10, 15 years really developing deeply, and will really move from Pramod's developing to developed, hopefully.
I think we are making a very good, headway in terms of building the second layer of development. The first is done, as Pramod said in the morning. So I think we got two very good inputs. Let's quickly move to Ravindraji from your side.
No, as we have been discussing long term, like Mr. Anup mentioned about what would be future in terms of regulation. Coming back to current situation, now, how do we leverage the current enablers that are there in the system effectively? So that's where my focus would be. In a near term, for example, the credit part, which is not probably very well addressed, or if addressed, it can address both the investor side and issuer side expansion requirements by adequately addressing the credit risk monitoring part, but through either partial enhancement or by leveraging the credit derivatives that are available, that are made available by the regulators concerned. But it's a work in the process. Though Fatima was very skeptical about single bond, single name CDSs, but that's a beginning. In fact, from the 2012 to now, whatever are the the regulatory episodes, learnings from the earlier episodes, regulator has provided for various flexibilities on the CDS product can take off. And there is always a thinking in the regulator's mind that second phase can be more robust and probably more aggressive than what first phase permissions are. But we are yet to see first phase being taken up earnestly by the various parties. On the partial rate enhancement, I think a lot of enablers are being played. NaBFID can play a role, and also on the CDS also, NaBFID can play a role. But only NaBFID cannot address this issue. So this is a too large an issue for NaBFID alone to shoulder that responsibility and then can reach to the destination. So in short term also, we need longer term players who can take the risk on their book with writing of the CDSs or providing the partial rate enhancements to the segment that they cater to is very, very important in my opinion. That is the short term takeaway, and we need to act on that collectively. The second one is about what Ms. Kali also has mentioned, the integration and, the availability of a curated data with full of integrity about the monitoring, about the project, about the issuer, about the progress thereof, about the cash flows. All this needs a huge consolidation and then single source of information, like learning from, let's say, GSEC market. Leaving aside the credit, the information flow is very integrated and then available at the fingertips of the market, like CCL, etc. Though NSDL exchanges are working towards that, but single source of data, curated data, is very, very important at this stage. That's one thing which is very actionable for us.
Thank you, Pratham. So, the way I will look at it and I will link it is a supply in an international market versus demand in a domestic market. And I would like to link these two, because in my mind, both these market complement to each other. I talk in my opening remarks that the supply in the international bond market is very minuscule as compared to the size of our economy that we see, right? Now, how you enable more corporates, more issuers to go to the international market such that the crowding out effect in the domestic market happens. What I mean by that is, look, in the international market, there are certain size of corporates, certain minimum rating category, and certain size of funding can go to the international bond market. And any treasurer or any CFO, when he thinks about the borrowing cost, good thing is, for India, they have multiple avenues. And in their mind right now, when I talk to my clients, the international bond market comes as a last option because they have access to the local liquidity, which is quite cheap. How you make that access to the international capital a lot more efficient for these guys so that, for a long-term capital, like for example, ma'am talk about, once the project is commissioned, the takeout of that project finance has happened through the bond market. Like 10 years back, if you would have talked me about the amortizing project finance kind of a ball in the international market, one would have laughed. But we have already delivered that, from the India so far. So the way I think about it is that more people go in an international market, their reliance on the local market reduces that much. And I'm just, I'm hoping that drives the demand from the local investors to probably go down the grade, because we all know like 66% of the issuance is still happening in a AAA market. Now, how you make the international capital access a lot more efficient? I talk about our regulators has been quite pragmatic in coming up with a new regulation, in having amendments or relaxation in the ECB guidelines. I remember when they first came out with the size relaxation for a tenor in a 3-year bracket. That's what enabled the NBFC issuances back in 2019. More of such measures, like for example, one quickly comes to mind is for the INR refinancing. You have large assets which needs INR refinancing, and given the INR liquidity situation right now, can these guys go to the international market and get it refinanced? Right now, the regulation says the minimum tenure needs to be either 7-year and 10-year. Can we relax that so that more corporates go that side, and which will create a demand pool in the domestic market for a low rated credit? And before I end, just one on a lighter note, and Sir already talk about it. The education of the investors locally, the retail investors, is quite important. I'm not talking about the crowd over here. I'm assuming all of them are financial literate, and that's why they are here. But when I talk about, or when I think about my mom, my driver, the financial investment that they talk about, they don't think about the debt market right now. That's where the education is required, and that will probably lead to the growth of the market further. Thank you.
On Sahi, as you rightly said. So we'll just go into the elevator pitch mode, 1 minute each, to give your remarks quickly.
Sure, only 4-point answer. Product innovation, most important, and I think a single regulatory window to clear all new products for either pension, banking, or insurance, so that the speed of penetration is high. Easy access to market to all kind of participants, right from foreign to non-institutional to retail. Most important part for a vibrant market. Bhao Bhagwan hai, so you need a platform which actually gives an access of information in terms of pricing to everybody. And last and not the least is liquidity, liquidity, liquidity. It could be through repo platform, through market maker. I think these are fundamental issues for any market, given those two. You're saving 30 seconds.
Yeah, in fact, what says that requirement of a different kind of bond market. Like, right now the maximum is through NBFC. Somehow, if a mixture of bonds can come, the investor has options to invest in. Today they have an appetite for investing in something. Now their appetite is over. So they need various kind of an infrastructure bonds also. If that can happen, yes, there is a good scope for them to come in. Like I am saying that municipality bond, as NaBFID is trying a lot, and we are floating, I would like to say that my city, my bond. If that concept can come in, that person will have definitely as a huge confidence in his own city. And if start investing in his own city bond, I think that can be developed, that city by itself. So that kind of concept can be created. A lot of NRI inquiries are coming, but NRI does not have any true information about the Indian bond market. And if the system can be created, that a lot of foreign money coming into India, I think that will be the real development of the bond market. Because when new money will come in, then it will create a huge market demand, and their expectation also not that very high compared to the Indian people. So I think that can also create a market. Thank you very much.
Yeah. Thank you. So just let me quickly summarize, the India stack, which we actually talked about. I think the way I think for us to look at, it's a journey, as somebody rightly said. So we have achieved the first milestone of creating the framework where investors are able to come and issue bonds. The issuers are able to come, investors are able to come. The next journey is basically to expand the issuer base and the investor base. And also the most important thing is the product base, because that is the one which is going to drive people to come and make it easier for them to access the market. And that is what we need to actually focus on. And it's good that we have a large and influential organization like NaBFID has taken the mandate to develop the bond market. So hopefully, some of the things we discussed today will become as an input for you to focus on how do we take the second milestone. Hopefully when we come back the next time, we talk about what should be the third milestone, so that at least we know that we have developed and we are moving in the right direction. That's what we need to know. On that note, I think we did a fantastic job of keeping time to the time and getting people to the lunch. And I'm pretty confident that India Stack, we will be able to deliver on that as well. On that note, thanks to all on the panel. Thanks to NaBFID and everybody in the panel.
I would request all of you to please stay with me a moment longer as we take this and capture this beautiful memory. Ladies and gentlemen, we'd like to thank our incredible panelists and moderator for that insightful and engaging discussion. And I'm sure some of the keywords will stick with us: my city, my bonds, bonds sahi hai. So many of these innovative ideas that we've spoken about. Monica, would I request you to please give a small token of our appreciation to each of our panelists and moderator. Thank you so much for joining us, ladies and gentlemen. Yes, please give our panelists a big hand. Thank you so much. A big hand for our moderator as well, Mr. Jaiswal. Thank you so much. Ladies and gentlemen, I'm sure all of you are as famished as we are. We've got the knowledge. We need some fuel for ourselves as well. So we'd like all of you to please join us for a networking lunch, which is right outside in the pre-function area. But request you to please join us back in 45 minutes after you've relaxed and recharged in this lunch break. Request everyone to please join us back in 45 minutes. Thank you.
कुछ बजाना जरा एक बार या
Check. 1, 2. Hey. Bag up. Check. Check. 1, 2. Hey, sound check. Check. 1, 2. Hey, sound check. 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 1, 2.
Sound check 1, 1, 1.
Yes, Amir sir, we can hear you.
1, 2, 3.
Hello. Is there anyone?
Check test. A very good afternoon, ladies and gentlemen, and welcome back after the lunch break. Requesting all our guests, speakers, attendees, everyone to please join us back in the hall. Everyone in the pre-function area, request you to please join us in the hall. Take a seat. We're ready to reconvene the conclave after this lunch break, requesting your presence in the hall. Thank you. Good afternoon, everyone. Welcome back, ladies and gentlemen, after the lunch break. I hope all of you had a refreshing break. I'm sure great conversations take a little more time than usual, but I'd request all of you to continue them during the next break. Request everyone to please take a seat. Can I request everyone in the room to kindly take a seat? And if everyone in the pre-function area can hear me, then this is a great time to join us back as we reconvene after the break. All right, we are excited to resume our program and continue with the energizing discussions and sessions we have planned for you for the rest of the day. So ladies and gentlemen, now we are ready for our third panel discussion of the day, focusing on the vital topic of green financing, climate risk, and transition financing. Our discussion will be presented by Mr. Rathin Kukreja, who is the Director at CRISIL Market Intelligence and Analytics. In his role, he heads the sustainability function at CRISIL on a pan-India basis. Rathin has overall 14 years of experience in energy, sustainability, and climate change, and has supported several corporates, financial institutions, government, and multilateral clients. His extensive experience of working on various facets of sustainability, such as developing ESG roadmaps, science-based decarbonization strategies, ESG reporting, ESG integration in supply chain, GHG emissions, climate risk assessment, life cycle assessment of products, energy management, etc. Ladies and gentlemen, please join me in welcoming Mr. Rathin. We could do warmer with the applause. We've got some energy after the break, isn't it? Thank you so much. A very warm welcome.
So very good afternoon to all of you. Hope everyone had an enjoyable lunch. Yeah, so I think this topic is of, I would say, cross-cutting in nature. It's getting a lot of traction and buzzword this year, climate risk, transition finance, and green finance. And when I say it is cross-cutting, it is applicable across sectors, across industries, irrespective of the size, that is large and small. So today what we will do is, just before the panel discussion wherein we invite the dignitaries to share their views about how this can be further accelerated as a part of India's nationally determined contributions as well as the net zero targets. We'll see a brief on the context setting, how this overall picture is poised, what are the key avenues that can be tapped upon, and then followed by the panel discussion. So I'll very quickly begin with a brief context setting. I think there was a lot of discussion in the morning panel about the growth of infrastructure sector in India. So while India plans to be a $7 trillion economy by 2030, and a lot of this is going to come from the infrastructure sector, and we plan to see a lot of investments, a lot of capex being put into this. Investments are expected to double, grow multifolds in subsequent years. And this is primarily driven by a lot of key enablers and focus led by improved credit rating portfolios, enhanced focus from the government, and increased access to bond market, and a lot of growing interest from the international investors. So in all, as the GDP grows, as we saw in the budget, nearly about 4% of GDP has been allocated as a part of the capex expenditure for this year's budget. So infrastructure sector seems to be, you can say, a kind of a paving stone for this economic transition. In the morning, we already had a lot of discussions going about the key schemes that the government has recently launched and how they have been a game changer. I think a lot of discussion was done on the kind of game-changing impact that the Gati Shakti scheme had. So it's what has happened is it has been a kind of a, you can say, a combination of schemes plus a lot of focus from the government on the financial side by launching institutions such as NaBFID, along with other infrastructure finance companies. There is a lot of focus now on making sure that there is an adequate focus not only from the policy side but also from the financing side. So I think this sets the context very clear that infrastructure obviously is important as a part of the economic growth. But with financing, what comes is also, you can say, risk. And when I say risk, climate risk today is at the center stage, right? Why it is at the center stage is because this is becoming real. That is, it is visible. We can see a lot of events which happens and wherein there is an impact. So as we talk about infrastructure financing and in particular green financing, it also has to be kind of done in conjunction with climate risk, how we can mitigate it, how we can adapt it. So I think some of us are already aware about a number of initiatives that have happened in last decade. We've seen India's, if I talk about from the green financing point of view, we've seen a lot of focus on the green side. It all started way back in 2015 when India's first green bond was raised, followed by social bond, then sustainability linked bond. And a lot of municipalities also on the local front have raised these bonds. So, and there are primarily two regulators. One is SEBI, that is the Securities and Exchange Board of India, and second is RBI, which are trying to drive the investments on the green financing on the policy front. Just, I think last month only, SEBI has extended the existing green securities framework to sustainable finance, that is adding the social, sustainable and sustainable linked framework also to that. RBI, as I said, they had launched the green deposit framework back in 2023, as a result of which large number of financial institutions has raised their green deposits. But that part, that is still voluntary in nature. So this is primarily, as I said, on the regulator front. Then coming to the climate risk part, because as I said, the investment and risk also have to go hand in hand. So on the climate risk part, some of us are already aware that RBI is a signatory to NGFS, that is Network for Greening Financial System, and they became a signatory in 2021, as a result of which we can see that a mandate was launched, which is, you can say, a draft mandate as on date, which is encouraging the financial institutions to focus on integrating climate risk in the credit appraisal process. So while typically when a bank lends, the more focus is there on the, you can say, other aspects of risk such as credit risk, liquidity risk, market risk, but climate risk is also something that the regulator has focused on. So what we can see here is that as a result of, say, a lot of regulatory and policy initiatives, while some of these are voluntary in nature, there is now a push coming from the regulators to kind of increase the focus on the green financing part, or I should rather now call it sustainable financing, and then parallelly on the climate risk piece as well. So as I said, India has steep targets in terms of NDCs, the 2030 target, the Panchamrit goals, followed by the net zero commitment of 2070. And these steep targets will require green finance. And as you can see here, the requirement here is multifold, about 29 trillion for 2030 in India, for India to achieve its NDC targets of, say, 45% reduction in the intensity and 500 gigawatt or 50% non-fossil fuel electricity generation. Then this target is even steeper, say if we have to go to 2070 net zero, wherein again close to 800 trillion of investment is expected to be made, and a bulk of which will be driven through infrastructure sector, primarily from the renewable energy, transport, urban development, and roads. So this is something, as I said, where the financial institutions can play a significant role, that is helping India meet its green commitments and targets. Then talking about the recent issuances and the trend in the local market as well as the global market, what we can see here is that yes, there is a lot of traction, but there are some interesting trends that we can see here. So as you can see here, while the green bond or the overall bond market was on the rise, there was a bit of, you can say, hold or a kind of a steady, I should say, due to, say, initially COVID and then geopolitical tensions due to, say, the war between Russia and Ukraine. But still, the market is expected to grow exponentially going forward till 2030 onwards. And what has been significant is the predominantly GSS market, when we say green, social, sustainable, and sustainability linked market, that has primarily been dominated by the green bonds. As you can see the trend here, not only just in India, globally also. The interesting trend in India is, even within green bonds, the bulk of the, bond issuances have happened in the renewable energy market. That is primarily on account of utility-based solar plants, wind-based plants. So that is where the more of the traction is there. Other segments, say social, sustainability-linked bonds, though have picked up, but the momentum has not been, say, very great. India is yet to issue a transition bond, while some of the global issuances have happened for bonds on the transition front. So transition bond is something that can pave the way for hard-to-abate sectors, say sectors such as cement, wherein we know that the levers are hard to abate, refinery, chemicals. So this is where transition financing can come in, wherein the financing is linked to a sustainability development target, or rather say a kind of a 1.5 degree pathway or a well below 2 degree pathway. So transition financing is something that is yet to begin in India, but we have seen some issuances that have happened globally. But overall, as I said, it's a promising side of story with regards to green bonds. But as I said, there's a lot of work that has to be done in sectors beyond, say, I would say renewable energy, as the bulk of the issuances have happened in this sector. Then I think this is a pretty interesting and yet a debatable subject, the greenium part, wherein sometimes we have seen at par issuances. When I say at par, that the investors, while globally what we have seen, they are willing to pay a greenium, that is a lower rate of interest while putting their capital or lending. But in India, that has not been the case. Obviously, it is just, say, 2 years. The first sovereign bond, which was launched in January 2023, the first tranche saw a greenium of around 6 basis points. But in the last fiscal, that is FY24, the average greenium was only 2 basis points for the tranches which were issued thereafter. So greenium is something that I think the Ministry of Finance has expressed its concerns that the yields are at par with the conventional part. But I think with the inclusion of India's government security index in the JP Morgan's emerging market index, I think that can pave the way, is what is expected, and ministry is expecting around $30 billion of fund getting pumped through the inclusion of this index, which has come in effect from June 2024. But overall, as I said, greenium is something that the investors typically are willing to pay for the environmental benefits of the projects. So one important point that that is also observant from the last slide and this one is a majority of the bonds that have been issued in India, they have been, or rather issued by Indian organizations, have been issued in, say, international currencies, right? So the US, the euros, sovereign bonds was a good initiator to have a rupee denominated bond, but most of the bonds globally issued by the Indian organizations, they have been in international currencies. We're yet to see these bonds being effectively raised by Indian entities in, say, in Indian currency, and the reasons and challenges is what we'll be discussing in the next slide. So moving on to the climate risk impacts, as I said, now the World Economic Forum has also mentioned that climate risk is one of the topmost risks that is expected to affect not only just the counterparties, but in turn the financial institutions as well, both in terms of likelihood of occurrence as well as the financial impact. And you can see here the 2-year and the 10-year forecasts
that has been given, it clearly states that the larger amount of risks are due to impacts of climate change. And because, as I said, when we are talking about investing and lending into infrastructure sector, the risks related to climate also have to be taken into account. And this is where the Reserve Bank of India did a pilot exercise in 2022, that is 2022, on 15 banks, combination of public, private and foreign banks, to assess the impact of credit loss, expected credit loss on the portfolio of the banks. While this was a pilot exercise done on selected sectors and subsectors, but the results, yes, they are alarming, but not very surprising as expected. Both physical risks and transitional risks, as you can see, the impact in near term and long term under different scenarios are touching up to three digits in terms of the percentages. And because RBI is now a signatory to NGFS, you can see the transition risk scenarios was done under the three scenarios of orderly world, disorderly world, and the hothouse world in the India event scenario. And as I said, both in near term as well as long term, transition risk is expected to have larger implications on the borrower. And of course, the physical risks, while flood and cyclones were the two risks which were assessed, the other risks such as water stress, temperature, precipitation are again expected to have this, have a substantial impact which can affect the, you can say, which can affect the credit loss. And as a result of which, RBI came out with a mandate on introducing climate risk as a part of the credit appraisal process, wherein stress-tested PDs and the LGDs will be used to assess the borrowers to start with. Then I think some of the challenges, while I already highlighted, but I think the major ones is that India is still awaiting for its taxonomy in place. I think the union budget announced last couple of months back also stressed the fact that Ministry of Finance is preparing the green taxonomy. RBI had released, you can say, a preliminary list of activities which needs to be considered as a part of the overall green financing framework, but we do not have a very detailed green taxonomy as it is applicable in some of the other geographies such as China, EU, wherein there are always concerns in the minds of investors on what is green. But this is something that the Ministry of Finance is currently working on, and of course, along with green, when we talk about sustainable finance, the social part also comes in. Then other challenges, obviously, what we saw on the greenium front is that the bond market or the green market is in a nascent phase, right? It is in the development phase, so we do not see a lot of greenium or the investors' interest to pay on the environmental attributes. Even the RBI, which had released the green deposits, kind of asked the financial institutions to keep the rate of interest same for the deposits, green deposits, as that of conventional deposits. So the bond market is a bit on the nascent stage. There are obviously concerns in primarily more from the international investors as well as some of the domestic investors on greenwashing, which I think primarily will get addressed when this taxonomy gets released. Then other part is the domination by sectors, which I said, while it is green, in green also it is primarily towards one particular sector, which is heavily dominated, renewables. We do expect that some of the other sectors would also start getting that traction as the hydrogen mission and the CBG projects gets kicked in. But as I said, because that is more capital intensive and there is more amount of capex involved, the past history says that is heavily favoring towards the renewable energy. So these are some of the challenges that we have seen based on the recent issuances on the green finance side. Talking about the challenges on the climate front, I think there are plenty of challenges on the climate front because this is a subject that has just kind of kicked in for the financial institutions in last couple of years, wherein RBI acknowledged the fact that climate risk is a systemic risk, and the main challenges involved are primarily on the data part, because the sustainability reporting started in India just a couple of years back. There is a lack of, say, transparent, validated data on account of energy, climate, and sustainability. Then there is a lot of, you can say, confusion around which scenarios to be used, which frameworks to be used, because there are multiple international frameworks are there. So we are expecting RBI to come up with guidelines on doing stress testing, how to compute the probability of default and LGD. So guidance framework is something which currently is not there, but is expected to be released shortly. Data part, scenario part, guidance part, and the biggest and important is the capacity building part, right? Because as I said, it is a nascent market. Not a lot of stakeholders are aware about how climate risk has to be read, how climate risk has to be taken into account in the lending part or the investment part. So that is where a lot of work has to be done as a part of this exercise, and it has to be done across stakeholders, not just the FI, but also the corporates, the smaller industries, other stakeholders who are involved in this particular exercise. So all in all, there are some challenges, and there is scope for kind of taking this forward by doing some certain initiatives. While we will hear from the panel today that what some of these initiatives can be taken on green financing or sustainable financing, as well as on climate risk. But primarily, some of these changes have to be done on the policy front. As I said, green taxonomy is something that the government is looking, focus on other sectors, that is sectors beyond renewables. Then in terms of higher disclosures, government mandates. So as I said, a lot of these things are still voluntary, at least the green financing part. So there is no mandate given to any of the AMCs, lenders, or insurance companies to go for, say, green financing. Mandates such as allotting a portion of your, say, fixed income investments in green side can go a long way in kind of further moving this and boosting this market. Mandates for AMCs, lenders. Then I think a lot of discussion was there in the morning session with regards to that a lot of these instruments are issued for top-rated companies, that is companies which have good credit ratings. So for the companies, say, where the ratings is not on a higher side, so this is where the first loss default guarantee structures can come in, right, wherein even smaller companies or mid-sized corporates can also get into the issuance part. So first loss default guarantee structures is not a new concept. RBI already has regulations given to this, but it has not got extended to the green financing market. Then obviously when investors, they pay greenium, so that has to be somewhat incentivized through certain initiatives. So tax incentives is something that can also be done. So these are some of the initiatives or policy structural changes that can be done to make this market foster further. But I think it will be interesting to hear from the panel as to what else can be done beyond this. So thank you everyone for patience learning, patience hearing, and look forward to an intriguing discussion from the panelists. Thank you.
Thank you so much, Mr. Kukreja, for setting the context for this discussion: green financing, climate risk, and transition financing. Ladies and gentlemen, this panel is further moderated by Mr. Rahul Prithyani. He heads consulting and research services for energy, commodities, and sustainability domains. He and his teams specialize in assignments supporting corporates for business planning, strategy formulation, market opportunity assessment, risk management, fundraise, and sustainability ESG strategy. He has spearheaded the launch of ESG and sustainability offerings in India for CRISIL. Ladies and gentlemen, please welcome our moderator, Mr. Rahul Prithyani. A very warm welcome to you. I'd like to take a moment to introduce and welcome our panelists. Ladies and gentlemen, we are honored to have our expert panel to delve into this critical subject. Please join me in welcoming Dr. Suneet Tyagi. He earned his PhD in Electrical Computer and Systems Engineering from Rensselaer Polytechnic Institute in Troy, New York, USA, where his research focused on developing indium phosphide solar cells for space applications. Before pursuing his doctorate, he worked on developing blue LEDs using zinc selenide. Currently, Dr. Tyagi is the Managing Director of InSolar Energy Private Limited, a leading solar energy systems integration company established in 2008. Under his leadership, InSolar has played a pivotal role in advancing the solar revolution in India with a strong emphasis on quality, discipline, and innovation. Before founding InSolar, Dr. Tyagi worked at Intel Corporation, where he led development of the first microprocessor entirely designed in India. Ladies and gentlemen, give a huge round of applause and welcome Dr. Suneet Tyagi. A very warm welcome to you, sir. On the panel, we are joined by Ms. Neha Kumar. She is the head for South Asia Climate Bonds Initiative and is based in Delhi. She drives policy, strategy, and partner programs on climate risks and sustainable financial ecosystem. Her efforts are targeted at building policy mechanisms, market infrastructure, and capacities needed to accelerate financing for green, just, and resilient transition in the region. Her current areas of focus include transition and resilience finance, the role of financial policy and regulation, and DFI and MDMZs. She serves on the committee of IFSCA and Niti Aayog on climate finance and has been on the Ministry of Finance Working Group on sustainable finance, taxonomy development, and international ESG standard setting bodies. Ladies and gentlemen, a huge round of applause. Very warm welcome, Ms. Neha Kumar. We're also joined on the panel by Mr. Sandeep Kumar, who has over 15 years of professional experience and leads climate and sustainability strategy at PwC. Sandeep has advised clients on integrating ESG into corporate strategy to drive business outcomes. Sandeep has also helped several funds, strategics, and public sector enterprises on clean energy investments and net zero pathways, advising on strategies for establishing climate funds. Ladies and gentlemen, a big round of applause for Mr. Sandeep Kumar. On the panel, we are also joined by Mr. Arjun Prasad, who is the General Manager at International Financial Services Centers Authority, Gift City, Gandhinagar. Mr. Prasad is in charge of the division dealing with primary markets at IFSCA. During the last 4 years at IFSCA, he has been involved in policy making in several areas in the capital markets, including listing regulations and capital market intermediaries regulation. Ladies and gentlemen, a big hand for Mr. Arjun Prasad. On the panel, we are also joined by Mr. B.S. Venkatesha. He has a rich banking experience of nearly 3 decades with primary focus in the specialized areas of foreign exchange, treasury, international banking, large corporate credit, and risk management. Currently, Mr. Venkatesha serves as Deputy Managing Director, Chief Risk Officer at NaBFID. At NaBFID, he oversees crucial areas such as risk management, information security, and more. Ladies and gentlemen, big hand.
Hi, good afternoon, everyone. Pleasure to be interacting with all of you and moderating this panel. And over the next 40 minutes or so, we'll look forward to kind of, active deliberations in this area. And as Ratan set the context, I think green finance, transition finance is going to be one key buzzword that we are going to be with for the next foreseeable future, and a lot to be done with respect to policy. So in that context, I would really like to extend warm welcome to all the panelists for sharing their wisdom on this dais. I'll just begin firstly with you, Suneet. How do you really see the overall market space really evolving, and where do you see the need? As we saw in the previous presentation with Ratan, I think today we've seen it's the RE segment. Do you really see it kind of widening, and what is going to drive to deepen this market going forward from a demand standpoint?
Thank you, NaBFID, for having me here, and really appreciate being on the podium with honored to be here. I just wanted to see whether there were some foils I had shared, maybe they could be shown. Okay. I just wanted to say that we hear about
India and China now being one of the biggest emitters, and therefore being asked to do something about it. I know it's difficult for us to see here, but no, they're not showing. If you go to the next foil, please, the thing to note is, on a per capita basis, on the left is the GDP, and it's been growing. It's been growing faster for China than for us. But also on the right is the per capita carbon dioxide emission. It's been growing. It grew quickly for China. We are significantly lower, and this is a log scale. So the reason to point this out is, as a per capita, we are significantly low, but thanks to our population, we are one of the biggest emitters, and we are one of the biggest sufferers going forward. So it's imperative that we address this issue. Going to the next foil, please. One thing to look at is emission efficiency, if you will, in terms of how many dollars do you really create for every kilogram of CO2 you do. We are the yellow or reddish, orangish color down there. We are at something like 0.35, while it has been coming down for the rest of the developed countries. Let me point out that biggest emission, as was pointed out by earlier, is in the hard-to-abate sector, the cement, the steel, the hard infrastructure. So when US built it in 1950s, that's where their emission intensity was high. Now, when we are building it today, we would have to have higher intensity, but we are going to be pushed to reduce the emissions. What is shown on the, this is fine. What is shown on the right is a historical per capita GDP with respect to GDP per capita down there. All civilizations went up this path. They emitted significantly to grow into the place they are. We are starting in the orange. We are going to be asked to come to net zero. And the point to make here is, typically emissions increase when the GDP increases. Now with net zero, we have the conundrum of reducing emission while we still want to increase our GDP. And that is the last foil here, which is stating the, on a trend, in a historical trend standpoint. We have never seen this happen before. And the net zero is at a slope which has never been achieved anywhere. One thing to note here is UK touts itself as being improving the efficiencies or reducing the emissions, but that is when they moved away from coal to wind and other places. We have got to be facing this challenge of reducing all kind of emissions while we still have aspirations to grow into a rich country. This is our challenge, and this is where, how do we finance this, how do we make it happen, is the part which I would love to hear from most of the others. So I'm setting the context. I'm the guy who will send you the DPR and you have to approve it. This is what I'm trying to do. I'll stop there.
Well said, Suneet. So moving on, Neha, coming to you, I think we've seen big picture numbers. How do you see it really manifesting on the ground in terms of areas, segments, which need to grow and which, for whom this may be a very viable option from a demand standpoint? Just wanted your views, and how do you see it panning out, and if there are any global parallels that you can draw?
Sure, thank you, Rahul. And Ratin did a wonderful job of setting the context. I don't have to repeat those numbers, but I will keep on going to some of those numbers that you presented to tell you a little bit more, probably add a little bit more texture. Before I come to answering your question, I do want to add to the big picture. When you said that this is nothing like that we have seen before, you're absolutely right. It is now, I mean, by various calculations, wherever you would see, if we remain or try to remain under 2 degrees Celsius, the GDP impact of climate change will still be nearly 5.7% of GDP. Okay, and if we breach it, which is probably what we are on track for, then it will go up to 38.5% of GDP. So what we are seeing is not in the future, we are actually sitting on something that we have to deal with. Now, infrastructure, why we are gathered today is, in the morning we said, Mr. Rao made the comment that it's not simply infrastructure, it is green infrastructure because everything is interconnected. So how our economy grows is actually embedded in how we make the infrastructure, and it's a huge opportunity because most of the infrastructure is still to be built out. Retrofitting your infrastructure towards resilience, towards being green, towards being, as low in emissions is much more of a cost. So I think it's such a huge opportunity. So people who are sitting in this room post-lunch with all their ears and eyes open are actually looking into the future. So this is absolutely not a peripheral subject when we talk about even hard numbers and hard financing numbers. Why do I say, and there were, I was listening to all of the speakers, and I wanted to attach climate to every comment. And I said, yeah, we talk about this even in our climate discussions. Because fundamentally, we are talking about finance flows. Fundamentally, we are talking about demand. Fundamentally, we are talking about how to create supply of that finance to meet that demand, or even to create some demand. You need to have some supply of finance to begin with. Globally, this demand exists, and this has been driven by investors. In the last 10 years, there has been 100x growth in the green bond issuances and other types of bond issuances globally, standing today at $4.3 trillion and growing. Climate bonds looks at all of these numbers, actually works on the integrity of the market so that the market can grow, and works on policy, etc. Last year alone, the issuances touched $1 trillion, right? So this cannot happen without advantages being actually accrued on both sides, whether that's investor or that's issuer. It is not a good thing happening. It is something which is absolutely directed by the kind of risks that investor now have started looking at their portfolios going into the future. Everything is about planning for the future, and hence they're investing now. What do issuers gain out of it? There was, Ratin, you talked about greenium in your slide, and I will come to that a bit later, but the preferential capital exists in large quantum. We are talking about, out of $130 trillion of global bond markets, nearly $50 trillion committed to climate and green. So this is preferential capital. So it's absolutely critical that we understand this. Do you know the size of green economy by 2050 would be $10.3 trillion at par with fossil fuel economy? Okay, so there is a lot of money to be made. Green finance industry is going to contribute to your GDP in increasing ways. So there is a lot of money to be made, not only for your domestic priorities, but also for export. So we are really talking about economic opportunities. What we are seeing, both globally and in India, it is actually somewhat mirroring. Renewable energy was the first one to go out. Now it is utility plus storage, okay? Transport, buildings, these are some things that are now in the global market is looking at. And we're also seeing some diversification in India. It is definitely a lot more has to be done. But what I would say, Rahul, before I answer your further questions maybe in the coming rounds, that India is at such an amazing inflection point right now. If it doesn't do something in time and fast, then there is a lot of cost to be paid. The challenge before us and the opportunity before us is swiftly harnessing the successes that we've already had. Sovereign green bond issuance was a huge success. You may say 6 basis points is for a sovereign, what does it even mean? A Ministry of Finance may say that, the sovereign, when it issues, it not only issues for greenium, even though we got a greenium in
adverse conditions of high interest rates, local currency, foreign investors investing in local currency. These are not general conditions. Most of the bonds have been issued in USD, right? Despite that, we got a 6 basis point, right? And now it is beginning. It is, you know, a lot more has to be done. What I would say, targeted investor outreach, whether that's domestic, or international, has to be done, because without that you will not be even able to have the predictability for the investor that there are pipelines, that, you know, so that bit I think we have to improve by leaps and bounds, because we have been contacted by investors and they said, very interestingly on sovereign, they said that, oh, it went off too quickly, do you know what the plans are? The other one said, it did not entirely meet my internal green bond guidelines. And these are international investors. So there is something out there that investors are looking for. They're not only looking for green, they're looking for robust green. And we have to, you know, we are in that space now. I think we can build that market infrastructure, but we really need to start connecting dots and start stacking our successes, because 2-year roll 6 basis points, if you do not you know, swiftly harness on the gains, then 2 years hence you have to go back to the scratch and do the same thing again, right?
Absolutely, Neha. I'll come back to how it will be done. So, yeah. Sandeep, moving on to you, I think you work with a lot of clients, corporates, and how are they looking at this entire space in terms of opportunity to raise capital, and how are they internally gearing up to kind of address this opportunity that might be there, and there's a need per se given the large size investment?
Yeah. So thanks, Rahul, for the question, and excellent context that was set. So essentially, if I talk about the corporate ecosystem, and I would have, you know, we would have worked with almost 400 of them in the last 3 years, broadly they will fall in 2 categories. The ones that are more active, the active corporate set, they understand that this entire concept of climate and sustainability, it is not just talking about the impact of the corporate on the environment and society, but it's also about their business dependencies on these factors. And because they recognize both the impact and dependencies, they realize that there is an element of risk management and an element of business opportunity for each one of them to leverage. And once that's the mindset that is there, then obviously your way of looking at investments will change. So I think that's one category of corporates that we encounter. The second, obviously, they work predominantly because either there is a regulatory push, or they might be working because there is an investor or a customer push. So for them, it's all about impact, and hence the focus would be to look at, okay, which are those investment spaces, maybe something like renewable, which is you know, good ROI today, market is matured, regulations are positive, and hence can I go and get that, and get basically and invest in those you know, projects. The focus on sustainable capital, what we have really seen is more from the category 1 investors, right? Because the category 1 investors are the ones that are not just looking at those low-hanging fruits of renewable, but they're also exploring, can I invest in logistic changes, which are today expensive? Can I make changes to materials and chemistry? It's a massive space, and you talked about sectors, right? Without change in chemistry and materials, we cannot achieve net zero. So they are looking at those aspects, and those aspects are expensive. And so how do they make it you know, something that can be investable? Yes, the corporates will probably demand a lower ROI, but they're also looking at support from financing ecosystem. They're exploring if that there is a carbon market that is established through which they can get some additional money. They're looking at consumer ecosystem, that is it something that consumer ecosystem can pay more? Is there certain tariff or non-tariff incentives that can be leveraged on from the government? So when they look at sustainable finance, it's about looking at this entire ecosystem of financing, and hence ensuring what are my products, who are my investors, what kind of markets I can tap in to get the sustainable finance to make this project, which otherwise would not have been viable in monetary terms, to really make it viable.
The second category is obviously more focused on, can I get an interest rate BIPs, make it more profitable for me? So I think that's the kind of ecosystem we have seen evolving. But what is very interesting is that traditional wisdom will say that it's probably the top 20 business houses which fall within that category 1. True, but also we do see a lot of these startup ecosystem, a lot of the Gen Z entrepreneurs who are picking up businesses are really more aware, more climate conscious, and hence they would probably fall within that category. So just quick summary to that. And if I have another 30 seconds more, very interesting concept that you showed about India and other countries. In fact, not many people know that the concept of environment impact was established way back in 1960 through a mathematical equation. Most of you know it about I is equal to KCT. The equation basically tells us, without getting into the mathematics of it, that with population growth and affluence growth, there will be impact on environment. You cannot stop it, right? So affluence growth would be something like US, population growth is where we stand, right? So we are part of the problem. However, there is a balancing act, and the balancing act comes through K, or what is popularly called as technology. So through technology, it is possible to actually reverse that curve and become more sustainable. So thanks, Rahul, for that question.
Definitely, we are banking on it. And I spoke to one of the CEOs, and his comment was, it is not if and when. This is like my license to do business. So I better invest, otherwise it doesn't work. So Arjun, moving on to you, just from your perspective, I would want to also understand your thoughts. I know, IFSC has got big plans in terms of developing the overall bond markets, and as of now, I think most of the issuances that we have seen, they have been in the overseas markets. How do you see the entire ecosystem at IFSC developing, and what are the plans here?
Thanks for this question, and thanks to NaBFID for having a wonderful event and inviting me on this panel discussion. So before I go to the specific question on the plan for green bond, let me set the context on why Gift City, what is our objective, what is our role. So the concept of Gift City, the IFSC started in 2015. So there are two main objectives. So the first thing is, there are many India-oriented businesses which are actually happening from various parts of the world. So can we have an international center within India where we can onshore those India-related activities from those countries and bring it back to India? For example, there are funds which are set up in various parts of the world. If I can name them, Mauritius, Cayman, Ireland, Singapore, many countries. So can we have an international center where we bring back India-related business in our shore? That is the first objective. The second is, can we become the gateway for various foreign capital into India? So that is which is very, very relevant for sustainable finance. We need foreign capital, and not just sustainable finance. Currently, we are the fastest growing economy in the world amongst the large economy, and we have already crossed 4 trillion. And in the last 10 years, if we see, from 10th largest economy, we are now 5th largest. Very soon we'll be 3rd largest economy. And with the vision of Viksit Bharat, there are projections that probably will reach $55 trillion by 2047. So from 4 trillion to $55 trillion, it's a huge jump. So we need foreign capital, and that is where Gift City or IFSC will play an important role to get foreign capital to here. Coming to the specific question on sustainable finance, so we have, that is one of the most important priority for us as a regulator. So when we were set up in 2020, we took several steps in this direction. The first thing which we did is the listing regulations, which is in 2021. And we have come out with the framework for listing of green bonds, social bonds, sustainable bonds, and sustainability linked bonds. And the exchanges were set up in 2017. We are having 2 international exchanges, India International Exchange, subsidiary of BSE, and NSE International Exchange, subsidiary of NSE. So total listing of bonds on our exchanges, it's close to $60 billion, and out of which ESG labeled
bonds, $13 billion. So it's a significant amount. So we have a good amount of listing on the ESG space. And in fact, we have listing of all the 4 categories on our exchange. So $7 billion is green, around $3 billion social, close to $2 billion on sustainable, and even SLBs are listed. 2 SLBs are listed on our exchanges, around $700 billion. So that is the first thing which we have done. Currently, we are working on, I saw a very nice presentation on the need for transition bonds. So there are hard to abate sectors, iron and steel, cement. So we are working on the framework for transition bonds. So an expert committee was there constituted. So they have given a recommendation. We'll be coming out with our consultation paper very soon on transition bonds to finance those sectors which are otherwise not falling under the definition of green or sustainable. So the other thing which we have done, since we are even a unified regulator, is in the banking space. So we have close to 30 banks, and out of which around 15 Indian banks and around 14, 15 foreign banks from American banks, European banks, banks from Singapore, Japan, many parts of the world, Australia, they have set up. So we have, I think the presentation mentioned about mandate. So we as a regulator have mandated all the banks set up in IFSC to have a board-approved policy for sustainable lending. And from last financial year onwards, we have mandated 5% of their lending for sustainable related activities. So in fact, last financial year, we had $1.5 billion lending by banks on the ESG space. The third aspect which we are doing is on the fund management. Last 2 years, we have seen several funds set up here, mostly inbound funds, so close to 150 schemes are there in IFSC, and it's growing very fast. So every month we have several funds being set up for various strategies. So we have come out with our guidelines on ESG schemes. So in case you want to use proceeds for such projects, we have a detailed guidelines in terms of disclosures, labeling, and we have gone through the IOSCO's principles. They have report on ESG schemes. In fact, there is one fund with targeted corpus of $1 billion, which has already been set up in IFSC. So that is something which is coming up very fast. So these are the largely what we have done. And as a regulator, our next step is also, to address if there are any concerns on greenwashing. Can we make it more stricter in terms of to build the investor confidence for making huge investments in this space? So I'll like to pause here. So we have bonds, funds, and banking space.
Sure, I think quite interesting perspectives, and clearly, given till the Indian market picks up, I think probably IFSC will probably have a significant role going forward. Mr. Venkatesh, from now I would like you to provide us a lender's perspective and of the overall green and transition finance market, how you're looking at it, and maybe what are NaBFID's larger plans in this area, given that you have such a central role in the infrastructure build out for the country now.
Thank you, Rahul. So just to set the context, the green finance, which normally we talk about renewable energy finance. When it comes to transition finance, mainly the financing to hard to abate sectors, which are mostly the industrial financing, which doesn't fall within our NaBFID mandate, because most of the industry finance happens from the commercial banks. But nevertheless, when it comes to transition finance, as long as it is captive power plants with embedded technology related to carbon capturing or FGD kind of solutions, definitely we will be participating in such lending activity. But when it comes to green finance, yes, it is largely where DFIs has to play the necessary role. This segment is very huge in terms of opportunity for lending. As per the estimates, till 2070 for the NDC commitments, whatever India has got, the required amount is around USD 10.1 trillion. So which translates to almost USD 250 billion per year, which has to be escalated to around 325 billion from 2032 onwards. That is the size of the market which we are talking about. When it comes to the capacity building, the requirement is almost 430 gigawatt is what the commitment for 2030, which translates to almost 38 gigawatt every year. So there is a small pass which happened in the last 2 years, where the actual bidding invited were around 18 gigawatt in the last year, which is a slight improvement over 2022-23. So now this year it is almost 25 gigawatt is what is expected. And it has to translate into almost 38, 40 gigawatt per annum so that you reach 430 gigawatt by 2030. So this is the size of the bid which is assured from the government side. So when you look at this size, there is a huge lending opportunity and for the lenders to participate. So is the industry matured enough to participate by the lenders? If we look at from that point of view, a lot of positive things which have happened. So if you see the solar and wind power, so most of the things have stabilized by this time. So with respect to technology, and the sector itself has been recognized as stable sector from most of the rating agencies. Even our internal data which talks about the median rating of the players in this segment. So it is almost A and A plus in respect of wind and solar. Even though there is a small sensitivity with respect to the wind power because of the wind PLFs are not up to the mark. But the structures have come up so well that all the developers are always looking for kind of debt resizing once it reaches 3 years of sustained performance levels. And also there are guarantees coming from the vendors who are supplying the technology part. So these are the structures which are helping the lenders to participate in a positive way. Apart from that, the new thing is the around-the-clock facilities. So where the hybrid structure which has come up, where wind and solar simultaneous functioning, that has improved the efficiency and productivity and the return on capital. So those structures are also really picking up very well and very good traction there. Apart from that, on the structural side, if you see the DISCOMs, there is a good turnaround story from the government side, the initiatives taken. So through the RDS mechanism, so now the receivable period has come down very drastically, except few people which is not even exceeding beyond 75 days. That means at least the current dues are coming in time. When that is the situation and the panel prices have come down, so the viability of the projects has turned around now. So some during the COVID period because of some government intervention, the projects were becoming unviable. Now those things have been reversed now. So considering all these positive developments which are happening, at the same time the PE players are entering the market. So there is small InvIT traction which is just taken place, but it is not to the full extent. But the quality of asset selling which is happening, PE players coming and purchasing the operational assets in this segment, and the promoters, the earlier promoters who are sitting with huge assets, operational assets, are able to downsell their projects and recycle the capital. So with this kind of all activities which are happening, really there is a good case for lenders to participate with a strong counterparty, central agencies taking up the bidding exercise. So there is a clear positivity everywhere. From lending perspective, absolutely no issue. But when it comes to the initiating and bidding for the new projects, whether that capital exists, the capital is going to come, that is where the DFI roles comes in. NaBFID has to play a key role of bridging that gap, inviting the foreign capital to come in so that it can give a multiplier effect in terms of lending. And even some of the large plants which we have, especially even Mr. Arjun was telling the facilities available in GIFT, which we would like to explore, so that we can invite the some foreign capital through blended finance structure or through AFS structure. So these are a lot of plans we have. So first we have to set our policies in place. We have done our E&S policy already approved, and we are carefully drafting our ESMS platform. So where once it meets the basic principles of international investors, definitely NaBFID will play a very key role in inviting the capital.
Thank you, Mr. Venkatesh. Moving on quickly, since there's hardly any time left, maybe I'll just touch upon a few quick points. So maybe Suniji, from your perspective, if you can just quickly articulate what are the kind of challenges and opportunities that you are seeing in this space?
So a couple of things. As already just everybody talked about renewable energy, excuse me, solar, wind are being considered as relatively lendable now. But there are a whole bunch of other technologies which are coming have to be developed. And there's always the innovation technology risk, which the VCs, et cetera, can take. But there is the chasm between proving it at a pilot stage to scaling it to a usable stage. And that needs a kind of blended DFI, whatever, MDB kind of finance to come to the table. Otherwise, you'll always have a plant which can say it works at 1 megawatt, but I really need to make 1 gigawatt of this, and that is not provable. So that is one aspect. The other is in the Indian context, although many of these lenders are working, but is it pure project-based financing? Not always. People look at the balance sheet, and that has to be addressed. If you want solar to expand, and it has to significantly expand, it has to be project-based financing, could not be based on the balance sheet alone. Then there will be the bonds and bonds issuance for the not AAA rated players. That would be the other part. I'll stop here to wrap up time.
Sure, sure. Neha, moving on to you, I think, I mean, I'll just touch upon it. From a policy standpoint, what are, say, 2 or 3 priorities which you think need to fall in place? Although I know we've come a long distance from where we were a few years back, but are there few things that need to be done from a policy standpoint?
Yeah, I think, look, market has, in this green space, has actually led. Policy has sat up after market has done a few things. Now, if we need scale, we definitely want very, very clear policy signals. I think a couple of them I will state. One is that it's fantastic news that the Ministry of Finance announced that there will be a climate finance taxonomy. That is what the market was asking for. It is the right response to the demand. And that it is a budget announcement also puts a timeline, because next budget, there has to be a report on where we are. So that's a very, very good thing. Please remember, also note, because sometimes we use these terms sort of interchangeably. Climate taxonomy would mean mitigation and adaptation. Now, I would urge the Ministry of Finance to look back at the work that has already been done. I was part of that how does it remain people-centric transition also needs to be the focus of jobs. How many jobs will get created? What are the sectors that will prioritize, etc. Transition lens has to be at the center of the taxonomy. The second thing I would say that in terms of, in Indian setting, I think there is either regulatory mandate or some financial incentive that works. In terms of the mandate, we talked about this morning also, now the PFRDA and RDAI, they have to actually now come to the table. After the sovereign issuance, RDAI said to the insurance that it will count against their investment, right? But investment only in sovereign green bond. Can that be extended to the corporate issuances? Can there be a mandatory carve out that, okay, 5% of their investments will go to green? So between LIC and EPFO, we have $800 billion sitting. So that supply, if through a mandatory carve out can be put into the market, demand will get built upon it. Just the last one, the third one, which is policy come DFI related, I definitely think that it's 2.0 that we are looking at when it comes to DFI's roles. NABARD is going to issue a green bond. They are looking at building their internal taxonomy. NaBFID is really part of their mandate, really will be extremely important actor in the infrastructure space to actually look at creating the market. So policy and market will interact with each other, but sectoral policies, solar is an example. We need clearer, EV now is picking up. Can there be other sectors which can actually, Ministry of Steel, you said, Rahul, has come out with the transition pathway. All of these things are required at the line ministry level to be able to make it financially attractive for it to take off.
Sure, nuts and bolts. Quickly, since we are up with time, last few words on anything on policy or Sandeep from your side on corporate, quickly anything that needs to be done from a readiness point of view, and maybe Mr. Venkatesh and Arjun from your side on policy if anything needs to be done.
Yeah, I think from corporates, 3 things. I think corporates are today a lot more focused on how they can change internally, which means change my own technology, focus on my own investments and all of that, which is a great way to make this climate shift. But it cannot be done in isolation. It has to be done through market strategies, which means how do I engage with my consumer ecosystem, make them more responsible in terms of consumption, How do I work with my supplier ecosystem and ensure that they transform so that my products gets cleaner and greener and so on and so forth. And it has to be combined with non-market strategy, which means that how many corporates today go out in their policy advocacy effort and tell government that we need a carbon tax in a particular dirty product, or we need, let's say, certain kind of incentives for greener products being launched. So for corporates, it's important, combine what you're doing internally on technology shifts with your market strategies to work with customers and supply chain partners and bankers, obviously, and combine it with non-market strategy in terms of how you introduce or go about with your policy advocacy and ensure that right regulations come up and a good green market gets created.
So very quickly, three things which come into my mind. One is the taxonomy, which is a very big policy enabler, and it has already been announced in the union budgets. So that will give a strong push for the Indians to actually look for green financing. That is the first thing. Second is globally also what I feel it is more on the mitigation side. Can we have some policy where we go more towards adaptation? And because now, right now, even if we build infrastructure, there's a need to have climate resilient infrastructure. So there is a need to shift towards a focus on adaptation as well as resilience side. The third is promoting innovation in the space, because we are the leaders when it comes to India in the startup ecosystem. We are the third largest and leaders in terms of technology. Can we use tech or innovate in terms of the addressing climate risks? Thank you.
Taxonomy, everybody has already expressed. But why it is required is from the point of view of, otherwise it becomes too fragmented. Each institution is looking up for some other principles, and I think in the whole process we will miss the attracting the foreign capital. So that sooner the better, because that resource is very scarce. We need to tap it as quickly as possible so that country can reach its NDC commitments. That is one. Second one is the framework even for the blended finance structures. If something can be looked at, so that will probably help for the institutions like us to look at some withholding tax related challenges which are there. So that needs to be addressed so that we can actually participate. Third point is on the capacity building. So it is across all the segments. It is from the players at the financial institutions at the regulator side. So capacity building becomes at the most important. There has to be some efforts towards that side. Yeah, thank you.
Thank you. Thank you to all the panelists for fantastic views. I clearly, from the panel take away and a lot of work to be done in terms of nuts and bolts, in terms of blended finance, in terms of sectoral policies, and also investment mandates, and also capacity building. The point that you mentioned, I think, is a all-pervasive kind of issue that we are dealing with. So once again, thanks for everybody. Sorry to be rushing everyone on the panel, given the interest of time, and thanks to the audience. Thanks.
I'd also like to request Mr. Ratan Kukreja to join our panelists and moderator on stage, please. Ladies and gentlemen, let's give a big round of applause to our panelist and moderator. Wonderful discussion. And may I request Mr. Venkatesha to please present a small token of appreciation on behalf of NaBFID. Thank you so much, everyone. Thank you, sir. Request you to take a seat in the audience. Ladies and gentlemen, as some of our participants and speakers have meetings and flights planned, we are going to push the tea break to a later stage. We're going to move directly to our next panel discussion, which is panel 4. And as we set the stage, let me introduce you to Our topic for this panel discussion, it's a take on the Indian infrastructure industry and the way forward. This discussion will be expertly moderated by Mr. Tushar Arora. He has been associated with the World Bank since 2019, working as a senior financial sector specialist. He is responsible for analytical and advisory services, lending operations, and policy dialogue in the financial sector area. He's also been, prior to joining the World Bank, he's also worked in the banking sector as an economist. He held roles covering Asian markets at HSBC, Yes Bank, and HDFC Bank. His research projects covered macro-financial issues like government bond market, treasury yields, and many more. Ladies and gentlemen, he's also been a regular writer in the newspapers and economic journals, and his views on the Indian bond and currency markets have been widely appreciated. If the stage is set, let me welcome Mr. Tushar Arora on stage. Very warm welcome, Tushar. We have a distinguished lineup of experts to explore this crucial topic. Please join me in welcoming Mr. Baldev Purushastra. He joined the IAS, Indian Administrative Services, in 2002 before joining as Joint Secretary, Department of Economic Affairs, Ministry of Finance, Government of India. He served as Secretary, Lokpal, Punjab, and Divisional Commissioner, Jalandhar, Punjab. He also served in various field and secretariat positions in the Government of Punjab and the Government of India. As you can see, Mr. Baldev Purushartha has joined us virtually, so let's give him a very warm welcome. Thank you so much, sir, for joining us. I'd now like to introduce you to our next panelist, Dr. D.J. Pandian. Dr. D.J. Pandian currently serves as the Director General of the Indian Regional Office of New Development Bank. Prior to joining NDB, Dr. Pandian was the Vice President and Chief Investment Officer at Asian Infrastructure Investment Bank. He has an extensive career spanning 35 years with the Indian Administrative Services and has held key positions at the provincial, national, and international levels in energy, infrastructure, and finance sectors. Ladies and gentlemen, please join me in welcoming Dr. Pandian. A very warm welcome to you. On the panel, we are joined by Mr. Sanjeev Kaushik, who is the Principal Financial Sector Specialist at ADB in Manila. On secondment from the Indian Administrative Services to ADB, Sanjeev served as Additional Secretary Banking in the Department of Financial Services and headed the India Infrastructure Finance Company and was also Principal Finance Secretary of Kerala. Ladies and gentlemen, a big round of applause for Mr. Sanjeev Kaushik. A very warm welcome, sir. We're also joined by Mr. Bhanu Mehrotra, a development professional with a strong track record in mobilizing private investment for infrastructure and creating new markets by working across policymakers, industry leaders, stakeholders, academia, and media in South Asia, East Asia, and Middle East and North Africa, Eastern Europe, and Central Asia. Ladies and gentlemen, a big round of applause for Mr. Bhanu Mehrotra. A very warm welcome, sir. On the panel, we are also joined by Mr. Jae Hyung Kwon. Jae is MIGA's Head of India Office based in New Delhi, responsible for developing MIGA's guarantees business in South Asian region, including India, Bangladesh, Nepal, Sri Lanka, and others. Jae joined MIGA in 2012 as an underwriter in the infrastructure team based in Washington, D.C., focusing on the water and transformation sectors. In 2016, Jae moved to Seoul, South Korea, to lead MIGA's business organization efforts in North Asia region. Ladies and gentlemen, one more time, a big round of applause for Mr. Jae Hyung Kwon. With that, I'm going to leave the stage over to you, Tushar, to take the discussion forward.
Thank you. Good evening, ladies and gentlemen. Let me start by thanking NaBFID for giving us this floor. I think this initiative which NaBFID has started on an annual infrastructure finance conclave, I think it's a great initiative. And it gives us an opportunity to come together, I think, at least on an annual basis. And we hope that NaBFID will continue to organize this in the coming years. We have some great people, some great experts on the panel today. And we are discussing three simple things today. One thing which is clear from the discussion that has happened throughout the day is that Indian infrastructure finance market is not the same what it was, say, 10 years ago. A lot of things have changed, and that means all the stakeholders in the system will have to change. Be it the investor community, the lender community, the issuers, the borrowers, the regulators, if I may say, all of them, I think, will have to see this market in a new way. And we on the MDB side, I think, as well, will have to, carve out new ways to, be involved in this market and ensure that our value add is optimal and impactful for the Indian economy. And this is why we're just discussing three main things today. Where do we come in? What sectors do we come in? Question number one. Question number two is, how do we come in? Maybe we were engaging in X number of ways in the past. Do we change our strategy? How do we, evolve into making newer ways of things when we, make interventions in the market? And thirdly, just when we try and think about new things, what are really the challenges that all of us grapple with? And it would be good to have thoughts from everybody on these three things as well. We have tried to make this session a bit unique, where we would want, although I am moderating the panel, but we would want views and opinions coming from the audience, and that's why we have, set in some, nice, interesting things in the panel as we move forward. And this we would do by, having some polls and opinions coming in from the audience. But before we go there, we are a bit hard pressed on time, and I understand Mr. Baldev Purushottam has to leave for an urgent meeting. So let me start with Mr. Baldev first, and then before coming to the panelists, we'll go to the audience, get their thoughts, and then we'll come to the panel. So Mr. Baldev, over to you. It would be good to know what is your thinking on how MDBs should be looking at.
I would request you to speak little loudly or put the mic near your mouth. I'm not getting the proper voice.
Can you hear us, Mr. Baldev?
Still, it is on the lower side. It's not the volume. You have to raise the volume little bit.
Mr. Baldev, what we are trying to ask is, as representative of the government, as representative of the infrastructure division in the government, how do you see the changing dynamics of how MDBs should be supporting the infrastructure finance market in the country? I hope you were able to hear us.
Well, thank you for your question. And I would say that MDBs has a very, very important role in the infrastructure development story of India. And not only in India, probably they have a role in other countries as well, but I will limit myself to Indian infrastructure, development story. And first, I would like to give you some data where MDBs have been helping us in a bigger way. For example, let us take the World Bank, and their engagement with us, is actually as old as India's independence. And they have funded many of our initiatives, some critical projects, and not only funded, but they have also engaged with us in developing the entire ecosystem for PPP development, the knowledge development for infrastructure development, the transaction advisory support, focused interventions, and all these things in a holistic manner. Today, World Bank is supporting India in over 127 active projects with a combined worth of over USD 28 billion. So this shows the kind of deeper engagement we are having with World Bank, and also in the upcoming fields like social sector, water sector, we are deeply engaged with World Bank to finalize a roadmap how to move quickly and achieve results in these sectors. Then similarly, if I take the ADB, then we have our engagement from 1886 when the ADB commenced operations, and India has been one of the founding members of ADB. And ADB has equally supported India in a variety of projects and in a variety of manner, similar to World Bank. And today ADB is committed support to 623 public sector projects through loans, grants, and technical assistance. totaling US dollar 55.3 billion to India. Similarly, we are having engagement with other, multi-development banks like NDB, AIIB, and then we are also having bilateral negotiations with various institutions and authorities in other countries like FCDO in UK, with whom we are working on a variety of theoretical as well as practical issues of infrastructure development, and it has started showing results. In fact, our Infrastructure Finance Secretariat itself has been established with the support from ADB, World Bank, and FCDO. So there is a very, important space for multilateral banks in contributing to India's development story as far as infrastructure is concerned.
Thank you, Mr. Baldev. The first question, the changing nature of the market. There are a lot of sectors which were getting a lot of financing from the MDBs, which perhaps do not require that financing anymore, which perhaps require newer forms of intervention from the MDBs. There are some sectors which are emerging. We just finished with the panel on the green financing. Maybe there are some newer emerging sunrise sectors which require harder interventions from the MDBs. But you as audience need to tell what you want to hear from the MDBs and whether the thinking of you, the experts in the audience, is in alignment with what the MDBs are thinking about. So let us start with the first poll on this. Please take out your phones and let us spend maybe 45 seconds to a minute on voting and seeing what your thinking is and whether what we can hear from us on the panel, is it same or not? Which sector do you think in Indian infrastructure market should the MDBs be more involved in? Should they prioritize in the next 5 years or so? It's quite interesting how the first rank is not changing, but the answers on the other three are really moving around. Maybe 10 more seconds and then let's hear from our panelists. So while the voting is going on, I think verdict is quite clear. I think urban infrastructure is really coming on the top. Second being social infrastructure, and the energy, transportation, and digital infrastructure also have some votes in there. So let me start by asking Mr. Kaushik and Mr. Pandian, what are your thoughts on this? Is this in alignment with what NDB and EDB are also thinking about?
So Tushar, thank you for letting me be the opening batsman. But before I start, I must thank the organizers. It's fantastic to see NaBFID come of age. In the pandemic time, we were sitting in the ministry and poring over the files, and NaBFID was being drafted on the drawing board. Secondly, what a distinguished panel, seniors from the government and seniors in the audience. My first boss is there, so I better do a good job. But coming to the question directly, as you know, ADB, for one, has been restructuring and reinventing itself as the green investment bank, as, if you like, the climate bank. So we used to be doing a lot of sectors, including infrastructure, etc., but now our mandate is shifting towards doing exclusively green energy, climate mitigation and adaptation related projects. So clearly the demands of the time are such that to fill the huge gap in financing, both for infrastructure as well as for climate financing, MDBs need to rise to the occasion. And of course, these are issues. For example, we are active in e-mobility. In, Government of India, for example, is trying to procure e-buses, and Tushar, that both World Bank and ADB are trying to do that together. Let me not spend too much time on that green aspect because everyone's heard about all this, but some of the other subsectors in your screen. Urban infrastructure, again, is a no-brainer. Government of India has set the target for livable cities for tomorrow, etc. So urban infrastructure, of course, we need a lot of financing to flow in, and that's a priority sector for us. I would like to spend more time on social infrastructure. And this is an area which is underserved. If you like, it has been under-resourced. Most developers, most players in the infrastructure financing sector or in the construction sector have been targeting projects which have good IRRs, good profitability, and traditionally they've gone into highways, airports, the hard infrastructure sectors. But now the time has come when we need to find more and more resources outside the budget for sectors like education, for healthcare, PPP hospitals, chains of diagnostic centers, etc. There are so many other examples we can talk about, solid waste management, things of that nature. So I think the time has come for MDBs also to devote some amount of funding for social infrastructure. But going away a little bit, sir, from the pure MDBs, I think NaBFID, here is a tale for NaBFID. When NaBFID was set up, several exemptions and waivers were given to NaBFID. In the Act, there are so many dispensations that NaBFID enjoys, hedging costs being reimbursed, guarantee commission is hardly, I think, 0.25% or something like that. I think it's incumbent upon NaBFID as a social responsibility to take up some of these sectors which are not necessarily commercially viable, but which are under-resourced and underserved. Otherwise, the risk is that NaBFID will not be able to supplement budgetary resources for which actually it was set up. And it will only chase profitable projects, which I think will be half fulfilling the purpose. It'll become like another NIIF. NIIF was set up with a purpose from which it's my personal feeling that it has deviated a little bit. So the word of caution here is for NaBFID to also please focus on some of these sectors. I've spoken a lot, sir. Over to you. Thank you.
Thank you. Actually, the poll captures what is the exact requirement of India as of today. Also, mostly, that's what we are doing. Urban infrastructure covers everything. It covers transport, it covers water supply, it covers education and social sector. So it covers everything. All will come in the urban area. The general trend is towards urbanization. A lot of people are coming from rural area to urban area, so seeking employment. So the urban infrastructure is collapsing. The bridge, we construct the bridge, but we forget to put a system, how to drainage the water under the bridge. The rain comes and it is flooded. And urban infrastructure is very much needed, but it should be holistic. It's not just putting the bridge alone will not solve the problem. Today, NDB, we are doing a lot of projects in the urban area. Delhi National Capital Region, Delhi Meerut Regional Urban Transport System. Of course, along with the ADB, we are doing it. Indore Metro, we are doing it. Mumbai Urban Transport System, we are doing it. Chennai Metro, we are doing it. Bangalore, we are negotiating with that. So everywhere, urban infrastructure is a need of the hour, but it should be holistic. It should not be just putting metros or bridges is not enough. People are coming there to urban areas for good quality of life. So how we can deliver good quality of water? Just giving piped water alone is not enough. It should be pure, it should be drinkable, it should not create further diseases. Today, Ahmedabad Municipal Corporation has put up a notice board warning. Because of the flood in the river Narmada, the water color has been changed. So be careful, and also please boil the water and drink it. Now, can't we make a water drinkable? How to improve? Infrastructure is there, but how to improve the quality of the infrastructure or quality of the deliverables? That is important. Very good very good school systems are needed. Yes, I agree with you. Social sector is also needed. At the same time, transport and water supply within the city cannot be neglected. But in India, also from state to state, it differs. If I go to Assam, they will say you put up 2 bridges in the river Brahmaputra. If you go to Meghalaya, they will say, please help us to improve the infrastructure for the tourism, community-oriented infrastructures. If you go to Bangalore, again, they will say, put up urban infrastructures. It varies. If you go to Gujarat, they will ask us, give us help for social infrastructure, develop hospitals, medical education system, paramedical education system. So it varies from state to state. It depends upon the political will also. But what we need is, we need to assess the exact requirement and see the infrastructure is wholesome and useful, sustainable, maintainable, and climate resilient.
Thank you. Jay, Bhanu, I think let us get some quick thoughts from Mr. Baldave. We might lose him soon. So, Mr. Baldave, you want to come in here? I don't know if you're able to see the results of the poll. The audience here says that the MDBs should mainly be involved in the urban infrastructure space. Is it in sync with what the government thinking is also? Mr. Baldave, are you able to hear us? You're on mute. I think there's some problem with the line. So while we fix that, some quick comments from you, Bhanu, and then Jay.
Sure. Thank you very much. I think IFC has quite aligned with the type
Tushar,
of...
am I audible?
Yes, you are. Please come in.
Yeah, so sorry, I am not getting your question because of the very low volume. But my quick thought on the results, irrespective of what you have asked, sorry, I am not getting it. But my quick thought on results, I am not surprised at all on the results. More than 50% has, indicated it's urban infrastructure. And prima facie, there are three main reasons why such result has come. Number one, of course, urban infrastructure is a big need area, and we need to work in that, including support from MDBs. It's sometimes said that 75% of the urban infrastructure of the Amrit Kal is still to be built. So it's an area which requires a substantial infrastructure development, getting support from all sectors, private investment, MDBs, government efforts, everybody has to chip in. That's number one. Number two, that primarily the people who have indicated this, it seems that they are urban dwellers, and therefore they are much more concerned about the urban issues. But more importantly, the third point which I am getting is, the urban infrastructure is an omnibus word. It's not one infrastructure, but it encompasses a variety of infrastructure, especially in the era when we are talking of urban infrastructure, not within the city itself, but also it's reaching to the urban and peri-urban area. So it includes transportation projects in urban transport. It includes social sector projects in terms of water supply, healthcare, sports facility, recreational facilities. It talks of, energy solutions, clean energy to the urban cities. It talks of infra solution for industry and productivity, jobs and skills. So it encompasses a whole spectrum of infrastructure cutting across various sectors, and that is why urban infrastructure is so important. Thank you.
Thank you, Mr. Purushottam. Bhanu Jay, some quick comments here, but it is really the next question which is going to be very interesting from both of your perspectives.
Sure. So very quickly on the city space, everybody has said 70% of GDP being there. So simply from a growth perspective, but also from the quality of life perspective. And as far as IFC is concerned, we are very much there. I think the huge needs of water, sewerage, the circular economy, waste management, e-mobility, and even affordable housing. All of those space we occupy, and we think that we'll be growing in that space. I think two quick thoughts on this is that, first of all, there are certain areas in this like waste to energy and bio-CNG, etc., which are very amenable to private investment. But a whole lot of this urban infrastructure is not so amenable as it stands today to private investment. And so there's a space here where urban local bodies will have to take the lead. And so institutions like IFC are even willing and looking at working directly with ULBs, not just with the private sector, to see how we can sort of support their funding needs. Of course, whether it is on individual basis or on pooled basis. And lastly, I think the whole point is that how do we bring commercial financing to urban infrastructure, not just, so it should complement the public financing. But the point apart from cities, I would say, is also that
I think people say that renewable energy is mainstream. Yes, it is. But the challenge is huge still. So greening the energy transition challenge poses an equally important area for us to continue growing. I think there are areas like pump storage, energy storage, bringing in commercial industrial customers in a big way, mainstreaming corporate PPAs, and so on and so forth, which still need to be worked upon. So there's a lot of IFC focus that will continue to be on that front as well. Thank you.
Thank you, Bhanu. Jay, would you like to add anything, or shall we move to the, okay. Can we put the second question on the screen, please? And I think this is going to be interesting. I can give you a World Bank take on this. Now, whatever projects we are at least looking at, be it in the form of technical assistance, be it in the form of policy advocacy, financing, one key parameter that we have now started tracking is PCM, which we call private capital mobilization. Whatever intervention we are doing, is it leading to some PCM or not? And how much is that PCM? And we're starting to track that. So depending on the PCM and depending on the impact, you in the audience, do you think there is change in the way MDBs should be intervening? Some areas might require more of technical assistance. Some areas might require no financing, but just fixing up of some regulatory guidelines. While some areas are a bit mature and they require new innovative products of financing. So what is really your take? It seems like everyone is really satisfied with the policy because the policy advocacy is 0%. Let me start by getting some thoughts from Jay. I think he's really trying to do something very, very innovative in India with MIGA. An institution which was not doing many deals in India now is increasingly looked upon as one of the cornerstone of financial innovation now. So let's hear from Jay. What are your thoughts on this?
Thank you, Tushar. This is very interesting because, just looking at the scale, all of our financing, all the MDB financing and loans, probably 5% and less of India's infrastructure needs. Okay? So if you're looking at scale, we're not it. If you're looking at scale, it's everything that we discussed this morning. It's about public financing, it's about commercial loans, local institutional investments, infrastructures, everything we discussed this morning, that's going to bring you the scale. Our role, I believe, is going to nascent sectors, going to riskier sectors, to open up markets so that eventually the commercial financing can come in. And that includes the risk mitigation, technical assistance, etc. Now, from MIGA's side, we closed an interesting transaction recently with the Dedicated Freight Corridor Corporation of India Limited. As you know, they have built the Eastern Corridor and the Western Corridor over the past 15, 16 years. So it's a huge project. And they needed financing. So it was JICA and the World Bank that provided that seed money, the preliminary money that they needed, obviously with the public financing. At this time, when they're almost completing the construction and they're ready to operate the freight corridors, they're tapping the commercial market. Now, because they don't have any operating experience, the commercial banks were not very eager to lend. That's where we came in. So we're the guarantor that bridges that risk perception gap, meaning we as a multilateral know that DFCCIL as a standalone entity will not default. But if you're a commercial bank, if you don't know, if it's a new entity that doesn't have operating experience, you don't have that confidence. And I think that's where we came in, and our guarantees allowed commercial bank to come in to provide financing, which is very important because they have tens of billions of dollars for future freight corridors planned. So for us, we helped to open up that commercial market so that for the future lines, they have this commercial banking option, as well as the World Bank and other financing sources.
Thank you, Jay. I think while you were speaking, Jay, the score for risk mitigation was slightly going up. So maybe. Yeah, you are influencing. So what are your thoughts, Mr. Kaushik? I think some sectors have really matured and do not really require the kind of financing that was needed earlier. They maybe require something else.
So actually, I find it easier to answer this question as a IAS officer in Kerala. And I'll give you two or three examples from my experience as a project director of multilateral funded projects. One was the Kerala State Transport Project, where one would think that it's only about getting a loan and building roads. But it was not, because there were aspects of design, there were aspects of road safety which became very important. I mean, the terrain in which the road ran in Kerala, all of those issues. So I think apart from financing, it was also those aspects of technical assistance and capacity which were very important. The second example is, again, Kerala, and Bhanu will relate to this, is when there is a large international seaport which was coming up near Trivandrum called Vizhinjam International Seaport Limited, and I was the MD for that. We got IFC as the advisors, not for any big money that they were bringing in, but you gave us some very valuable technical assistance, helped us structure the project, restructure the project rather into an EPC port, which is then what led to its successful bidding. So I think that kind of capacity and policy advocacy was very important. That's the second example. Third and final example I wanted to give us from my days as MD of the IIFCL, the Indian Infrastructure Finance Company, where from the inception, ADB was involved in working with IFCL, and in fact, a very innovative partial credit guarantee scheme was introduced with ADB assistance for the first time in the country, and today you know how relevant credit guarantees are. So I think these three examples show that the MDBs, after all, how much money do they bring? It's only a drop in the ocean. $4 billion from ADB, $4 billion from World Bank. It's not much for a country like India. It's actually the global expertise, apart from the features of the loan itself, like the long tenor, the costs, the blended finance that we are now bringing in. So I am now bringing in blended finance, as Rajkiranji, you know, from GCF and from the Korea Exim Bank, so as to lower the costs. So some of these aspects, in PPP infrastructure projects, I think policy advocacy used to be very important at a time when India was still waking up to PPP. But in other areas now, policy advocacy, some of which you named, Bhanu, for example, in energy transition and technologies which are still emerging technologies. So I think it would be fair to say that funding is probably less important, quite important, but not as important as some of the other aspects that come with an FDB loan. Stop there, thank you.
Totally agreed. And I think one point to add there, I think apart from the designing of the project and structuring it well, it's also the implementation and the monitoring phase. I think where we MDBs, as we add a lot of value, because that's where we have a lot of standardized procedures and offering implementation support to the borrower. But let us hear from Mr. Purushartha. I'm not sure if you can still hear me, but you saw the results. What is your take on that?
My take is very simple. See, undoubtedly, loan and finances are the most visible instrument of support from MDBs. So everybody is having, this kind of understanding that if MDBs are there, they are probably only to give us finances and give grants and loans. But let me give you one data, because we talked of the urban development and urban infrastructure development requirement in the last question. So one of the World Bank studies says that there is a requirement of $840 billion in urban infrastructure and municipal services till 2036. Now, if there is a requirement of 840 billion by 2036, and the combined support of the World Bank in India infrastructure projects, 127 active projects, is around 28 billion. So we can fairly understand that the World Bank, or for that matter MDBs, combined together finances and loans are not adequate enough to take load of the Indian infrastructure development. The India infrastructure development has to be with the larger domestic effort, larger international effort, in which MDBs can play a very, very important role. And their role is not only limited to finances and grants, but also limited to policy advocacy, transaction support, and other kind of support system in helping the country to scale up the infrastructure efforts it's being taken. So therefore, my take is that it's not only the grant and finances, but also, and you might be aware that even in the definition of blended finance, transaction support by the MDBs are taken as part of the blended finance definition. So it's combination of efforts and instruments given by World Bank and support given by not of all MDBs. That is important for infrastructure journey and developments, not only the finances and grants, but yes, finances and grants are important and they are the most visible element, and therefore it's not surprising to get this kind of result.
Thank you, Mr. Purushottam. Bhanu, Mr. Parnian, I think what all of us are trying to hint towards is, if all of us as MDBs are putting $10 billion on the table, is it leading to $50 billion or not? And you as IFC, you work with the private sector. What are your take on this? And sir, your take on this, maybe after Bhanu.
So firstly, as IFC, I think a little bit of a different taste is also there. For example, when we as IFC go out and invest in private, very innovative private companies and platforms, like for example, CleanMax. We did our first equity investment globally in what is a grid-connected distributed energy company. Now, these are, and similar examples recently we did with another where we had done equity investment. I think ADB and DEG is also involved in fourth partner. Now, where again, you know, we are actually investing in a very innovative company which comes and creates a new asset class like corporate PPAs, selling to the commercial and industrial customers rather than just to utilities. So this sort of a role is very market creating. I mean, it's not just policy advocacy or technical assistance. It's not just also investment. It's actually nucleating innovation, and that I think is something which is very value added in the whole creation of the whole ecosystem. I think the second thing is that, as Sanjeev very rightly said, and in fact, we as IFC also had the experience of working with you, sir, on Gandhinagar rooftop solar. And way back in 2010, I think 11, and the whole thing was that we helped stitch together a transaction and which IFC came back and funded. It was a very small transaction. It was 5 megawatts, but it helped unlock a whole asset class, a rooftop solar grid connected. Of course, the scaling was done sometime later with World Bank intervention, etc. But it sort of, and the similar thing when we unlocked the ground-mounted solar space with Riva Solar, where we sort of stitched together everything. World Bank put in $18 million. We, through our transaction advice, structuring it very innovatively, we multiplied it 32 times with $575 million of private financing, riding on that $18 million. And in turn, when IFC also raised the debt package for the winning bidder, they mobilized it further, that for every $1 that IFC lent, there was $2.1 of money raised from local institutions. So these sort of enabling activities sort of help us multiply, and of course working together helps us multiply as well.
Just quickly add one important point that Bhanu has raised. I think if the MDBs are to continue to be relevant in the Indian context, then they have to have that catalytic role. You have to be able to channelize more and more private investment and leverage the funds. So if it's your 4 billion annually, and that's like 20%, and private sector, promoter equity, other investors come in, I think at least 5 to 6x that investment. That catalytic role is going to be very important, and that should have also been put up on your screen.
Exactly. Mr. Pandyan, any thoughts from you? Maybe after this 5 minutes, we can spend on challenges, the point that you started discussing on.
Among the MDBs, NDB plays a different role. I think policy advocacy is concerned. World Bank and ADB have enormous experience. World Bank is considered as a knowledge bank. They have 70 years of experience, more than 70, and ADB also more than 50, 55 years. And they have huge human resources. This is nowhere in any other organization has such kind of knowledge pool. So they come with different knowledges, best practices and all. So we have to use World Bank and ADB to get the latest ideas, latest technology, and latest business practices, and we cannot deny that. NDB plays a different role. We want to avoid the pitfalls which we have inherited from these legacy banks, World Bank and ADB. Normally it is criticized, they come with a lot of conditionalities. So NDB is without conditionalities. I mean, procurement, we adopt a country policy system. We don't want a universal procurement. I mean, to construct affordable housing, why should we go for the universal procurement? Naturally, the local builder will come. Similarly, in a metro, there are different parts. There is a civil construction, there is a technology, signal technology and all. Okay, signal technology, we can go for universal procurement. For the civil construction, there is no need. So it is here the NDB steps in. And we align with the Make in India policy, and it is easy for the host countries or the member countries to get NDB's assistance and improve the infrastructure. So we are in that way very unique. As far as technical assistance is concerned, again, it varies from state to state. There is no need for a technical assistance to a state like Tamil Nadu or Maharashtra, but it is definitely needed for northeastern states because their capacity is limited. Here, the technical assistance plays a very vital role to design the project properly, to appraise the project properly, and to implement and monitor also. So at every stage, the technical assistance is needed. And then only, because we need to do a hand-holding concept, otherwise the infrastructure will collapse and the infrastructure may not be sustainable. So to have a successful project implementation, technical assistance, capacity building are needed, and multilateral development banks have to provide this.
Thank you. I think in the interest of time, just maybe 30 seconds to everyone on the panel. We know which sector to go into. The audience, very well explained that. We have some idea how to go about it. We just discussed all those things. What do you think is the biggest challenge when you try and do those things? Maybe just one pointed challenge that all of you can refer to. And then let's hear from Mr. Purushartha if he has any guidance for all of us on how to deal with those challenges. Bhanu, let's start.
So quickly, I think given the size of the challenge itself, the investments required, I think what is what the challenge is how to create a noticeable impact with the very small envelope of financing that we all have. And this is complicated by also a lack of a robust pipeline of bankable projects.
So by challenge, I mean what you as a MDB is facing as a challenge, and what I gather you were saying is the availability of a robust pipeline in a nutshell, right? As your biggest challenge that you can say.
Yes, and also how to do more with less money, so okay. That's the challenge.
Okay, Mr. Kaushik?
Let me go at the end.
Okay, Jay, you want to go ahead?
So I think I'll take that question as what can we as MDBs can do better. And I think if we can standardize our own policies, if we can trust each other's due diligence process, that would free up so much of our resources, so the remaining resource can do other things. I think that would make a big dent in the whole infrastructure financing gap.
So you mean we as MDB standardizing our procedures and policies? Is that what you mean?
Exactly.
Okay.
I'll give you 2 points. One is quality of the projects. Quality of the project conception, quality of the project preparation, quality of the project implementation. Second is the cost of borrowing. Dollar is very costlier today. Every government says no dollar, no dollar, no dollar. This hits the MDBs very badly.
So I agree with the point about the lack of bankable projects, but I think the biggest problem that I am finding, and I can afford to admit this because I'm myself a bureaucrat, is the bureaucracy. Number one, ADB's own internal bureaucracy safeguards the procedures from start to finish at least a year to approve a project and deliver it. I mean, Rajkaranji, your technical assistance from us has taken a year and a half maybe, but that's the MDB bureaucracy. But our own bureaucracy, it's I'm aghast from outside to see how poor some of the processes are in our country. When the Honorable Prime Minister has laid out the priorities, when the Honorable Finance Minister in the budget has said that these XYZ, green, climate, infra are my priorities, who are the departments in some of the ministries to, get the file stuck, take months to ask questions which are simply post-box issues. Files keep going up and down, meaningless questions without any value added being asked. So I'm very frustrated with our own bureaucracy. And I compare this with the countries that I work across the region, Bangladesh, Sri Lanka, even, which are in crises. They are so much more nimble than us. So I think there is a lesson for our own skill building in the ADB bureaucracy as well as the Indian bureaucracy. So all bureaucracies are bad. Thank you.
Mr. Purushartha, that's the last word from you. And then maybe we can have some 1 or 2 questions from the audience, maybe just 5 minutes after this.
Thank you. I think there is some truth in whatever being said by all the esteemed panelists. I am no one to say what are the challenges, internal challenges within the MDBs itself, but 2 things which I would like to point out. One is, of course, as said, that and probably the larger MDBs are facing the bureaucratic challenges, the internal bureaucracy challenge. That's a fair point, and we understand this also. But the second issue, and which Mr. Pandian has raised, and that is good point of NDB, that's much more flexible in its approach. And I think that flexibility is required to be adopted by all the MDBs. Given that world is a very diverse place and countries are at different, parameters of various economic parameters, but we need to understand the country's specific requirement, and MDBs have to be flexible to approach those requirements in that manner. So this is for the MDBs challenges. But for infrastructure challenges in the country, they are one and many. And last couple of years, we are almost last 10, and especially after COVID, Government of India has tried to handle those infrastructure challenges in a very systematic manner through reforms, through programmatic approach, and by also unlocking the potential for private capital to come in for the infrastructure development. I think biggest challenge for us, all of us, how to unlock the potential of private capital to be part of the infrastructure development. That requires a mindset change. I understand when I interact with people across the states, many states are still having that mindset of no, private, infrastructure development is not so good. It's to be done by the government itself. But things are changing. And with that mindset, there is a requirement of a very, very robust pipeline of bankable project. I have still some thought of what we can call a bankable project. There is a lot of diversion. There is no specific definition of a bankable project. But I understand that NIP itself, which is hosting a project pipeline of 10,000 projects, I think a large number of projects probably are not bankable. So we need to work on a very robust pipeline of bankable projects, which are amenable to private investment, domestic as well as international. And then thirdly, we have to unlock the international capital to come for India's infrastructure development. Already VT and DA is working on that. We have a collaboration with City of London, and we are working to identify those areas in our concession agreements, in our policies and in our projects itself, which can be tweaked to open the field for international finance. But these 3 are big questions. Ultimately, it's the infrastructure development in next 20-25 years. India 47 depends a lot on the kind of infrastructure we are going to create. And as our Honorable Prime Minister has said, and he said at the time of launching NIP, that it is the endeavor of the government to provide world-class services to the citizen at large. That is the overall goal. And that goal, how to achieve that goal, that depends a lot on sorting out these issues. Thank you.
Thank you, Mr. Purushartha. I think that summarizes the discussion also very well. I'm taking the liberty to just extend it by 2-3 minutes and maybe have some questions from the audience, if possible. Anyone? Okay. I think it's quite an extensive day. So thank you, everyone. And thanks for all the great thoughts shared by our fellow panelists on this panel. Thank you.
Thank you. Thank you.
Thank you so much to all our panelists and moderator. I'd here like to invite Mr. Himanshu Guliani, Executive Vice President, Head Corporate Strategy and Partnerships at NaBFID, to give a small token of appreciation to all our panelists and moderator. Ladies and gentlemen, give a big round of applause to our moderator and panelists. Thank you so much, gentlemen. Thank you very much. Now, as we reach the end of our event, it is my honor to invite Mr. Raj Kiran Raiji, Managing Director of NaBFID, to please join us on stage and deliver his closing remarks and vote of thanks. Let's give him a warm welcome, ladies and gentlemen.
Thank you. I think it's a great job done by our MC also. Maybe as MD of NaBFID, I would not have aspired for anything better than this. I think it went much better than what we really thought, and so much of thought, so much of new ideas. NaBFID has some thought processes. We tried to put it together, but the way it shaped it is much better, and hopefully this will add a lot of value to our planning, and maybe the way the regulators and the government, they are understanding NaBFID much better than us, actually. The way they are respecting things, and real expectations have gone up. So maybe today's day, that is 12th September, is a landmark day for NaBFID, actually. We should all record, and the way my team has worked for last few months as the date got fixed, and trying to onboard today, the kind of galaxy of speakers who were available in the first session and among the panel, I think we could not have aspired for anything better. The value which was coming in was fantastic. And new dimensions about, because today there is absolute clarity that infra development is the in thing, and the country, Viksit Bharat hona hai, to infrastructure mein investment hona hai. This is something which is coming out very clearly. So our secretary, Mr. Nagaraju, the secretary DFS, actually he expanded the vision of Viksit Bharat during his this thing. Actually, it was a very short time. He reported very recently. We met him and requested, and he immediately agreed, actually. His plan was done and it was all done. It was only day for yesterday evening, some meetings got lined up. You know how the government works. And they are so critical. Then he told me that, it will be very tight for me to come. And I requested, can you come through video conference, because that also serves a purpose. That he readily agreed. And I was very happy. He was not only making a speech, he was also logged in to watch Mr. K.V. Kamath speaking also. Basically, that shows the interest. And even when we made a presentation to him, he was very keen to understand, particularly on urban infra side, actually the kind of support he is assuring and his understanding of the things. And maybe he has worked with some of the multilaterals also. That experience, hopefully, he will lead the way. How NaBFID will shape up, but then at the same time, for NaBFID team, it is an additional responsibility now, because the demands will be much higher, and the expectations also will be much. But I am very sure our team, always delivered much better than what we thought, and this time also will deliver. And he also actually pushed the theme, saying that the government has done a lot of things, now it is up to private sector to do it. And maybe NaBFID is created with that idea of crowding in investment, and actually maybe today's theme was also around that. And I'm very sure, with the support, hopefully we'll be able to rope in more and more private sector investment. Mr. Rajeshwar Rao, the Deputy Governor, he's a big support in RBI for me because he's one man I reach out whenever we have a problem, and every time he's very pleasant, hears us, and most of the times actually our issues also get sorted out in record time actually. So actually he went through the whole process of the whole evolution of the infrastructure financing and the developmental institution. And he had a very clear for NaBFID because on better underwriting skills, risk management, because NaBFID is one agency which has mandate to take market talent, and which we have done actually. The skill sets which are available, the best skill sets we are able to rope in, and with that actually, you know, the credit risk which killed the whole spirit around infra earlier should not play out again. I think his mandate was very clear to NaBFID in addition to assuring the support. Mr. Pramod Rao, actually, it was a very, you know, for us actually, he suddenly shifted the thought process that when we always talk of developing bond market, he was telling what is developing bond market? It is already developed, like, you know, basically. You know, that was very, very, you know, like what we say, paradigm shift in thinking, basically. And he was right with the numbers what he's quoting. But actually, next panel, when the deliberation were going on, basically, you know, the analysis came in, basically, okay, numbers are there, but numbers are where? AAA and G6 or that kind of things. So it is not there where it should be. That's what we are looking at. I think maybe this is what actually when they say something, they trigger a thought, and in the panels, like, you know, those things come out, and it is a learning for us. And then the fireside chat, actually, with Tamal Bandyopadhyay, you know, it's always, you know, he just takes you to a different this thing. As Mr. Kamath mentioned, he is very naughty also, so I think it was visible. But I think he took the best out of Mr. Kamath Saab, actually. You know, it was such a wonderful thing. And his experience, actually, we talk of more of restricted group structures and unit structures, which has changed the way the infra is being refinanced or the operational assets are financing. And he took it to a very big perspective at NDB, when 5 countries came together with different ratings like BBB and all that. As a pooled structure, they could get a AA rating. You know, this is such a good learning for all of us, you know, in the modeling of the future loans, and even when we look at other countries around us, which may be, you know, around like rated like us, as a pooled structure, it can be much better. So, and then the panels actually, you know, went on with this thing, particularly the first panel where Mr. Ashish Garg made a very exhaustive presentation. We are lucky because like this being a knowledge partner, we also know that they work with many state governments also in addition to the central government. You could bring that perspectives here, how every state government also is looking at infra development in their own way. The Viksit Bharat is not only for the country, it is also for individual states. Now, as we are reaching out to states, we are also seeing that difference that every state, actually we are getting that kind of response from the chief secretary level and other bureaucrats, inviting us to participate in the development of state. Every state is competing with each other. Now, which state will become 1 trillion first is something like, you know, people are competing with each other in attracting investment and all that. So this is something which is very useful, because in the last panel, actually, project pipeline discussion which was happening, because we have started our transaction advisory, and I'm very sure as we build on that, maybe we will go and dig into those pipelines and see, and then work on that and make that more bankable. Actually, this is the BCG, that panel also was fantastic. The next panel was very interesting because that is more connected to what we were talking, the bond market. Mr. Nitin really could bring that Bloomberg intelligence and the perspectives internationally what they have into that panel. Fantastic discussions, a lot of good thought processes, very crisp, but then very good inputs, and hopefully my treasury team sitting here would have captured all those inputs and prepare us for the next round. And his guidance in the end, actually, like NaBFID should also deal internationally. Like, you know, this kind of conclaves also should be held in the perspective with the international investors also. It was fantastic. And definitely, because crowding in investment doesn't happen only locally, crowding in investment happens internationally. As Mr. Kaushik was also mentioning in the last phase, we have taken a lot of strides, but actually, you know, if you ask me what is in the plate, nothing, but a lot of things are cooking everywhere. So once it comes to our plate, then only we can say we have achieved something. So then Mr. Ratin from CRISIL put interesting data on green financing and the ESG perspective, and how India could approach it as like to be a developed nation. So regulations always come at a cost, actually. That's what they mentioned, and the benefits of climate and the no, for the climate side, no cost is high. Basically, because we need to take care of this, and it is our responsibility to hand over this world to the next generation as safe as possible. So I think we should not look from the cost perspective, but definitely, we need to find ways of taking care of this extra cost. Then the Multilateral Development Bank, it was a very interesting discussion again. One of the, one of the senior most panels we had, and also Mr. Baldev connecting from Delhi, people who are hands-on, actually handling an issue. It was so interesting to say they themselves, the bureaucrats themselves, mentioning that bureaucracy itself is an issue. But, it takes that kind of boldness. Actually, see, problem gets solved when it is accepted. That's the theory I always followed. The problem is problem as long as it is not accepted. Moment you accept that there's a problem is solved. Now, if everybody is aware that this is a problem, the time is not far off when it is solved. So it will be solved, I'm very sure, because we are also dealing with the government. We get a lot of our approvals. It takes time. He was mentioning, actually, because that process have to be, streamlined and all that. But I think as we go along, that is one of the, policy advocacies from this, panel learning. Maybe once we share with the government, we should write this, that this is one thing which gets flagged. I know that this will go to the higher authorities and somewhere, this will be attended to. The procedure simplification, government is really targeting. A lot of things are already happening. Hopefully, in these areas, like particularly even small investments coming into country, it has to go through a lot of approval note. Because even though it is a grant, before we take that money, at least multilateral to another DFI like us, actually it is not going to NGO or somewhere. And for purposes like climate, all that, should be much smoother than, we should not follow the same rules for everything. Maybe can we differentiate in these processes is something we have to look at. And it is very, heartening to see the participation of media. Even though I have not heard anything, even I was also doing interviews actually in the sidelines with many of these media persons, live and other print media and all that. But it is like Himanshu was putting in the, our group, the kind of coverage. Is I think since morning, it's a continuous coverage. And people have covered this event so well. I think NaBFID has arrived. And I think today the visibility of NaBFID actually has gone up many-fold. Our Patel Sahab always used to say, a lot of people don't know what is NaBFID. I think, sir, today I think it will be very satisfying, I think now there's a very good coverage, even though we used to make effort, but it was happening in pieces here and there. But I think today it was very exhaustive. And I also thank my friends from media for exclusively covering. Particularly very, very senior journalists were here today covering this event, and it has given actually that class to this event by the sheer presence of such people. Basically, this kind of events in Mumbai keep happening, but it is actually a great defiance. I think we will definitely come in AAA cadre because today kind of people who participated and people like Manoharan, like who are the veterans of the industry, and Mr. Prabhakar, Aruna Madam, my directors, so sat through the whole process today, hearing everyone and all that. This is fantastic. Actually, I think I have no better words to share this happiness. Similarly, I thank all my logistic partners, the event coordinators, public relation team, and the core team, my team, which spent months preparing for this. I think a round of applause for all of them. And the event management team and the media, the Trident team, and in the whole leadership of the BFIS sector, which came, participated, and I can't thank them enough. You made the day for NaBFID, and hopefully we look forward for more events and maybe international events, and then bring together the best brains in the industry and get the best out of them, because there is so much of experience sitting here in this country, a lot of veterans. We should bring them together so that we get the good guidance to take this country forward. All the very best, and thank you again.
Thank you so much, sir. I don't think this event could have been better summarized and concluded than how you have articulated. Thank you very much. Ladies and gentlemen, as we conclude this insightful and engaging day, I want to extend my deepest gratitude to all our speakers. Like sir mentioned, it is the quality and the position of these speakers that has brought so much knowledge, wisdom, insights, and coverage as well. So we thank all our speakers, our panelists, and of course, all our attendees. Thank you for taking out the time and being present here at this very first NaBFID Infrastructure Conclave 2024. I'm sure this event has been truly memorable and insightful for each of us. We hope you find the sessions valuable and that the discussions have sparked new ideas and connections, because only when we put action to these thoughts and ideas is when we really will build the infrastructure of tomorrow. Ladies and gentlemen, with that, I thank each one of you once again. My name is Khyati Kawa. It's been a pleasure to be the host to all of you. Thank you, NaBFID, for giving us the opportunity. Have safe travels, everyone. Have a great day forward. We request all of you to please join us, invite you to join us for high tea right outside this room. Maybe have some networking there as well. Thank you very much. Have a great day. Hope to see you in your next event. Yes? Yes. Yeah. May I request NaBFID team to please join on stage for a picture together? May I please request NaBFID team to join on stage for a picture together?
Got it? Thank you.